to as fixed assets, but the specific technical term here is property, plant and equipment. And in this standard, we'll talk about when do we recognize the property, plant and equipment, how do we measure property, plant and equipment, when do we de-recognize property, plant and equipment, and what are the disclosure related requirements with respect to property, plant and equipment. Now, when we say recognize, when do we bring property, plant and equipment in the books of account, that is initial recognition, and then subsequently if any expenditure has been done on property, plant and equipment, when do we recognize that? So initial recognition as well as subsequent recognition. Then when it comes to measurement, see, whenever you are accounting for something in your books, one part is recognition, that is the debit entry and the credit entry. The other aspect is at what value, and that is covered by the measurement. At what value should you account for the property, plant and equipment at initial recognition and at subsequent period. So here we'll be talking about aspects around depreciation, the cost model, the revaluation model, right? All of those things will be covered under the measurement aspect. Then comes de-recognition. Recognition, bringing into the books. De-recognition, throwing out of the books. Throwing out of means discarding that particular asset, or that asset is no longer existing in the books of account. So that is dealt by de-recognition. So we'll understand when do we de-recognize, what do we do when it is de-recognized, and all those things. And lastly comes the disclosure related aspects. So whenever we talk about disclosure, that is to do with the financial statement, the presentation part and the disclosure part. Now when we do that, we'll also have a look at financial statement of one of the companies to understand what are the various things that are disclosed in the notes to accounts. So let's get started and understand about property, plant and equipment. Before we move ahead with the discussion on property, plant and equipment, let us revisit one example. We had a similar example when we discussed inventories. I am revisiting them here so that it is absolutely clear as to what comes under inventory and what comes under property, plant and equipment. Say if you visit our office at Indigo Learn, you would see a lot of computers being used for production of these videos, right? Now these computers are basically used to process the videos, to animate them and to edit them and finally provide it to the students. Now these computers are used in our business. We are using these computers to provide services to the students. Now look at a computer dealer, someone who purchases and sells computer. He would basically buying computers for the purpose of sale. Now we have understood in Ind AS 2 as well that if something is purchased for the purpose of resale, then that would be classified as inventory. So if a person is dealer in computers, the purchase and sale of computers will take it to Ind AS 2. But if you look at Indigo Learn, we have purchased computers for use in the business, and these computers will be used to supply services to the students, right? So these would be classified under property, plant and equipment. Now there is an animation team which uses these computers, and there are other employees who use these computers for administrative purpose. They do not directly use it to provide services to the student, but for administrative purpose. Say for example, for accounting purpose. Now you have an accountant and who uses computers for accounting purpose to file the income tax returns, the TDS, the GST returns, do the day-to-day accounting, all of those things. Now this computer we say is being used for administrative purpose. One set of computers were being used to supply services, another set of computer is used for administrative purpose, right? So even if an item is used for an administrative purpose, we bring that within the purview of property, plant and equipment. Then we have the general air conditioning system, we have the furnitures, all of these items which are used for administrative purpose, even those come under the purview of property, plant and equipment. So a broad distinction is if something is used for production or supply of goods and services, or it is used for administrative purposes, we'll call them property, plant and equipment. Apart from these two, there is a third category where any item is held for rental to others. Basically, you own those items to provide them on rent to others. Say for example, we provide vehicles on rent to others. Now these vehicles are also items of property, plant and equipment. So broadly, three things that you need to understand. One, they are held for use in the business for production and supply of goods and services. Second, they are held for rental to others. And thirdly, they are held for administrative purposes. So these three category of items are classified as property, plant and equipment. Then there is another thing which needs to be understood, which is with respect to the time period of usage. Now these items should be used for more than one period. So that is how the standard defines it. It has to be used for more than one period. Now period here refers to accounting period. If you are using something within a single accounting period, then you will not classify it as property, plant and equipment. You will treat it as a revenue expenditure and you will charge it off to the income statement. But if something is being used for more than one period, then you will classify it as an item of property, plant and equipment. Now, there could be some items which are tangible and there could be some items which are intangible. Tangible meaning things which have physical substance. Intangible meaning things which do not have physical substance, right? So, intangible could cover your things around software. Tangible would be the hardware part of the computers. So, property, plant and equipment deals with only tangible items. If there is any item which is intangible, then that has to be taken to Ind AS 38, which talks about intangible assets. So broadly, what does property, plant and equipment cover? Tangible items which are used in the production or supply of goods and services, or which are used for administrative purposes or for rental purposes and are expected to be used for more than one period. So let's now have a look at the definition which is given by Ind AS 16 for property, plant and equipment. Property, plant and equipment are tangible items. So the most important term here is tangible item, and if it is an intangible item, it will be dealt by the standard on intangible assets. Tangible items that are held for use in the production or supply of goods or services. So the primary purpose of holding these tangible items is to produce goods, or is to supply goods, or is to provide services to others. Now there could be a lot of examples around this. You could look at a plant, you could look at some specific machinery, you could look at any other item which is used for production and supply of goods or services. Now one thing that you need to understand here is production or supply of goods and services, and the other aspect which is dealt by the standard, which is the administrative purposes. These two have to be distinguished. The simple reason being, production and supply of goods and services will result in some form of economic benefit to the enterprise, right? But when you look at the administrative aspects, if you look at items which are used for administrative purposes, they will not result in any form of direct economic benefit to the enterprise. And it is important for us to understand this, because when we move ahead and when we see the recognition criteria, there will be using this term economic benefit, right? So it's important for us to understand there are some items which will give us direct economic benefit, and there are some items which will give us indirect economic benefit. You cannot say that the air conditioning that is being used is not giving us any economic benefit, and hence we will not recognize it as property, plant and equipment. No, that is not how you should understand. Is it giving us some form of economic benefit? Indirectly. Is it adding to the efficiency of the employees? Is it required by the laws or regulations, right? So is it giving us some benefit? Indirectly. Even that condition being met, you will classify those items as items of PPE. So property, plant and equipment are tangible items that are held for use in production or supply of goods or services, for rental to others, we spoke about that, or for administrative purposes, and are expected to be used during more than one period. So we are looking at uses for more than one accounting period. So this is what is property, plant and equipment. Let's now have a look at the exclusions from Ind AS 16, and these are largely because they are covered specifically by other Ind AS. The first item which is excluded is PPE held for sale, right? So if any PPE is held for sale, then that is dealt by Ind AS 105 and not by Ind AS 16. The second item which is excluded is the recognition and measurement of exploration and evaluation assets as per Ind AS 106. We'll understand about these aspects specifically in those standards. The third item which is excluded is biological assets, and it is governed by Ind AS 41. But bearer plants are governed by Ind AS 16. So overall biological assets are excluded, but bearer plants are included. Now what are these biological assets? What are these bearer plants? Biological assets are nothing but living plants and animals. So you can have a tree, you can have cattle, right? These are biological assets. Biological assets are not covered under Ind AS 16 except for bearer plants. Now what are these bearer plants? For this, let us take one example. Say we have an orange tree and we have a teak tree. There is an orange tree and a teak tree. Now what is the purpose of having this orange tree? To get orange fruits, which is the agricultural produce, right, and then sell it out in the market and earn some money out of it. And this we expect to do for more than one period, right, because the tree will bear fruits year after year. So for more than one period, we will be getting agricultural produce out of this particular plant. But if you look at the teak plantation, you are not getting any fruit. The idea behind owning this teak plant is to cut the plant at a later point in time and sell it as timber or lumber or wood, whatever you call it, right? So on one side, you have a plant which will bear agricultural produce for more than one period, and the intention to hold it is to sell the fruits or to get economic benefit out of the agricultural produce. Whereas if you come to this teak plantation, the idea is to harvest the tree. The tree itself becomes the agricultural produce. The harvested tree itself becomes the agricultural produce, and you will sell that agricultural produce in the market, right? So a living plant which is used for production and supply of agricultural produce and is likely to give us agricultural produce for more than one period, and there is a very remote likelihood to sell the plant as an agricultural produce except for some scrap sales, that is called a bearer plant. I am repeating once again. This living plant is used for production and supply of agricultural produce, in our case the orange fruits. It will be producing agricultural produce for more than one period, and we will not sell this plant itself as an agricultural produce, meaning to say the intention is not to cut the tree and sell it as wood, right? So the intention here is to sell the agricultural produce. We may sell this plant as an agricultural produce only as an incidental scrap sale. For example, let's say the orange tree has outlived its age, right? At that point in time, we may definitely cut the tree and sell it as timber, but the likelihood of selling the tree itself as an agricultural produce is very remote, other than some incidental scrap sales. Maybe some branches have fallen, you can sell that part as an agricultural produce, but the primary motive is to get the agricultural produce and then sell the agricultural produce, but you are not holding it to sell the tree itself as an agricultural produce. Whereas when it comes to the teak plantation, the idea itself is to cut the tree at a later point in time and sell timber out of that, right? So this is not a bearer plant. If the plant itself is agricultural produce, that you cannot consider to be as a bearer plant. And also remember, the agricultural produce should come for more than one period. So bearer plants are included. Other than bearer plants, any other biological asset, the cattle, the other plantations which are not bearer plants, they are excluded. For example, rice plantation, the maize plantations, all of these are seasonal crops. You only get agricultural produce in one period. Those are outside the scope of Ind AS 16. Right, so this is the third exclusion that we have understood. Apart from these, some other items which are excluded from the scope of Ind AS 16 because they are dealt in by other standard. One is leases, which is covered under Ind AS 116. So as far as right of use assets coming because of leases, that has to be dealt with by Ind AS 116 and not by Ind AS 16. But again, if you have to depreciate those right of use assets, that is governed by Ind AS 16. So the other accounting aspects are governed by Ind AS 116 and aspects like depreciation are governed by Ind AS 16. Then if you have an investment property which is governed by Ind AS 40, even that is excluded from the scope of this standard. Now we need to understand this investment property slightly in detail, because if you remember the definition of PPE, we mentioned that any item which is held for rental to others, even that is an item of property, plant and equipment, and immediately now we are saying that investment property is out of scope. Now you need to understand the distinction between investment property and other items which are given on rent to others. Investment property includes only land, building or both. So it could be land, it could be building or a part of building, or both land and building. Now that is covered by investment property. But if there are any other assets which are not land, which are not building, but which you give out on rent to others, for example, if you provide cars on rent to others, so that will be a part of your property, plant and equipment. And when it comes to land, building and both, even there you have to see whether it is used in the business for supply of goods or services, or whether it is held purely for rental purposes. So what I am trying to tell here is, say there is a company whose business itself is to let out buildings. Let us say there is a company called WeWork which provides office spaces on rent to others. Now because it is used for the business, that will be governed by Ind AS 16 and not by Ind AS 40. But let us say Indigo Learn, they own a building, right? And because that building is now no longer used and we have moved to some other premises, we are giving that building out on rent to others. Now that is not covered by Ind AS 16, that will be governed by Ind AS 40 under investment property. The motive there is to earn rentals. Now we are no longer using it for the purpose of the business. We are not using it for administrative purpose, and hence we will classify it as investment property under Ind AS 41, right? So that is one more thing you need to understand. And these are accounted by using the cost model. We'll understand cost model sometime later under Ind AS 16. Now we saw certain exclusions, biological assets other than bearer plant. We saw the exclusion of exploration and evaluation assets. We saw the exclusion of mineral reserves and mineral rights and oil reserves, gas reserves and other non-regenerative resources. Now these are excluded, but if you are using any item to develop and maintain these assets and that qualifies the definition of property, plant and equipment, then such property, plant and equipment will be included. Meaning to say, biological assets are excluded, but if any item is used to develop or maintain these biological assets, let us say cattle sheds, right? Biological asset, cattle are excluded, but if you have built a cattle shed to maintain the biological asset, then that will be included under Ind AS 16. So we need to understand what are included and what are excluded from the scope of Ind AS 16. Let's take a few more examples to have more clarity on which biological assets are included and which biological assets are excluded. Say for example, an entity owns dogs. Now, are dogs biological assets? Yes, definitely they are biological assets. Now, will they be covered under Ind AS 41 or will they be covered under Ind AS 16? That is, whether you will treat it under agricultural activity or you will consider them as property, plant and equipment. Now, for this, you need to answer the question as to what is the intention to own those dogs or hold those dogs. If the intention is to rear puppies and sell the puppies in the market, that is to generate more biological assets, in that case, it will be considered as an agricultural activity and you will classify these dogs, you will treat those dogs under Ind AS 41 agriculture. But if the purpose is not to rear puppies, but the purpose of having this dog maybe for security purposes, right? Let us say they have this dog to guard their plants, for specific security purposes. In that case, it will not be considered under Ind AS 41 because owning dogs for security purpose is not an agricultural activity, and in that case dogs would be considered as property, plant and equipment under Ind AS 16. May sound slightly weird, but that is how the treatment is done. So if you look at this universe of biological assets where we said there are living animals and plants, as far as plants are concerned, if the plants are bearer plants, we took the example of orange trees or it could be a mango tree, if they are bearer plants and the motive is to produce agricultural products and sell the agricultural produce, in that case, it will be classified under Ind AS 16. But if the plants are not bearer plants, let us say the intention of owning a mango plantation is to cut the mango trees and sell the mango wood. In that case, the tree itself becomes the harvest, the tree itself becomes the agricultural produce, and such trees will not be classified as bearer plants and they would be outside the scope of Ind AS 16 and they will be treated under Ind AS 41. So, bearer plants, Ind AS 16. Non-bearer plants, Ind AS 41. Coming to the animal side, If these animals are for agricultural activity, you will treat them under Ind AS 41, you will take them to Ind AS 41, but if they are not for agricultural activity, you will treat them under Ind AS 16. So, biological assets for agricultural activity would be considered under Ind AS 41, other biological assets which are not for agricultural activity, that would be considered as a part of Ind AS 16, and bearer plants are by default considered under Ind AS 16. Now, amongst the various frameworks that we will be discussing under Ind AS 16, the first thing is recognition. When do you recognize an item as property, plant and equipment and treat it as an asset in your balance sheet? So, whenever we talk about recognition, we are talking about when do we consider an item of property, plant and equipment as an asset, and when do we show it as an asset in the balance sheet? So, if you look at the standard very clearly mentions two criteria which needs to be fulfilled for any item to be considered as an asset under property, plant and equipment. So, if you look at the standard mentions that the cost of an item of property, plant and equipment. So, the first thing is cost. If you are incurring any cost, we'll come to the definitions of cost, what is included, what is excluded at a later point. But if you are incurring any cost for an item of property, plant and equipment, that can be considered as an asset if and only if. So, there are two conditions which need to be satisfied. Conditions for what purpose? When can we treat the cost of an item of PPE as an asset? So, if these two conditions are satisfied, you will consider them as an asset. Otherwise, you will treat them as an expense in the period in which they are incurred. So, what are we trying to understand here? The cost of an item of PPE will be treated as an asset if two conditions are satisfied. And if either of those conditions are not satisfied, then you will be considering them as an expense in the period in which they are incurred. So, these conditions when they are satisfied, the item of PPE will be treated as an asset. You will show it in the balance sheet. So, first, the item has to meet the definition of PPE. Then, that particular item has to satisfy two criteria. Only then you can treat it as an item of asset. Please note, Ind AS are largely principle standards. So, they give us principles based on which we can do specific accounting. And as you go further, you understand that for any item of cost, if the conditions are satisfied, treat them as PPE. If the conditions are not satisfied, treat them as an expense. Right? So, the first condition is that it is probable that future economic benefits, again, important word, future economic benefits associated with the item will flow to the entity. So, we are talking about some benefit in the future associated with that item which will flow to the entity. Now, let's take some examples of property, plant and equipment and see if they meet these criteria or not. Say, for example, you have a manufacturing plant. Now, what will you do with the manufacturing plant? Obviously, you will manufacture goods. Those goods will be sold to the customers, and then there will be some financial inflow to the company. Right? When you sell goods to the customers, you get some economic benefit in the future. So, an item of plant and machinery which is used in a particular factory, that can be considered as property, plant and equipment, and it meets the first criteria. That is, in the future, you will get economic benefit. Or say, for example, you own an asset which you want to rent to someone. Let's say you own vehicles which you want to rent to someone. Now, you are getting economic benefit by way of rental, so they also get economic benefit. So, like this, you have to check whether a particular item is giving economic benefits or not. Now, you have some smart students. Now, they say there is this third item which is for administrative purpose. How is that going to give us economic benefit? Say, for example, I have a chair office on the asset. Now, how is that chair giving economic benefit to the company? Or how is that chair giving economic benefit to the enterprise? And how can we classify that chair as an item of property, plant and equipment? Or there is a computer which is used by accountant. How is that giving economic benefit? It is not giving revenue. But then, how can we classify those items as asset and property, plant and equipment? So, for this, we need to understand that benefits can be direct or benefits can be indirect. If I don't get a proper chair to say, I'm not working on office, right? Or if the accountant doesn't have a computer, how will you make those accounts? How will you file those returns? How will you file GST returns? How will you do customer invoicing? How will you make payments? So, you cannot just restrict yourself to direct benefits. So, direct benefits could be like something being used for production, something being used for supply services, something that you have rent to others. They will get direct benefits. But there could be other items which indirectly help the entity to get benefits. So, all of these administrative activities are indirectly supporting the other assets or other items of PPE from which we are getting economic benefits. So, not only direct benefits but also indirect benefits need to be considered. So, say for example, there is a factory and currently the height of the machine is 1 meter. So, currently there is a factory and the height of the machine is 1 meter. Because of some pollution control regulations, they say that it cannot be 1 meter, it has to be minimum 3 meters. So, what you have to do, this 1 meter you have to extend by another 2 meters. Is that giving us any economic benefit? Will it improve our factory efficiency? Will it increase our production? Definitely not. It is a legal requirement because of which we have to extend the height of the chimney. We are incurring a cost there. Now, can I say that because this particular cost of extending the chimney is not giving me economic benefit, I will not capitalize it? No, it doesn't work that way. Because if you don't have a chimney of 3 meters, your factory has to be shut down. So, the chimney is necessary for you to run the factory smoothly. Sometimes what happens is the company may incur certain cost to improvise the production process, maybe because of environmental regulations, or otherwise also they have spent some amount to improvise the production process. Now, these items of cost can be treated under property, plant and equipment because this improvisation process would have resulted in better production. So, if they are improving the efficiency, if they are enhancing the production, then such items can also be classified as property, plant and equipment. If they are not improving the production, they are not giving us better benefits, then in that case we will not classify these items as property, plant and equipment. Now, this is some principle which we have used earlier also. Does it enhance the capacity? Does it improve the efficiency? Does it give us more benefit in the future? If those conditions are satisfied, then you can treat them as property, plant and equipment. So, what we want to understand is not only directly getting economic benefits, but when an item is indirectly supporting these activities, even those can be considered as an item of property, plant and equipment, and they can be classified as an asset in the book. So, the first condition is probable that the entity will get future economic benefits associated with the particular item. Now, remember this term probable. Probable means more likely than not, or in layman terms, it can be more than 50% chance. So, if there is a more than 50% chance of getting economic benefits, then this first condition is satisfied. And the second condition, which is generally met in most of the cases, the second condition is that the cost can be measured reliably. So, you must be in a position to measure the cost of the item reliably. Now, what is cost? What are included? What are excluded? Come back after some time. But what we need to understand is this item of cost must be measured reliably. So, for example, if you purchase some item, you can measure reliably because you're paying off some amount. But if the cost cannot be measured reliably because you're not able to allocate specific items of cost, or maybe there is no cost involved, so in that case, you will not be able to call this particular item as an asset under property, plant and equipment. So, two conditions: economic benefits to flow to the entity in the future, and second condition that the cost must be measured reliably. Now, what you also need to remember is that as and when you evaluate each item, you need to check whether the item meets the definition of PPE and whether that particular item can be shown as an asset because it satisfies the recognition criteria. So, it could be any item, it could be a spare part, it could be a servicing equipment, it could be a standby equipment. For any item, you have to check does it meet the definition of PPE and does it fulfill the recognition criteria. The two recognition criteria: one, you get economic benefits in the future, and number two, the cost can be measured reliably. If these criteria are satisfied, then you will consider that an item of asset under PPE. Otherwise, you will not consider it as an item of PPE. When you talk about spare parts and standby equipment, if these meet the criteria given under Ind AS 16, you will treat them as PPE. Otherwise, you will treat them as inventory under Ind AS 2. And from inventory, obviously, they consume their expense. Now, let's take some examples. Let's say there is a factory, and the factory has two turbines to generate power. So, there are two turbines which are used to generate power for the factory. One turbine is continuously used on a daily basis, and the other turbine is a standby equipment. That is, the second turbine will be used only if the first turbine fails. Now, first turbine clearly is under operation and it will generate power, which will give us future economic benefits. That is an item of PPE. You can consider it as asset under PPE. That is very clear. Now, what about the second turbine? Can you also classify the second turbine as an asset under property, plant and equipment? The answer to that is yes. Why is that so? Because though it is directly not being used, it is required for smooth functioning of your factory. If the first turbine fails, the second turbine comes into the picture, and hence you are required to classify even this item as property, plant and equipment, and you show it as an asset in the financial statements. Right? So, this is the case of standby equipment. Similarly, you may have spare parts. For example, a spare wheel in a particular vehicle. That's spare wheel, right? So, that spare wheel also will be considered as an item of PPE because though it is not used, it is needed for smooth functioning of the other property, plant and equipment items, and hence that will also be covered under PPE. Right? So, whether it is a spare, whether it is a standby equipment, if it meets the recognition criteria, you classify them as property, plant and equipment. Otherwise, you treat them as inventory. So, sometimes what happens is there are a lot of small items which may meet the criteria of property, plant and equipment, but to account for them individually becomes difficult. For example, tools, a lot of small tools are there which meet the criteria of PPE, but it is very difficult to account for them individually. So, here, the entity can use this judgment. If items are material, they can recognize items separately as property, plant and equipment. If they are not material, they can aggregate or they can accumulate single items and then treat them as an item of property, plant and equipment. There are no hard and fast rules. The standard does not prescribe any limit of measure. Okay, this has to be considered as property, plant and equipment. This should not be considered as property, plant and equipment. There are no rules like that. If it meets the definition and the recognition criteria, you classify them as property, plant and equipment. To aggregate or to show them separately is purely upon the judgment of the entity. Now that we have understood when to initially recognize, when to recognize if it is probable that future economic benefits will flow to the entity and the cost can be measured reliably. Now we'll move on to initial measurement. We have understood initial recognition. Let us now move to initial measurement. What does measurement mean? At what value should we recognize that particular item of property, plant and equipment? And the principle laid down is very, very simple. At initial recognition, an item of property, plant and equipment should be measured at cost. So when you are accounting for an item of property, plant and equipment, when you are initially recognizing it, you will account for it as cost. Now we'll understand what is the meaning of cost and what are to be included in the cost, what are to be included in cost, what are to be excluded, what are the items to be expensed. All of those things we'll understand. So to understand the meaning of cost, let us take a few examples. Let us say I purchase a machinery. Now when I purchase a machinery, I pay 5 lakhs to the vendor. So I purchase the machinery, I paid 5 lakhs, I paid in cash. So this 5 lakhs that I paid in cash represents cost. Or let us say I didn't have 5 lakhs of cash. What I did was I gave an existing machinery and some balance amount in cash. So there is a machinery that I'm giving to the vendor, I'm paying some cash, and in return I'm getting a new machinery. That is also possible. Or in another scenario, it could be possible that I don't have sufficient money. Let's say, as a startup, I don't have huge amount in my bank. So what I tell the vendor is, you supply me that machinery, I'll issue some shares, and at a future date you'll get $1 million valuation and you'll make a lot of profit. You take the shares and give me the machinery. Right now I don't have money. Right? So what I've done, in one case I have given cash. In the second case I've given cash and some other asset as consideration. In the third case I'm issuing shares. And sometimes it may happen that I don't want to buy machinery, but I may want to construct it in-house. I may buy material, I may get some workers to work on it, I may get a designer, engineer. All of those people I'll get, and I'll get the machine constructed in-house, right? So whatever I'm paying, either in terms of cash or cash equivalents or fair value of any other consideration, or for example I'm giving some shares, all of these represent the cost of the property, plant and equipment. It need not always be share-based payment. It could be any other mode of payment which is dealt in by any other Ind AS. So if you look at the definition of cost as given in Ind AS 16, it says cost is the amount of cash or cash equivalents, the first case, which is paid, or fair value of other consideration given. So if you have not given cash or cash equivalent, you have given some other consideration, you have to determine the fair value of that at the time of its acquisition or construction. So when you are acquiring that asset, what is that you are paying? See, there are elements of taxes, there are elements of discounts, all of that will come to it later. I'm just giving you a basic understanding of what is the cost. Or where applicable, the amount attributed to that asset when initially recognized in accordance with specific requirement of other Ind AS. So for example, I'm issuing shares, right? It is covered by share-based payment in Ind AS 1 or 2. Now the way it gives us the treatment for this particular transaction, we will recognize that amount as cost. Now we'll understand that aspect when we reach 1 or 2. But for now, just understand that cash, cash equivalents, fair value of any other form of consideration, or if some other Ind AS has given some specific treatment, what is that amount coming to? These aspects are considered to be cost. And an item of property, plant and equipment at initial recognition will be recognized at cost. Now ignore the second and third example. Let's take the first example only, where I have paid 5 lakhs to a vendor to supply a machinery. Do you think 5 lakhs is the only amount? I just gave an amount. But then there could be aspects around taxes, right? I would be required to pay some taxes. Then there would be amount that I'll be incurring to get that machine from the vendor location to my location. Maybe I'll require to install the machine at my premises, for which I'll have to pay. So not only the price of the machine, if there are any taxes to be paid, that will be considered as cost. If there is any transportation paid, if any freight is paid, that will be considered as cost. If there is any loading, unloading, installation, all of these items will form part of cost. So what you need to remember is any cost which is incurred for property, plant and equipment, which is directly attributable to a property, plant and equipment, and is incurred to bring that particular property, plant and equipment in the location and condition which is intended by the management. Whatever cost you are incurring, all the cost will form part of property, plant and equipment. So what do I mean by that? Let us say that particular vendor is in Delhi, I'm in Hyderabad. Now where do I want that particular machinery? I want that machinery at one of my factories in Hyderabad. So what has to be included? The cost that I'm paying to the vendor, that will be included. Let's say that is 5 lakhs. Then let us say that particular vendor incurred 2,000 to load that machine, transport that machine to the nearest railway station. So that 2,000 also will add. Then railway charge, let us say 5,000 to transport that machine from New Delhi railway station to Secunderabad railway station. So that also will be added. So we have added 2,000, we have added 5,000. Then I incur 2,000 to unload that machine. So I'll also add the 2,000 rupees of unloading charges. Then I have to move that machine from Secunderabad railway station to my, let's say, factory which is some 15 kilometers away. For that I paid another 5,000. Then I paid another 10,000 for installation. Now my intention was to get it installed at my factory, right? So till the time that machine reaches that condition, all the costs which are directly attributable to that particular item will be considered as a part of cost. It could be insurance, it could be any other transit cost, it could be any octroi, it could be any taxes, anything and everything that is paid to ensure that that item of property, plant and equipment reaches the condition and location which is intended by the management. So what did the management think of? The management thought that they will install that machine at a specific factory in Hyderabad. So till the time the machine reaches the factory, all the costs will be included and will be treated as cost of property, plant and equipment. Now let's discuss payment towards taxes. So let us say the price of the machine is 5 lakhs and applicable rate of GST, because it is an interstate supply, IGST, 18% on 5 lakhs to be paid. So 18% on 5 lakhs comes to 90,000. So I have to not only pay 5 lakhs of that machine cost and all other costs that I have discussed, I also need to pay 90,000 towards IGST. Now should this 90,000 form part of cost? Now this 90,000 will not form part of cost if I am able to take benefit of this particular IGST paid. Now what is the benefit I'll get? I paid 90,000 as IGST, I will take input tax credit. You have learned it in GST, right? You will take input tax credit and I'll set off this input tax credit against my output tax liability. So if that particular tax is refundable, right, because I paid IGST to the vendor, that 90,000 is indirectly being given as a refund to me because I'm adjusting that 90,000 against my output GST liability. So if any duty or taxes is refundable, in other words, if you can claim input or if you get some form of benefit out of that, then such taxes are excluded. So that particular IGST will be excluded while arriving at the cost of the property, plant and equipment. If it was non-refundable, so what are the duties which are non-refundable? Say you paid import duty. You imported some machine from China and you paid import duty. So is that import duty refundable? Maybe refundable, may not be refundable. If it is refundable, you will not consider it as a part of cost. If it is non-refundable, then you will treat it as an item of cost. So any duties or any taxes which are non-refundable will always form part of cost of the property, plant and equipment. Now let's assume that particular vendor has given me a discount of 50,000. Okay, after charging GST, then he says, oh, you pay me 50,000 less. GST is 90,000. I'm not getting into complication of taxable value will change and then GST will change. For our understanding, the discount given is 50,000. Now if any discounts are given at the time of purchase, such discounts will be reduced or such discounts will be adjusted against the cost of the machine. Now if you look at this explanation, this looks similar to the components of cost that we have discussed when we were discussing inventory. Almost similar treatment. You will include all the cost, you will reduce any refundable tax. So what we will do, we will consider the purchase price, we will consider all non-refundable taxes, we will reduce any discount, and we will include all costs which are directly attributable to bring that item to the condition and location as intended by the management. You should also remember that it is not enough that you bring it to the location and condition. It should be in an operating condition as intended by the management. So let us say you bring that machine, you bring it to the factory location, you install it, and then you may have to do some trial runs before the machine can actually be used properly or machine can actually be put to use. So all the costs incurred to bring it in an operating condition as intended by the management will be forming part of the cost of property, plant and equipment. So what does cost cost comprise? Cost of an item of property, plant and equipment comprises of number 1, its purchase price, including import duties and non-refundable purchase taxes after deducting any credit discounts and rebates. So that is the first item. Second, any cost directly attributable to bringing the asset to the location and condition necessary for it to be capable of operating in the manner intended by management. So these are the first two items of cost, and I am giving more emphasis here because a lot of times the examination question asks you to calculate the cost of property, plant and equipment to be recognized as an asset. So in that case, you must be sure of as to what is to be included and what is to be excluded. And the third component of cost is any cost incurred to dismantle that particular item of property, plant and equipment, or to restore the site, or decommissioning the plant. So basically we refer to as decommissioning and site restoration and similar liabilities. Now the accounting of this is given by Ind AS 37, which deals with these kind of provisions, but we need to understand what are these costs and why are we including this cost as a part of cost of property, plant and equipment. So we are purchasing a property, plant and equipment, let us say today year 1 at 5 lakhs. Okay, forget all discounts and transportation costs and all those things. 5 lakhs is the cost. What we are saying is this machine will last for 5 years. So from year 1 to year 5 we will use that machine, and if any cost of dismantling is to be incurred on this machine at the end of 5 years, even that has to be included in the cost of that property, plant and equipment. So the dismantling cost to be incurred in the future or site restoration cost to be incurred in the future also needs to be included in the cost of property, plant and equipment. Now in many cases it may not be significant, but in some specific industries this is a significant cost. Say for example you build an oil refinery, right, and you have a specific contract with that local state government which says that you can run that particular refinery for 30 years. After 30 years you have to dismantle the plant, you have to restore the site in good condition. So there is some cost which we incur today which we know we are incurring for property, plant and equipment, and we are capitalizing it as an asset in our balance sheet. But what we are also saying is that future cost that you are incurring, even that you need to account for it today. Now you may have a doubt, why should we account for a cost which we will be incurring in the future today? Now for this we need to refer to Ind AS 37. To give you a brief perspective, and you have also learned it as a part of AS 29 when you learn about provision. What it essentially means is that future cost which we will be incurring is because of an event which has already happened today. Now what is the event that has happened today? We have built a factory. Now that factory has to be dismantled after some years. Now the future cost is because there is some past event which has created that obligation, and hence you need to create a provision for that, and for which you need to create a provision and correspondingly add to the cost of that asset. Now if you just zoom out from all of this discussion, it is also important to understand that sometimes those decommissioning costs may be very high. Say the original cost of the plant, for example in our case, is 5 lakhs. After 5 years we will incur some 3 lakhs on decommissioning or dismantling. Now don't you think that the users of the financial statement must be aware that there is not only this initial cost of 5 lakhs, there is this terminal cost of 3 lakhs which the company will be incurring. Now look at the significance of this cost. 5 lakhs here and 3 lakhs there. So even the 3 lakhs is significant, and you are incurring that because you bought an item of property, plant and equipment, and hence it is logical to include that cost even to the cost of property, plant and equipment. So any dismantling cost, any decommissioning cost, any site restoration cost which are incurred because of this particular item of property, plant and equipment, that will also be considered as cost of the property, plant and equipment. But one thing that you need to keep in mind is you are paying, or you are expecting that you will pay 3 lakhs after 5 years. You are expecting that you will pay 3 lakhs after 5 years. Now 3 lakhs after 5 years is not equal to 3 lakhs today. So what we will do is we will discount this 3 lakhs at an appropriate discount rate and bring it to the present value. Okay. Now with this understanding, let us see how we will capitalize each of these items using some numbers and show them as cost of property, plant and equipment in the books of accounts. Now what we'll do is we'll use some numbers and understand how this cost is calculated, and also understand this aspect around decommissioning cost. Again, we will be revisiting decommissioning cost when we come to Ind AS 37, but for now let's have a broad understanding. So let us say, the same example that we are talking about, let us say the base price or the purchase price of that particular machine that we are buying, and it has a life of, let us say, 5 years. That is, we are expecting that we'll use it over a period of 5 years is 5 lakhs. So purchase price 5 lakhs. Okay. Then what the vendor does is, the vendor says we need to pay IGST at the rate of 18%. So IGST at the rate of 18%. Now this 18% of tax that you have paid, it is refundable. The GST that you have paid is refundable. So you would say 500,000 into 18%, which is 90,000. And the total comes to 5 lakhs plus 90,000, 5 lakh 90,000. And on this, he gives us a discount of 50,000. Okay, 5 lakh 90 minus 50, the purchase price after tax and discounts comes to 590 minus 50, 540. But is this the cost to be considered? No, this is 540 that we are paying to the supplier. Now what will be included and what will be excluded, we'll just mark it in this column. So cost of PPE, we'll mark it here. 5 lakh, yes, it forms part of cost. This 90,000 will not form part of cost because it is refundable. Because it is refundable, we'll not consider it to be a part of our cost. Then what will be the total? Total will be 5 lakhs. And from this 5 lakhs, we have to reduce the discount that we are getting, which is 50,000. So our purchase price after tax and discount, as far as cost is concerned, will be 4,50,000. Then let us say there is a loading and unloading charge of 5,000. Loading and unloading, including what the supplier paid and what I have paid, 5,000. This will be added. Then you have freight, which is the transportation cost of 10,000. This also will be adding. Then installation cost. Let us say the installation cost works out to 20,000. Okay. So after doing all of this, what is my total cost? Total cost of PPE is 450 plus 5,000 plus 10,000 plus 20,000. So it comes to 4,85,000. Now, what the standard also says is, these are all your costs which are incurring initially. You also need to add the costs which are related to dismantling and decommissioning. So at the end of year 5, for example, you have to spend 3 lakhs. So cost of dismantling and restoration after 5 years is, let us say, 3 lakhs. Okay. Now this 3 lakhs which you will be incurring after 5 years, you have to discount it and bring it to the present value. Now let's say the rate of discount is 10% for ease of calculation. So we have to calculate what is the present value of decommissioning cost, right? At what rate? At 10%. So I'll just mention it here. At 10% per annum. So how do you do that? We all know the formula. Present value is future value divided by 1 plus r to the power of n. So which is equal to 3 lakhs divided by 1 plus 10% to the power of n, to the power of n here represents 5. So the present value of decommissioning, dismantling, restoration expense comes to 186,276. This will also be added to the cost of property, plant and equipment. Please note that. Okay. So it will be 186,276. Now how will we pass the journal entry? It's important for us to understand how do we do the accounting, right? So when you come to journal entry, we have property, plant and equipment, property, plant and equipment, how much will we debit property, plant and equipment by? So you have to see what is the total cost of PPE, which is nothing but 485 here plus 186,276 here, which is 671,276. So property, plant and equipment you will debit by 671,276, which is the total cost incurred plus future estimated decommissioning cost. And so this is debit. What will you credit? You will credit. Let us say you have paid all of this in cash. Okay, cash means cash or bank. You have paid the supplier 540, the total amount, and you also paid all of this transportation cost. So if you look at the total payment comes to. So if you look at the total payment comes to 575. Okay, so you have paid total 575. So we'll say to cash or bank, whatever it is, credit. How much is that? 575. Okay, now we have capitalized out of this 575, 485 has been capitalized as property, plant and equipment. The balance 90,000 that we have paid is a IGST input, which we will get refund, right? So what we'll do is we'll debit that to IGST input account, debit 90,000, right? So if you see the total of debit here, total of debit comes to 761,276 and total of credit comes to 575. There is some difference. Now what is the difference? Please note, we have taken 186,276 as the present value of decommissioning cost. So for that we need to create a provision. So to provision for decommissioning credit, how much is that? 186,276, right? So like this, you will pass the capitalization entry. Now when we say capitalization, what are we doing? All these costs that we have incurred, we are showing them as an asset under property, plant and equipment. So PPE has been, the cost has been treated as an asset, right? Now what do we do for depreciation and all? We'll come to it later. But one thing that we need to understand is this 186,276, which is the provision for decommissioning. The final amount that we will pay will be 3 lakhs, correct? Now how will this 186 become 3 lakhs? What you do is this every year on this 186,276, you will charge interest. In our case, interest is 10%. So 186,276 into 10% comes to 18,628. So 186,276 plus 18,628, 204,904. Then this becomes opening balance for year 2. Again, interest 10%, closing balance becomes 225. So if you prepare a schedule like this, you see that as you keep on adding interest year on year, the ending balance becomes 3 lakhs and ultimately you will pay 3 lakhs to the vendor, whoever is doing the dismantling. There could be changes in estimation and all of that, will deal separately. But for now, assume that 3 lakhs was the cost and 3 lakhs is what has been paid after 5 years. So every year, you will charge this interest expense. So what you do is, you say interest cost, let us say in year 1, debit 18,628 to provision for decommissioning credit, which is 18,628. So what you have done from 186,276, you have added another item of 18,628. Like this, when you add all of these items, the ultimate balance becomes 3 lakhs, and when you actually pay off, you will debit this provision for decommissioning account and you will credit cash, right? This is the third item which is included as a part of cost of property, plant and equipment. So first was the purchase price, net of any discount and taxes. Then we had other costs. Then thirdly, we have this decommissioning and site restoration and related costs. So if you look at the third item of cost, which says the initial estimate of the cost of dismantling and removing the item and restoring the site on which it is located. So we may not know the exact amount. What we will do, we will calculate or we will arrive at an initial estimate based on the market conditions, based on the market situations. We will try to arrive at what is the estimate of those costs. The obligation for which an entity incurs either when the item is acquired or as a consequence of having used that item during a particular period. The obligation for which an entity incurs either when the item is acquired or as a consequence of using or as a consequence of having used that item during a particular period. Now what does this mean? This means that the dismantling or decommissioning cost, it has to be an obligation either when you have acquired. So when you have acquired that plant or when you have installed that plant, at that point of time itself, you have incurred that obligation or you know that you have to incur those dismantling and site restoration costs. So that is first thing. Or during the usage, you create that particular obligation. That obligation came to you as you were using that particular plant and machinery or item of property, plant and equipment, right? So obligation, an entity incurs either when the item is acquired or as a consequence of having used the item during a particular period for purposes other than to produce inventories during that period. So if those obligations are incurred for producing inventories, then you will take them to Ind AS 2. You will not bring them within the purview of Ind AS 16. But because you have acquired that plant, or because you have used that plant and for which there is an obligation to restore the site, dismantle or decommissioning that site, then the cost, the estimated cost will be treated as a cost of property, plant and equipment. How will you arrive at the cost which is to be added? It will be as per Ind AS 37, which talks about discounting the future obligation. So whatever is the future obligation, you discount it and you bring it to the present value and then add it to the cost of property, plant and equipment. Now we've discussed about directly attributable costs. Now what could these costs be? What are the various costs which could be included as a part of this directly attributable cost? One could be employee benefit expense, which is arising either because of acquisition or construction of PPE. So let us say for installation purpose, you have not got some outside vendor, but you have used your in-house staff to install a particular machine. So in that case, to the extent of the installation, whatever is the employee benefit expense, that will be treated as the cost of property, plant and equipment. Then there could be cost of site preparation. The site may not be even, that you have to do some kind of clearing of the site, or you have to maybe put some structures at the site. That will be considered as a directly attributable cost. Then we have discussed about delivery cost and handling cost. Then we also discussed about installation and assembly costs. Then there could be some cost of testing. So what we may do is, before making that plant fully operational as intended by the management, we may be needed to do some test runs, right? If any cost is being incurred to do some test runs, even those will be considered as directly attributable cost. Now one thing that you need to keep in mind when you're doing a test run, there may be some output which is sold, right? So if you're getting some proceeds, that proceeds have to be deducted from the cost of test run. So these are some examples of directly attributable costs. So some costs are specifically excluded or are not considered as a part of directly attributable cost, or they are not considered to be cost of property, plant and equipment. For example, if you want to start a business in a new location and for which you're carrying out some staff training. Now such costs which are cost of conducting a business, those are not costs to create an item of property, plant and equipment, but because you're conducting business maybe with a new customer or maybe conducting a business in a new location for which you're training the staff, such costs are not considered to be cost of property, plant and equipment. So if you're building a new showroom, the cost of showroom will be a part of property, plant and equipment. The cost will be considered as property, plant and equipment. But if you're training staff for doing the business, at that point that cost will not be considered as cost of PPE. Then if you're incurring some cost to introduce a new product or service, maybe you're doing some marketing campaigns and are introducing a new product or service, even that will not be considered as PPE cost. Similarly, cost of opening new facility and administrative and other general overhead costs. So let us say the cost of electricity, cost of maintaining the office, let us say cost of security, cost incurred in corporate office buildings. All of these costs are not considered to be cost of property, plant and equipment. These are day-to-day expenses which are incurred and they are charged against the income for the particular period. So any cost which is not directly attributable to a property, plant and equipment will be excluded. Now let's discuss some more aspects around this cost. We have seen a case where we have purchased a machinery and we have seen how do we calculate the initial cost. But what if the machinery is not purchased but it is built in-house? We refer to these as self-constructed asset. Now this self-constructed asset also can be of two categories. One, we have got the material, we have got the engineers and we have got the workers, we have built that particular item in-house. Maybe we have built a plant, we have built a building, right? We have done it on our own. That is one case. And the other case could be we generally manufacture those items for sale. Say for example, we manufacture cars and we sell those cars. One of those cars we are using as an item of PPE. So one is an independent construction activity. The other one is you are using some item out of inventory as property, plant and equipment. See, whatever you are selling, that forms part of inventory. But if you are using it for the purpose of business, if it meets the PPE criteria, you classify them as property, plant and equipment. Now the question here is, how do we arrive at these costs? So the principles broadly remain same. We have discussed this in Ind AS 2 also, and also applying the principles of Ind AS 16 which we have just discussed for purchase machinery. Same principle applies here. All the costs which are incurred to bring that particular item of PPE to its current condition, location for operation as intended by the management, whatever are the costs, all of them will be included, and that cost will be capitalized as property, plant and equipment. So it could be material, it could be labor, it could be designer, it could be consultancy, it could be transport, anything, whatever is used to construct that particular property, plant and equipment, or build that particular plant and equipment, everything will be capitalized. Same thing if it is an item of inventory which you are using for the purpose of business, which you are classifying as property, plant and equipment, whatever is the cost incurred, the entire cost will be considered as cost of PPE. So please note, if you are selling that inventory, you will sell it at a higher price. Maybe you are the car at 5 lakhs, but the cost of the company is only 4 lakhs. So you only take 4 lakhs as cost of property, plant and equipment. You will not take any profit. You will eliminate any unrealized profit while capitalizing the cost of property, plant and equipment. And like we have discussed in Ind AS 2, any items of abnormal basis of material, any amount of abnormal losses, if at all they are incurred, they are also eliminated. They are not considered to be cost of property, plant and equipment. So these costing principles, the principle to calculate the cost are pretty similar as compared to Ind AS 2 and Ind AS 16. Now there is also a component of borrowing cost which we will be discussing separately in Ind AS 23. Apart from this, borrowing cost also forms part of the cost of property, plant and equipment as prescribed by Ind AS 23. So when you go in Ind AS 23, they will understand how to capitalize, how much to capitalize, when to start capitalization, when to stop capitalization, all of those aspects are covered in Ind AS 23. So even borrowing costs form part of cost of property, plant and equipment. And like we discussed was beer plant. How do we calculate the cost of beer plant? Now the principles are same as we have applied for self-constructed assets. All the costs which are incurred to bring that beer plant to its current condition and location and to be operated in the manner which is intended by the management, whatever costs have been incurred, all the costs should be capitalized as the cost of beer plant. Now whenever we are referring to the term self-constructed asset, also refers to the term of bringing up a beer plant. Whatever costs have been incurred to bring up a beer plant, even those costs will be capitalized. Now let's understand how do we deal with costs related to incidental operations or income coming from incidental operations. Now incidental operation means those operations which are not necessary to bring the item of PPE to its current condition and location for operation as intended by management. So what do I mean by that? Even without those activities, you will be able to construct the property, plant and equipment. Even without those activities, you will be able to get the property, plant and equipment to the condition and location as intended by the management. And if such activities being carried out, any cost related to those activities will not be added to the item of property, plant and equipment. So for example, if let's say a company has purchased a land to construct a building on it, until the land building is constructed, it is being used as a parking space, and they have let out that parking space on rent to somebody. Whatever income that has arisen out of this parking activity, that will not consider, that will not be adjusted against the cost of property, plant and equipment. Similarly, if a cost is being incurred to run that particular facility as a parking facility, even those costs will not be added to the cost of property, plant and equipment. Why? Because it is not a necessary activity to bring the item of PPE to its current condition and location. So if there are any incidental operations which are not related to the item of property, plant and equipment, you will ignore both the cost as well as the incidental income. You will directly take them as income to your statement of profit and loss. Now let's talk about cessation of capitalization. What do we mean by cessation? Cessation means stopping. Now capitalization means that the cost that is incurred on the item of property, plant and equipment, it is shown as an asset in the balance sheet. When do we stop capitalizing this cost? Once the asset is ready for its intended use in the condition, in the location as intended by the management. So once it is operational, once it is fully functional, once it is ready for its intended use, then you will not capitalize any further amounts on that. Right? You may capitalize subsequent expenditure if it meets the condition criteria, which you will understand separately. But at the initial measurement phase, once it is operational, once it has reached that particular condition and location, then you will not capitalize any further amount. What will you do with any further cost incurred? You will treat it as an expense in the statement of profit and loss. Right? So say for example, we brought that machine, we put it into a plant in Hyderabad, then we shifted that machinery from one plant to another plant. Or within the same plant, we have shifted it for some operational reasons, right? Such costs cannot be added to the cost of property, plant and equipment. These costs have to be expensed. So any costs which are incurred after the machine is let's say ready for its intended use, you will not be capitalizing those costs. Let's have a look at some of the costs which are not capitalized but are expensed. And the reason is that the item of PPE is ready for its intended use. Say for example, we got the machinery, we installed it, but we are not using it. We are not using it, but it is ready for its intended use. Now during that period, we may be incurring some insurance cost. Will we capitalize the insurance cost because the machine has not started its operation? No, we cannot capitalize that. Once it is ready for use, then any other expenditure after that, you will treat it as an expense in the financial statement. Right? Similarly, there could be a case that in the initial phases there are huge operating losses because the demand in the market has not picked up. Right? You are not able to sell fully. You are giving huge discounts to the customers. Now, the operating losses also you cannot capitalize as the cost of property, plant and equipment. Or let's say you are reorganizing your operations, you have shifted the machinery. All of these costs are revenue expenses, and you will not treat it as a cost of property, plant and equipment. Right? Let's now look at an example and understand which costs can be capitalized and which cannot be capitalized. Moving ahead, because the following costs in relation to the construction of new factory and introduction of product to the market, you are required to calculate the amount which can be capitalized as per Ind AS 16. Now, first item, all at once are in houses. First item, site preparation cost 150. Now, what is the site preparation cost? Before you build the plant, you have to clear the site, you have to level the site. Is it incurred in relation to the construction of the plant? Yes. So you will capitalize, and that one gets capitalized. Then direct material 2000, it is for the construction of the plant, so you will capitalize that 2000. Then you have direct labor cost 1160, and out of this 10 is towards cost incurred during industrial site. Now, if you go back and remember, any abnormal loss will be excluded. So out of this 1160, you capitalize only 1150, and 10 will be shown as expense in the statement of profit and loss. Then you have testing of various processes in the factory. You understood that any testing work is carried out, any cost is being incurred for testing, then those costs will be capitalized. Then consulting fees for installation, again related to the construction of plant, which will be capitalized. So 300 will be capitalized towards consulting fees. Relocation of staff to new factory. So you are moving staff from one factory to another factory. Now, is it necessary to move the staff to construct a factory? The answer is no. So this cost is not related to the item of property, plant and equipment, and hence this cannot be capitalized. So this 450 will be expense. General overhead 550, again, if it is not related to the item of property, plant and equipment, it will be expense. And estimated cost to dismantle at present value. Remember the third item, the decommissioning cost, that will be added to the cost of property, plant and equipment. So this 200 will be a cost which will be added to the cost of plant. Right? So all this will be total, it comes to 4000. Right? So in examination, what you need to do is you need to explain which cost can be recognized, and then for each item, why have you not recognized that particular cost? You need to give an explanation. So let's have a look at one illustration. On 1st April of year 1, XYZ Limited acquired a machine under the following terms. List price of the machine 80 lakhs, import duty 5 lakhs, delivery fees 1 lakh, electrical installation cost 10 lakhs, pre-production testing 4 lakhs, and a purchase of a 5-year maintenance contract with the vendor 7 lakhs. In addition to above, XYZ Limited was granted a trade discount of 10% on the initial list price, so that is on the first item, and a settlement discount of 5% if payment of the machine was made within 1 month of purchase. So when was the machine purchased? In this case, the machine was purchased on 1st April, and the vendor says if you pay within 30 days, within 1 month that is, you will get an additional discount of 5%. Now friends, you would have understood this at your earlier levels as well, that there is something called a trade discount and there is something called a cash discount. Now trade discount is basically given at the time of purchase itself. It is negotiated at the time of purchase. So the first discount, which is the trade discount of 10%, that we will adjust from the cost of the machine. But the second aspect, which is you will get a 5% discount if you pay within 1 month. Now this is the cash discount. This is a discount for prompt payment, and this is not related to the item of property, plant and equipment, and hence that discount will not be considered. So you can keep this one in mind. Trade discount you will reduce, cash discount you will not reduce. XYZ paid for the plant on 20th of April of year 1. At what cost will the asset be recognized? So pretty simple and straightforward. Just two special points here. One, the purchase of a 5-year maintenance contract. Now we need to understand, is this maintenance contract required to bring the item of PPE to its current condition and location? If the answer is yes, it will form part of the cost. If the answer is no, it will not form part of the cost. By looking at the term itself, we can see that it's a maintenance contract. So if any cost is incurred for day-to-day repairs or maintenance, that we will not capitalize with the asset, right? So this maintenance contract will be excluded from the cost of PPE. We'll have more discussion on this slightly later as to what kind of cost can be included, what kind of cost cannot be included. But if it is a day-to-day maintenance contract, that will not be included in the cost of PPE. So now, like we did in our earlier example, let us list down all the items of cost, and whatever items are to be included will include, and whatever items are to be excluded will exclude those particular items, right? So the first item is list price of the machine, and the amount given is 80 lakhs. So list price, which is 80 lakhs. Okay, to save time, you can use in lakhs as well in the examination because almost all the numbers are given in lakhs. So list price is 80 lakhs. On this, we have got a trade discount of how much? 10%. So we'll reduce that. Less 10% trade discount, which is nothing but 80 lakhs into 10%, which comes to 8 lakhs. So I'll just denote it as a negative number. So 80 lakhs minus 8 lakhs. So the adjusted list price comes to 72 lakhs. On this, we'll have to add. Why do we add import duty? Because it is incurred to bring the machinery to the current location. So import duty will be added, which is 5 lakhs. Then the next item is delivery charges. We know transport and delivery charges will be added. Delivery fees of 1 lakh. Then the next item is electrical installation cost. Any cost which you incur for installation, even that needs to be added. Electrical installation cost of 10 lakhs. Then pre-production testing. Now we have understood that if you incur any cost for testing purpose before the machinery is fully ready for its intended use, if you are doing any testing, even the cost of that will be added. So testing will also be added. This pre-production testing, 400,000 or 4 lakhs. And purchase of a 5-year maintenance contract. So this purchase of a 5-year maintenance contract is towards day-to-day repairs and maintenance, and that will not form part of your cost of property, plant and equipment. So what will you do with the 7 lakhs that has been spent? That will be taken as an expense in the profit and loss account. Now the 7 lakhs will not be the expense of one single year. It will be for 5 years because it's a 5 years annual maintenance contract. So over a period of 5 years, you will charge 1,40,000 every year to the P&L account, right? So where will the balance be reflected? The balance will be reflected as a prepaid expense. So 5-year maintenance contract will not be included in the cost of PPE. The question also says that the entity is eligible for 5% cash discount. That will also not be adjusted from the cost of PPE. That will be shown as an item of other income in the statement of profit and loss. So these are the items which will be considered to calculate the cost of PPE. So let us see what is the cost comes to. Total cost comes to 72 lakhs plus 5, 17, 7, 78, 88 and 4, 92 lakhs. So the cost of PPE, the total cost of PPE comes to 92 lakhs. Now what all did we not include? We did not include maintenance contract, right? Maintenance contract is in the nature of day-to-day repairs. It will not form part of cost of PPE, right? So maintenance contract is in the nature of day-to-day repairs and maintenance, and it will not form part of cost of PPE. Now there are some types of cost which will be included, about which we will discuss after some time. Then second thing is cash discount of 5% is other income and not adjusted against cost of PPE. So these two notes you can write in the examination, and then that is sufficient. Let's now understand how does deferred payment impact the recognition of an item of property, plant and equipment. Say for example, you want to purchase a machinery. The vendor gives you one rate, that is, if you pay upfront, the vendor will supply the machinery to you at 9,50,000. Okay, maybe the listed price is 10 lakhs, whatever is the number. If you buy today and pay the entire amount today, you will get that particular machinery at 9,50,000. Or you can pay it in 3 installments, and if you do that, you have to pay 3,33,333 in 3 installments. First installment today, let us assume it is 1st of April of year 1. Second installment by 31st of March of year 2, and the third installment by 31st of March of year 3. That is first financial year and second financial year. Now what is happening here? If you pay upfront, you have to pay 9,50,000. If you pay over a period of 2 years in 3 installments, and the installments can be any, it can be 3 installments over 3 years, it can be structured in any way. But for our example, if you are paying in 3 installments, the total outflow is 10 lakhs. Now the question here is, should you capitalize 10 lakhs or should you capitalize 9,50,000 in the books of account? So what the standard prescribes is, you need to find out what is the implicit rate of return in this transaction. Now by implicit rate of return, what do I mean? The rate at which when you discount this 3,33,333, the present value becomes 9,50,000. In other words, you are computing the IRR. So the question here is, what is the IRR of this transaction? Use that rate of return, discount all of these payments to the present value, and account for the property, plant and equipment at the present value, which in our case is 9,50,000. We will see what is the implicit rate of return, what happens when we discount that, and then how do we do the accounting, that we'll understand. But all these future payments that you are doing, you need to discount that at a rate which will bring all of these future value to the present value of cash price, which is 9,50,000, right? So that is what you need to do, arrive at the implicit rate of return and do the accounting. Now the difference between the total outflow, that is 10 lakhs, and the cash price, which is 9,50,000, this difference of 50,000 is treated as interest expense. Now again, if this interest expense qualifies as borrowing cost which can be capitalized as per Ind AS 23, you can very well go ahead and capitalize. But if it does not meet the capitalization criteria as per Ind AS 23, you will expense that in the statement of profit and loss. So let us look at the computation, what we have done, and see how do we do the accounting. So now in the given case, what's happening? The cash price or the amount that you need to pay upfront is 9,50,000. So if you pay to the vendor 9,50,000, you can collect the machinery, and in that case, you will be debiting the property, plant and equipment by 9,50,000, or you will be capitalizing 9,50,000 and you will be crediting bank. But what's happening here? You're not paying everything upfront. What you're doing is, against this 9,50,000 of machine that you have got, on the first day, that is 1st of April, you are paying 3,33,333. I'm using 334 just to make the total to 10 lakhs. Otherwise, you can use 3,33,333 also. That is, you are paying on the same day, 1st of April, and on 31st of March of year 2, you are paying 3,33,333, and on 31st of March of year 3, you are paying 3,33,333. Now, what you need to do is to capitalize this. See, we know that we will have to capitalize the machine at the cash price. We cannot say that because we are paying a total of 10 lakhs over 3 installments, we will capitalize the property, plant and equipment by 10 lakhs. No, that is not correct, because there is an element of financing. There is an element of financing involved. So we need to identify what is that interest component. So you cannot say that because I am paying the supplier 10 lakhs over a period of 2 years, I will capitalize the property, plant and equipment by 10 lakhs. No, that is not correct. You have to calculate what is the implicit rate of return here, and you will capitalize the item of property, plant and equipment at the equivalent cash price, or in other words, the present value of whatever you will be paying in the future. So now you can compute IRR by trial and error method. You have learned that financial management, or in most of the cases, this IRR will be given in the examination. I'm not spending time on that. So here you see that what is IRR, you can use the formula in Excel, X IRR, you can select all the values and you can select all the dates. The IRR comes to 5.369%. You can take it rounded up to 5.37% as well, or you can use 5.369%. Minor rounding of differences are allowed. Now what does this mean? This means that at an interest rate of 5.369%, the three payments that you will be doing, the present value of those payments will be equal to 9,50,000. So though you are paying 10 lakhs, the present value is 9,50,000, and the difference of 50,000 will be recognized as an interest expense. Now sometimes in the examination, what they can do is, they will simply give you these three amounts, and they will say that implicit rate of return is 5.369%. What happens? They will say that the amount is 3,33,333 per year or per installment, and the discounting factor or the implicit rate of return is 5.369% or 5.367%. Okay, so if that is the case, then what we need to do is, we need to discount this payment, arrive at the present value, and recognize the item of plant and machinery at that particular plant and machinery or item of PPE. So if let us say the question mentions, let us see the sign, so it is easy for you to understand. So on each of these dates, you are expected to pay these are the payments, and the implicit rate of return is 5.369%. Now we need to calculate, we need to have the discounting factor, because we need to discount these future payments and arrive at the present value. So what is the discounting factor? This is present value factor at what? At 5.369%. Okay, so we need to calculate the present value factor at 5.369%. You calculate simply 1 divided by 1 plus r, you can get the answer. So in this case, you do 1 divided by 1.0539, press equal to 1 time, you will get the end of the first year, press equal to 1 more time, you get the end of the second year. Now please be careful with the dates. The first date is 1st April of year 1, that is today. Now any payment that you make today, the present value factor is 1, so this will be 1. At the end of the first year, it will be 1 divided by 1 plus 5.369%. You calculate 1 divided by 1.0539 and press is equal to. So you get 0.9490. Press equal to 1 more time, you will get this divided by 1 plus 5.369%. 0.9490 divided by 1.5069, you get 0.90. So these are the present value factors. Now we need to calculate the present value. So 3,33,333 multiplied by 1, and second case 3,33,333 multiplied by 0.9490, you get 3,164, and this one you get 3,129. What is the sum of these? So the sum of present value comes to 9,49,912, which is approximately equal to 9,50,000. The reason for difference is extra actually number of days. So if I change this to 31st of March of year 1, and this also 31st of March of year 1, then you get exactly 9,50,000, and the rate comes to 5.359%, which is equal to 5.36%. That is how Excel calculates, right? So if you're taking 1st April, you have to take 31st March, which represents the end of the beginning of the first year, that is 1st April, then you get 9,50,000, right? So you need not worry about the minor differences of what happened if you use 950 or what happened if you use 940, or what happened if you use the number 949,912. It's by law, it's perfectly fine. Now based on that, you have to pass the interest. But before that, we'll prepare a loan schedule and understand how do we calculate the interest, how much amount will be paid, and ultimately how do we pass the journal entries. Now coming to loan schedule, let us say look at the opening balance, interest, payment, and closing balance. So we need to know the dates, the opening balance, interest, payment, and closing balance, right? So let's say 1st of April, that's the first date. What is the opening balance? Opening balance is 949,912. Now please note, on 1st April itself, we have paid the first installment of 3,33,333. So reduce it from this total present value. So the opening balance comes to 616,578. On this, we'll provide interest at 5.369%. 5.369%. Amount paid at the end of the first year is 333,333. Closing balance is opening balance plus interest minus payment, you get closing balance of 316,348. Then in the next year, so this payment is happening at the end of the year. This is on 31st of March. Okay. So in the next financial year, 1st of April of 02, you have the opening balance as 316,48. Interest 316,48 multiplied by 5.369%. Payment is 333,333. Closing balance is opening balance plus interest minus payment. Closing balance comes to 0. So the present value comes to 949,912, and the interest for each comes to 31,695, and the closing balance comes to 0. So basically, we are converting this deferred payment transactions into a kind of loan transaction, and we will recognize the difference between total payment and cash price as interest. Right? Now for example purpose, generally I said give you the rate, and if you look at the study as well, you have the rate given as 5.36%. So you can use the 5.36%, consider 9,50,000 as opening value, and do the and pass the necessary entries. Now when it comes to passing of the entries, the first entry is passed at on 1st of April of year 1 when we actually acquire the property, plant and equipment, and it has to be done at the cash price. It has to be done at the cash price. Now in our case, where we have solved, the cash price comes to 949,912, and in some cases they will give cash price to you, meaning 9,50,000 the cash price, and in that case they will give you the implicit rate of return as well. And accordingly you can calculate what is the interest component and prepare the journal entry. So what you do is whatever payment is done, that you have discounted the given discount factor, arrive at the present value, and then pass the entries. So journal entries, first journal entry will be on 1st of April of year 1, you will debit PPE by what amount? By the cash price or the present value discounted at the rate, which is 9,49,912 in our case, and again it can be 950 also if you want to round it up. Okay, and I'll show you how does that calculation change. Debit PPE 949,912, credit. Now please note, on 1st April itself you have made the first payment of 3,33,333 or 34, so you credit bank because you have paid 3,33,333 or 34, and credit balance is payable. 3,33,333 is paid, balance is payable, so you have credit accounts payable, or if you are used to writing two accounts payable. How much is that? 949,912 minus 333,333, so 616,579 is what is payable. So 31st of March of year 2, what is the entry for interest? You will debit interest expense by what amount? We have calculated here 30,104, credit to accounts payable. How much is that? 30,104. Okay. Then on the same day you pay accounts payable, so debit accounts payable by 333,333, credit to bank, and that is the credit for reference. You can add the entries in normal way, right? To bank 333,333. Or if you want, you can combine both of these into a single entry. So if you do that, accounts payable, credit, and debit gets net off, and you can pass a single entry. So you pass single combined entry. What you do is, let's copy this here. You can pass single combined entry, that is interest expense 3104, right? Credit bank to bank. So if you pass combined entry, debit interest expense, then debit accounts payable to bank. To bank will be saying that is 333,333. Out of 333,333, 33,104 is for interest, balance is for zero. So 3,229 is a combined entry. So you can pass a combined entry as well, right? Then moving on to 31st of March of year 3, we can pass a combined entry if you want. Interest expense. How much is the interest expense for year? There is financial year 16,985. Then to bank 333,333, balance is towards account payable 3,160,448. Now if you see 3,160,448 plus 3,229, the total comes to 6,6,578. So if I add these two, 3 lakhs plus 3,160, 6,6,578, which is the original amount that we recognize as accounts payable. And if you come back to this table, for each of these, right, interest is 3,114 and payment is 3,33,333. Out of this total payment, 3,33,114 is towards interest and balance is towards accounts payable or principal, right? So like this, you pass the entries at the end of each period or at the end of each transaction. So what you understood here, the cost of property, plant and equipment will be recognized at its initial cash price or at the cash price. If there are deferred credit terms, if there are deferred payment terms, which is beyond the normal credit term. So if it is normal credit term, that is fine. But if it is beyond the normal credit term, then you have to identify what is the implicit rate of return or what is the interest cost involved and arrive and recognize for the PPE at the cash price. And any difference between cash price and total payment, you will recognize it as interest expense over the period of payment. So in our case, in this example, the cash price is 9,50,000. The total payment over a period of 3 years is 10 lakhs. So the difference of 50,000 is recognized as expense. Now there is a small rounding of difference because of the dates you have used to calculate the IRR, but don't worry, those differences are allowed in the examination. Let's look at another illustration. The term of an operating lease allows a tenant XYZ Limited to tailor the property to meet its specific needs by building an additional internal wall, but on the condition that the tenant returns the property at the end of the lease. So what's happening? You're taking the building by some lease, maybe for purpose. Now on that lease building, you are carrying out an activity of construction of internal walls, right? Now this meets the criteria for recognition as an item of property, plant and equipment, and because you're using it for more than 1 year, and because it is also used for any administrative or production, you do not. But it will generally recognize as an asset in the financial statement. Only the wall portion, we call it leasehold improvements. We call it leasehold improvements. As far as operating lease is concerned, we account for it as Ind AS 116. So this will entail dismantling of the internal walls because the owner wants you to return the property back in its original state. You have to dismantle the wall, and XYZ has incurred a cost of 25 lakhs on building the wall, and present value of estimated cost to dismantle the wall is 10 lakhs. So today you have spent 25 lakhs, and in the future you are expected to incur certain cost for dismantling. The present value of this is going to be 10 lakhs. At what value should these improvements be capitalized in the books? As I told you, these are works done on these properties. You have got something on these on the capital of certain improvements, and these can be recognized as items of PPE. Even for taxing purposes, remember, you can capitalize this and pay depreciation. Right? Now, how much amount should be capitalized? Should be capitalized 25 lakhs or should be capitalized 35 lakhs? 25 lakhs of initial cost plus present value of dismantling cost is 10 lakhs. What should be done? Now you understood. The cost of an item of PPE also includes the present value of the future dismantling, destroying, decommissioning, etc. Right? So the present value of dismantling, that is 10 lakhs, will be added to the cost of all these 20 lakhs, and this particular item of PPE, which is these whole improvement in our case, will be recognized at a cost of 35 lakhs. And this entire 35 lakhs will be depreciated over the life of the lease. Now, how to do the depreciation? Become and this entire 35 lakhs will be depreciated over the leasehold period, right? So the value of the cost when there is a estimated dismantling cost. Even though the property is a leasehold property, still then you need to consider the present value of future dismantling costs. Let's have a look at the illustration. Exclusions started construction on the building for its own use on first of April year 0. The following costs are incurred: purchase price of land 30 lakhs, stamp duty and legal fee 2 lakhs, architect fee, someone will design the building 2 lakhs, site preparation, getting the site ready for the construction activity 50,000, materials 10 lakhs, labor 4 lakhs, and general overhead 1 lakh. Other relevant information. Material costing 1 lakh has been spoiled and therefore wasted. So wasted 1 lakh material of 10 lakh. Cost of wasted materials are not included in the cost of PPE. They will be charged the income statement of cost. And a further 1 lakh 50,000 was spent on account of faulty design work. So what happened? Because there was a faulty design, we have to spend additional 1 lakh 50,000. I'll assume that is what material, material state of mind. So in this 1 lakh 50,000 have to be excluded. Any item of abnormal wastage or losses will not be included when you calculate the cost of the plant. When you calculate the cost of PPE. So this item will also be excluded. As a result of this problem, work on that building was for 2 weeks in doing further. So poor material, poor design, and then work was not done for 2 months, 2 weeks in the month of November. And it is estimated that 22,000 of labor cost later. Basically, for these 2 weeks, we spent 22,000 on labor and no work was being done on that item of PPE. So this will be excluded. See, pretty logical and principle is it incurred for item of PPE? If yes, capitalize it. If it is no, you will expense it. Then the building was completed on 1st of January and was brought to use on 1st of April of year 1. So when the building completed, the building was completed on 1st of January and it was put to use on 1st of April. Excluded had taken a loan of 40 lakhs on 1st April for construction of the building, and the loan carried an interest rate of 8% and is repayable on 1st of April of year 2. Calculate the cost of building has been included in tangible non-current assets. Now, the last item loan was taken at the rate of 8% on 1st of April of year 0. Why is this information given? This information is given for us to consider whether borrowing cost can be capitalized. Now, just to give you this, you have learned as a part of the borrowing cost in year 16 as well. To give you this, if the asset is a qualifying asset, then interest cost related to qualifying asset will be capitalized as per Ind AS 23. Now, here we can make two assumptions. Is this asset qualifying or not qualifying? If the asset is qualifying, the interest cost will be added to the cost of that particular asset. If the asset is not qualifying, it will not add. Now, guys, you see, the time period of construction of the building is from April till January. That is from April till December, considered 9 months. Generally, assets which take less than 12 months, we do not consider it to be a qualifying asset, and it's up to management decision whether they want to consider it to be a qualifying or non-qualifying. So we can base our answer according to that. So here the 9 months, and we do not consider 9 months to be a qualifying asset, then charge the interest expense to P&L. Now, we understand the detail of borrowing cost when we do Ind AS 23. So for now, we assume that it is not a qualifying asset, and this particular amount has to be expensed. Okay. So with this information, let us see how we calculate the cost of machinery. So we understood that any cost which is incurred to bring the item of PPE to current condition and location, and it is capable of being operated in the manner as intended in the dimension, all those costs will be capitalized. Any cost which is not related will not be capitalized. And we also understood that items of abnormal wastage will be excluded. Let's say one by one. We have purchase price of land 30 lakhs will be included. Yes, will be included. So purchase price of land 30 lakhs. Then we have stamp duty. Now stamp duty is paid for registration of land, so we will add that as well. Stamp duty is 2 lakhs. Then we have architect fee. So architect fees, someone will design the building, so fee paid to the architect, this will also be added. Then we have site preparation, so cost incurred for site preparation will add. Then materials. Now how much should we consider as material cost? The total is spent is 10 lakhs. 10 lakhs of material have been spent. Out of which the question says that there is a spoilage of 1 lakh. Do we consider 1 lakh of spoilage in the cost? Not, and we'll exclude that. Then another 1 lakh 50,000 was spent on quality design. So these are abnormal items. See, abnormal items, so abnormal costs are excluded. Maybe also understood that abnormal costs are not considered to calculate the cost of material. Same logic like this. So abnormal loss of material both because of spoilage and as well as quality design will be excluded. So material cost is 10 lakhs. Less spoilage 1 lakh. And material 55, quality design 1 lakh 50. Okay, so 10 lakh minus 1 lakh minus 1 lakh 50,000, that comes to 7 lakh 50,000 the material cost. Then we have direct labor cost 4 lakh, and they said that for a week period there was no work and 20,000 people in that period. So to extend up 20,000, we exclude from the cost of PPE. So 4 lakh minus 20,000 comes to 3,78,000. Right? If it is a normal wastage, if it is a normal item, then we will consider, and these are basic cost available. If it is a normal loss, we will be excluding it. Then general overheads. Do we consider general overheads when we calculate cost of item PPE? Generally, we will not consider any general overheads unless such overheads have been incurred specifically for the item of PPE. So in this case, we are not mentioning so, we assume that general overhead will not form part of cost of PPE. So 0 and interest cost. Both of them are 0. General overheads are expense, and interest cost, we assume that this particular asset is not a qualifying asset, and hence the interest cost cannot be capitalized. If it was a qualifying asset, then it would have been capitalized. Don't worry about this, we understand about borrowing cost in detail when we go in this 23. So the total cost now, just add 30 plus 2 32 plus 2 34, 34 lakhs 50,000, then 35% 42, and then 3 lakhs 78,000. If you add all of this, it comes to 45 lakhs 78,000. So this is the cost of PPE, or the cost of building which will be capitalized in the books. We can write it about general overhead are cost of PPE is interest cost is not capitalized, assuming that the building is not a qualifying asset. So these two modes and this computation, we have done the answers. Let's look at one more illustration. ABC Limited is installing a new plant at production facility. It has incurred the following cost. Cost of plant as per the last invoice plus taxes 25 lakhs, but they have not mentioned whether taxes are refundable or not. In that case mentioned, it is non-refundable. So that will be from part of cost of asset. Then initial delivery and handling cost 2 lakhs will include in the cost of PPE. Cost of site preparation 6 lakhs is also include. Consultation used for advice on the acquisition of the plant. Now the question that I need to ask is, are these consultation fees or consultation expenses incurred in relation to acquisition of the plant? Could we have bought the plant without these consultation charges? If you have bought the plant without consultation charges, then this will be an item of expense. But generally we are spending a huge amount here. We do not have technical expertise. We hire consultants who can guide us as to which is the right kind of plant given our requirements. Without consultant, maybe we have purchased the wrong kind of plant, or maybe we have bought a plant for poor quality. That could be possible. So consultation fees which are paid to this consultant, which are used, who have given us the advice on the acquisition of the plant, even this will be included in the cost of the plant. Then interest charges paid to the supplier of plant for deferred. We understood that interest charges should not be included in the cost of PPE. These will be expense unless they need the criteria specified by Ind AS 23. So we generally assume. Now in this case, if you see this is outright purchase of plant, so by nature itself, we will not be working as again. We understand what this is in Ind AS 23. Then NPV of estimated dismantling cost will be incurred after 7 years. So given the net present value of 3 lakh, this will be included. Operating losses before commercial production. Now we know that if there are any losses before you go into commercial production, initial operating losses, initial the market may not accept the product, you may be spending a lot on marketing, and trying to figure out ways to sell the product in the market. Such losses, such operating losses are not considered to be the cost of PPE. So you will exclude. For all of these items, interest and operating losses before commercial production will be excluded, and remaining all will form part of your cost of PPE. So you can do simple computation, you can calculate, and you can figure out the answer. Now the exam is always available to write notes for items which you have not considered. So generally what you have considered is assume that you know what to be considered, but what you have excluded, interest charges, operating losses, you need to write more on that. So why have you excluded those specific items? Let's now understand how do we arrive at cost of PPE whenever we are exchanging assets. Now, what do we mean by exchange? In fact, you would have done this quite a few times. Let's say you have an existing phone, which is troubling you a lot. The memory is not sufficient, so you think that let me buy a new phone. So you go to Amazon and then there you check out a mobile phone. The mobile phone is costing 20,000. Normally, you would have paid 20,000 and acquired that phone, right? So that is the cash price, or that is the price that you would have paid to acquire that phone, and you would consider this 20,000 to be the cost of your phone. But Amazon is giving you an excellent offer. Amazon says, whatever phone you have, we will give you 5,000 in return of that old phone. Now, when you take your phone to the market and try to sell it as a second-hand phone, no one is ready to pay more than 2,000. So 2,000 is the value of your phone. Amazon is giving you 5,000 in return of that. And what do? You pay 15,000, give that phone, and acquire that particular new phone. Now, the question here is, what should be the cost of new phone acquired? Right? There are other discussions around commercial substance and all that. Let's ignore that for a moment. What should be the cost of new phone acquired? Should we account for it at 20,000, or should we account for it at 15,000 cash paid because existing phone anyways was not in use, or should we account for it at 15,000 of cash paid, 2,000 worth of phone given, 15 plus 2, 17,000. Now that is what is addressed by this standard. Now these principles regarding exchange of assets, whatever has been described under Ind AS 16, is because of a wonderful logic. We need to understand that logic, and we also need to understand how do we account for these transactions. Now come back to our example. You got a phone. Now what is the value that you have given to acquire that phone? If you look at it, and if you honestly answer yourself, you gave 15,000 plus 2,000. 17,000 was the work that you gave to acquire the phone, which was worth 20,000. Now from an accounting perspective, if I have to ask you what will be the cost of this item, assume this is an item of PPE, how much is the value at which you will record this item of PPE? If you look at it logically, you should record it as 17,000 because that is what you have paid, that is what you have given to acquire this asset worth 20,000. Now the balance 3,000 you can consider it as discount. Now you may say, sir, but I'm getting asset worth 20,000. Why should I not show it at 20,000? You can do that at a later point in time by revaluing the asset. We'll understand cost model and revaluation model. By revaluing the asset, you can bring it to its true fair value. That can be done. But initially when you are recognizing, when you're saying cost of acquiring that particular item, that cost is the value that you have given to acquire. And what is the value that you have given? Cash of 15,000 and 2,000 worth of old phone, right? Now the extra 3,000 is like a discount that the supplier has given to you. Now this is a general example of exchange. So there can be situations even in businesses that a business gives up one asset to acquire an item of PPE. Now generally also if you see, whenever you're acquiring an asset, you are giving something in return. You are giving maybe cash in return. But if there are items which are not cash or which are not monetary items, in that case, how should you do the accounting, right? So this aspect deals with cases where you are acquiring an item of PPE. Listen carefully. When you are acquiring an item of PPE by giving either a non-monetary asset or a combination of monetary and non-monetary asset. Now I've introduced two new terms here: monetary asset and non-monetary asset. What is this monetary asset? Monetary asset is an asset which can be measured in fixed and determinable amount of money. To put it very simply, for example, cash and cash equivalents. If I have 1 lakh with me, what is the worth of that? That is 1 lakh. How much will I get when I give 1 lakh to someone? I get 1 lakh, right? Because it is fixed, it cannot change. Or I have sold goods to someone for 50,000. What is the amount I realize from the data? I will get 50,000. So these assets which have fixed amounts determined, they will not change. See, the data may not pay. There may be a bad debt. That's a secondary issue. But if I have to say that I have to receive some amount from that particular data, I know it is 50,000. So if it is fixed and determined, we call it monetary asset. Now, whenever we are acquiring an item of PPE in exchange of monetary asset, it is very simple. What is the worth you have given? Let's say I paid 1 lakh in cash. Yes, the cost of the item of PPE is 1 lakh. There is no confusion. But what if it is a non-monetary item? For example, fixed asset. Do you know what is the money worth of fixed asset? See, you have that book value, you have carrying value, all of that is there. But if you have to sell that asset, do you know how much will you get? Or if you have to use that asset in the business and generate future benefits, can you measure that accurately? Can you say that this is the fixed amount of worth that I will get from this asset? You cannot. Or say, for example, there is an item of inventory. Now, inventory will measure that cost. But what is the money that you will get when you sell that particular inventory? Sandy, today you will not be able to know. Data you know because you have sold it for a fixed amount. Inventory, it is not fixed. The money worth of inventory is not fixed. So these items are called non-monetary items, right? So fixed assets, inventory, if you have invested in equity shares, if at all there is any uncertainty regarding what is the amount that you will receive, those are non-monetary assets. Now, if you are giving either a non-monetary asset to acquire a PPE or a monetary plus non-monetary item to acquire a PPE, then we'll apply the principles laid down in Ind AS 16. Now, what is this monetary and non-monetary? Monetary may be cash, non-monetary may be your old mobile phone. So whenever there is exchange involved, how do we do the accounting? That is what is prescribed by Ind AS 16. The first principle whenever there is an exchange of assets is that the item of PPE is measured at fair value. Now, what is the fair value? A fair value is the amount at which a transaction would have been entered into between two knowledgeable and willing parties. Basically, the parties must be willing to enter into the transaction. They must have all the knowledge regarding the transaction, and the amount at which such a transaction is entered into, that is called fair value. Generally, if you go to a market and there are let's say many shops available, you could buy from any of the shop and you have full knowledge about the product that you're buying. Then maybe you can go to any shop and you inquire about the price. And whenever you're entering into a transaction, in such a case, let's say you go to a mobile shop, the shopkeeper says 15,000 is the price of the mobile. You pay 15,000, you take that mobile. You have options to check the price online at other places. So such an amount which is paid in these kind of transactions is called the fair value. Okay, but let us say you go to a relative's shop or you go to a friend's shop. Instead of 15,000, he may give that mobile phone to you at 12,000. Now that 12,000 is not a fair value because there is a relation which is influencing the transaction, right? Or someone has put a gun on your head and said, okay, you have to sell me your phone at 5,000. It may be worth 1 lakh, but because under threat, if you are selling it at 5,000, that 5,000 is not a fair value. So what is fair value? Fair value is the price that would be received to sell an asset. Whenever you're selling an asset, what is the price that you would receive? Or paid to transfer a liability. If you have to settle a liability, what is the amount that you would have paid in an orderly transaction between market participants at the measurement date? So basically it means in an orderly transaction, I told you, right? Knowledgeable parties, willing parties, parties having willingness, parties aware of the entire, parties have all the information and knowledge about the product and the transaction. Now whatever is the price that is paid or whatever is the price that is received, that is called fair value. So if you are acquiring an item of PPE in exchange of a non-monetary asset or a combination of monetary and non-monetary asset, the item of PPE acquired is measured at fair value. Now the question comes, fair value of what? Fair value of asset given or fair value of asset received? See, we gave assets, right? We gave 2,000 worth of phone, we gave 15,000 worth of cash, we got an asset worth 20,000. That is the fair value of the asset. Now which one should we consider? First preference is the fair value of assets given up. The fair value of assets given up. We'll understand the logic of why we are using fair value of assets given up in one of the illustrations, okay? Because if you use fair value of assets acquired, then you will be unnecessarily booking an extra gain in the books. The reason being, you gave 15,000 of cash, so cash as an asset has gone out of the balance sheet. Then you gave 2,000 worth of assets, so 2,000 of asset also has gone out of the balance sheet. You got 20,000 worth of asset. Now if you say I'll account for this as 20,000, then there is a difference of 3,000. Basically that difference represents 2,000 worth of the asset that you have given, which the other party has valued at 5,000. So the extra 3,000 you will be showing it as a gain in your books, which should not be done, right? So because of this reason, you are recording the item of PPE which is acquired at fair value, and the fair value should be the fair value of assets given up, not the fair value of assets acquired. But if you can measure the fair value of assets acquired more reliably, this fair value of assets acquired is more evident than the fair value of assets given up. Say for example, we have a machine for which you are not able to determine the fair value. In that case, you can use the fair value of assets acquired. But first preference is fair value of assets given up. If it is not evident and if the fair value of assets acquired is more evident, then you can use fair value of assets acquired, right? So first thing, in an exchange transaction, the item of PPE is measured at fair value. And generally, what is the preference? Fair value of assets given up. Now, if this kind of freedom is given and companies start exchanging assets and start bringing up their value of assets by using fair value, it will be very difficult. Let me give you one example. Let us say there are two companies, A and B. A has one machinery, B has another machinery, similar capacity, similar production process, similar level of efficiencies, similar costs, right? So maybe brands are different, but overall structure of the machinery, the production capacity, everything is similar. Now, company A had acquired it sometime back, B had also acquired it sometime back, and as on today, the book value of the machine is say in books of company A is let us say 40 lakhs, in books of company B is let us say 45 lakhs. What is in the book value or the carrying amount? That is the original cost minus depreciation, right? You all must be aware of concept of depreciation. So original cost minus depreciation, this is 40 lakhs and this is 45 lakhs. That is the book value, right? Now, when you look at the market value or the fair value of these machines today, because raw material costs have gone up, there is some shortage in supply of some let's say chips because of all this COVID and all, the prices of these machines have gone up significantly. Now this 40 lakhs machine, if you sell it in the market today in the given condition, it will fetch you 60 lakhs. Now this 45 lakhs machine will fetch let's say 65 lakhs. I'm just putting some numbers, okay? The worth is 60 lakhs and 65 lakhs, but in the books they have to show it as 40 lakhs and 45 lakhs, right? Now can they increase the value of these machines in the books? Yes, they can do it if they follow the revaluation model. We'll understand about revaluation model sometime later, but you can use revaluation model and you can increase the value of these machines, and whatever is the gain, you can keep it under revaluation reserve. But the revaluation reserve is restricted, right? You cannot pay it out as dividend. It is directly taken under other comprehensive income, so it will not be coming up in a P&L. So what these companies decide is, now when these companies exchange this machine, what will be the accounting treatment? Now this company, when it gives up this machine, which is at book value of 40, fair value of 60, we said the fair value of asset given up will be the cost of machine acquired. So when this machine moves from company A to company B, and this machine moves from this company to this company, what happens? This 40 lakh machine which is given up has a fair value of 60. So the new machine which is acquired will be shown as 60 lakhs, right? Will be shown as 60 lakhs, and the other company which has given up an asset, of fair value 65 lakhs will showcase the machine acquired at 65 lakhs. So from 40 lakhs, they have increased the value of the machinery to 60 lakhs and 65 lakhs. How did they do that? Just by exchanging, right? Now what will happen to the difference? The difference will be recognized as gain on disposal of machinery. Now both the companies are happy. Just by exchanging, they have increased the value of their assets in the balance sheet. They are showing higher profits. Should this be allowed? If you look at the substance of the transaction, the operating efficiencies are same. Machines also have similar capacity. Nothing is changing for the company. Production will remain the same. The operating profits will remain the same. The cash flow will remain the same. They have entered into this transaction to increase the value in the books of accounts, and this will not be allowed. So what the standard says is, if the transaction lacks commercial substance, what do I mean by lacking commercial substance? The cash flow doesn't change. The timing of cash flow doesn't change. The amount of cash flow doesn't change. Overall, it is not making any impact on the business. Just they are exchanging similar kind of assets with similar capacity. Nothing is changing for the business. So if cash flows are not expected to change, if the value that the business is deriving is not expected to change, then we say that the transaction lacks commercial substance. Then the transaction lacks commercial substance, and if that is the case, you will account for the acquired PPE at the carrying amount of asset given up and not the fair value. Now, when this principle is applied in the given example that we have discussed, when the assets are exchanged, you will not use fair value because there is no commercial substance. Because there is no commercial substance, you will account for them at carrying amount of asset given up, carrying value of asset given up. So what was the carrying value of asset given up in this case? It was 40 lakhs. So new machine also account as 40 lakhs. Here 45 lakhs. New machine also account as 45 lakhs. So when you give this restriction, they cannot play around with the books. So that is the logic behind whenever there is an exchange which is lacking commercial substance, you need to account for the respective asset at the carrying value of asset and not the fair value. Generally, if it has commercial substance, then you will use fair value. Now, what do we mean by having commercial substance? When can a machine have a commercial substance? Let's take one more example. I have a machine which has a useful life of 3 years. I have a machine which has a useful life of 3 years. I exchange it for another machine which has a useful life of 5 years. So because of this exchange transaction, my cash flow has increased for 2 years. My timing of cash flow has changed. Maybe the capacities are different and the amount of cash flow also changed. Right? So if the exchange results in any of these things, changes in the timing, the nature, the risk, the amount of cash flow, then we say that it is a commercial substance. Or if you look at the value that is being derived by the entity from the use of the machine. So my old machine, what will be the present value of future entity, right? Versus what will be the present value coming from the new machine? If it is a significant difference, then we say that the commercial substance. And whenever there is a commercial substance, then we will account for it at fair value of asset given up. If there is no commercial substance, we will account for it at carrying amount of asset given up. Very important for you to understand. First, what do we need to check? First, check whether there is commercial substance. First, you check whether there is commercial substance. If yes, then you will account for it at fair value of asset given up. So commercial substance, if it is yes, fair value of asset given up. No, there is no commercial substance, then carrying value of asset given up. Now, the transaction has commercial substance, but fair value of asset given up cannot be measured reliably. Then check, can you measure the fair value of asset acquired? Yes. Then measure at fair value of asset acquired. Now, you cannot measure fair value of asset given up, neither can you measure fair value of asset acquired. For reasons many in market available, they are not buyers. It's a very customized kind of machinery. In such cases, you may not be able to measure the fair value of asset given up or acquired. So, if you cannot measure the fair value of asset given up, nor can you measure the fair value of asset acquired, then in that case, you will again have to measure it at carrying value of asset given up. So, again, summarize. First, you need to check whether there is commercial substance. If commercial substance exists, then you will account for it at fair value of asset given up. Otherwise, carrying amount of asset given up. If fair value of asset given up cannot be identified, then you will account for it at fair value of asset received. If that is not evident, then you will account for it at carrying amount of asset given up. The cost of items of PPE acquired in exchange of non-monetary asset or combination of monetary and non-monetary asset are measured at fair value unless, so generally measured at fair value, but exceptions are, number 1, the exchange lacks commercial substance. So if the exchange doesn't have commercial substance, then you will measure it at carrying amount of asset given up. Or number 2, or the second condition is the fair value of neither the asset received nor the asset given up is measured reliably or is measurable reliably. So basically, you are not able to measure the fair value of assets reliably. If that is the case, again you will measure it at carrying amount of asset given up. So now when we talk about commercial substance, how does an entity determine that an exchange transaction has commercial substance or not? Basically, we need to look at the cash flows and understand whether there is a change in the cash flow or whether there is a change in the value that we are deriving from the asset. Now to give you a simple example, let's say I have an iPhone 11 and I exchange it for iPhone 11 Pro. I have an iPhone 11 and I exchange it for iPhone 11 Pro. Now, do you think that the usability or the value that I am deriving from the acquired iPhone will be significantly different from the existing iPhone that I have? No, right? So if you are exchanging similar assets which are using the results, in that case, we will say that the transaction doesn't have commercial substance. But if the transaction is very different, say for example, I gave up my land at one location and I acquired a building in exchange at another location. This exchange transaction has commercial substance. Why? Because the benefits that I derive from land will be very different from the benefits that I derive from buildings. Or if the age useful life is very different, in that case also the transaction will have commercial substance. Now you have to look at facts of the case and understand whether a transaction has commercial substance or not. Okay, so to give one more example, let's say a company owns oil reserves in a particular location and company B owns oil reserves in another location. Similar capacity, similar yield, prices are determined by global factors. Now if they exchange these assets, why would they do that? Maybe because the operation convenience is not that. If they exchange these assets, do you think it has commercial substance? Because the cash flow is not changing significantly, we say that the exchange transaction doesn't have commercial substance. So when we're looking at exchange transaction, you have to see whether it has commercial substance or not. And generally, a transaction is expected to have commercial substance if the configuration of the cash flow of the asset received differs from the configuration of the cash flow of the asset transferred. So now configuration means the risk of cash flows or the amount of cash flows or the kind of cash flows. So the asset that given has a different configuration of cash flow from the asset that acquired. Then we say that the transaction has commercial substance. Account for it at fair value of asset given. Okay. Or the entity specific value of the portion of the entity's operation affected by the transaction changes as a result of the exchange. Basically, what it means is that asset, whatever it contributes to the entity, right? Whatever it contributes to the entity, if that changes because you give up an asset and you acquire the asset, then we say that the transaction has commercial substance. So what is this entity specific value? Basically, you take the post tax cash flows which you can associate with a particular asset and bring it to the present value. It's similar to the concept which you understand in impairment. The present value of post-tax cash flows associated with that asset, which the entity is expected to generate. So the asset that given up will have an entity specific value. The asset that acquired will also have an entity specific value. Is there a significant difference between these two? Right? If there is a significant difference, then we say that the transaction has commercial substance. So basically, when you compare these two, let's say from the asset given up, the entity specific value 1 lakh, from the asset acquired, the entity specific value 1,10,000. If they're not significantly different or materially different, then we can say the transaction has commercial substance. You have to see this difference in relation to the fair value of assets that you are exchanging. The asset may be worth 1 lakh and the difference is only 5,000. Then it is insignificant. Then also you say that the transaction doesn't have commercial substance. So you need to very carefully understand and evaluate whether the transaction has commercial substance. If yes, only then we will go to fair value, otherwise we will go to carrying amount. Right? So most of the times in examination, we should mention whether the transaction has commercial substance or not. We also understood that the fair value of assets must be measured reliably. Now what is reliability? You can see it's an estimate. Now whenever we are making an estimate, the variations in our estimate should not be significant. It should not be like, the first fair value we have is 1 lakh, the second fair value is 3 lakh. It's a wide variation, right? The variation should be insignificant. And if you are assigning probabilities to calculate fair value, we must be able to assess those probabilities reliably. Right? We must be in a position to have a proper assessment of what will be the probabilities and then compute the fair value. It's more of a judgment. There's nothing hard and fast rule. It's more of a judgment that the fair value can be measured reliably. Let's have a look at an illustration. Pluto Limited owns land and building which are carried at its balance sheet at an aggregate carrying amount of 10 million. Now, when we say carrying amount, always remember we are talking about original cost less depreciation. Cost less depreciation. If you're following the revaluation model, the revalued amount would be considered, right? So here, the carrying amount is 10 million. 10 million is 1 crore. The fair value of such asset is 15 million. Now, think of it logically. I have assets worth 10 million. The fair value today is 15 million. If I go and sell these assets, how much will I get? I will get 15 million. So, I am getting a gain of 5 million. So, these assets, when I'm giving up or when I'm transferring, I should be making a gain of 5 million because the present worth is 15 million, right? It exchanges the land and building for a private jet. So, you have given land and building, and what do you get? Private jet. Now, does this transaction have a commercial substance? See, building has a different set of cash flows. Private jet has a different set of cash flows, right? So, obviously, it has a commercial substance which has a fair value of 20 million. So, the jet has a fair value of 20 million. What did you give up? Land and building worth 15. Okay. Was it 5 million discount? Let's see. And pays additional 3 million in cash. Okay. So, it's very clear. Assets given up, land and building worth 15 million. Book value is obviously 10 million. Cash 3 million. So, what have you given up? One non-monetary asset with a fair value of 15 million and one monetary asset with a fair value of 3 million. 15 plus 3, you have given up 18 million. That is what you paid, right? And what did you get? You got a jet. You got a private jet. Now, this private jet should be accounted for at what value? 20 or 18? It should be accounted for at 18. That is the fair value of assets given up, right? Now, this difference of 2, if you want to follow the revaluation model, you can evaluate at a later point in time. But for now, you should be accounting for at 18. And the very simple reason being, if at all you account for it at 20, you will be accounting for extra 2 million gain, which does not belong to you. That's the very simple reason behind that, right? So, the question says show the necessary treatment. We already discussed that and pass the journal entry for the transaction. So, let's look at the journal entry. What should be passed? So, the first thing, at what value should we recognize this private jet? The private jet should be recognized at 18 million. That is, the fair value of building given up 15 million and cash paid 3 million. So, total outflow from your side is 18 million, right? Then, how should we pass the journal entry? Now, think of it. In your balance sheet, look at the balance sheet. In your balance sheet, land and building is at 10 million. It's not at 15 million. Land and building is at 10 million, right? Then, you have cash worth 3 million. So, you gave this out, right? Now, this land and building, you actually gave it at a value of 15 million. So, this difference of 5 million between the fair value and the carrying amount is the profit on disposal of land and building, which should be accounted for. So, whenever you're passing an entry, think what you need to debit and credit. What will you credit first? You will credit land and building. So, right, to land and building, how much is the amount? 10 million. Land and building has a debit balance because you're disposing it off. You will have a credit entry which is 10 million. That's the first thing. Then, to cash, how much? 3 million. So, 10 million is out, 3 million is 3 million. So, 10 million building, because we transferred it at a value of 15 million, that 5 million is profit on disposal. So, to profit on disposal, 5 million. So, you have 10 million of building, 5 million of profit on building, 10 million of cash. 10 plus 5 plus 3, what is the total? 18 million. That will be debited to property, plant and equipment for private jet. So, debit, property, plant and equipment, private jet, 18 million. Credit to property, plant and equipment, land and building, 10 million. Profit on disposal, 5 million, cash 3 million. So, this is the journal entry that we will be passing. Now, when you look at the balance sheet will now have private jet of 18 million and you'll have profit on the other side which is 5 million. 18 minus 5, that is 13. So, this allows you have
Let's have a look at one illustration. Pluto Limited owns land and building which are carried at its balance sheet at an aggregate carrying amount of 10 million. Now, when we say carrying amount, always remember we are talking about original cost less depreciation. Cost less depreciation. If you are following the revaluation model, the revalued amount would be considered, right? So, here the carrying amount is 10 million. 10 million is 1 crore. The fair value of such asset is 15 million. Let's have a look at one illustration. Logically, Pluto Limited I have assets worth 10 million which are carried at its balance sheet. The fair value today is 15 million. Let's have a look at one illustration. Pluto Limited owns land and building which are carried at its balance sheet at an aggregate carrying amount of 10 million. Now, when we say carrying amount, always remember we are talking about original cost less depreciation. Cost less depreciation. If you are following the revaluation model, the revalued amount would be considered, right? So, here the carrying amount is 10 million. 10 million is 1 crore. The fair if I go and sell these assets, how much will I get? I will get 15 million. So, I am getting a gain of 5 million. So, these assets when I am giving up or when I am transferring, I should be making a gain of 5 million because the present worth is 15 million, right? It exchanges the land and building for a private jet. So, you have given land and building and what did you get? Private jet. Now, does this transaction have a commercial substance? See, building has a different set of cash flows. Private jet has a different set of cash flows, right? So, obviously it has a commercial substance which has a fair value of 20 million. So, the jet has a fair value of 20 million. What did you give up? Land and building worth 15. Okay. Was that 5 million discount? Let's see. And pays additional 3 million in cash. Okay. So, it's very clear. Assets given up, land and building worth 15 million. Book value is obviously 10 million. Cash 3 million. So, what have you given up? One non-monetary asset with a fair value of 15 million and one monetary asset with a fair value of 3 million. 15 plus 3 you have given up 18 million. That is what you have paid, right? And what did you get? You got a jet. You got a private jet. Now, this private jet should be accounted for at what value? 20 or 18? It should be accounted for at 18. That is the fair value of assets given up, right? Now, this difference of 2, if you want to follow the revaluation model, you can, revalue it at a later point in time. But for now, you should be accounting for at 18. And the very simple reason being, if at all you account for it at 20, you will be accounting for extra million. This is not that's very simple reason. Right. So, the question is show what is that and pass the journal entry for the financial. Let's look at the journal entry what should be passed. The first thing, at what value should be recognized private jet? Private jet should be recognized at 18 million. That is, the fair value given up 15 million and cash get 3 million. So, total outflow from your side is 18 million, right? Then, how should we pass the journal entry? Now, think of it. In your balance sheet, land and building is at 10 million. It's not 15 million, land and building is at 10 million, right? Then you have cash worth 3 million. So, we get this out, right? Now, this land and building, you actually gave it at a value of 15 million. So, the difference of 5 million between the fair value and the carrying amount is the profit on disposal of land and building which should be accounted for. So, whenever you're passing an entry, think what you need to debit and credit. What do you credit first? You credit land and building. So, right, 2 land and building, how much is the amount? 10 million. Land and building has a balance because you are disposing of, you have a credit entry which is 10 million. That's the then 2 cash, how much? 3 million. So, 10 million is out, 3 million is 3 million. So, 10 million building, because you transfer it at a value of 15 million, then 5 million is profit on disposal. So, 2 profit on disposal, 5 million. So, you have 10 million of building, 5 million of profit on building, 10 million of cash. 10 plus 5 plus 3, total 18 million. That will be debited to profit on equipment for private jet. So, debit property plant equipment private jet 18 million, credit to property plant equipment land building 10 million, profit on disposal 5 million, cash 3 million. So, this is the related passing. Now, you look at the balance sheet. The balance sheet will now have private jet of 18 million and you have profit on the rest is 5 million. 18 minus 5 that is 30. This is 30. So, you balance sheet as 30. Let's have a look at few scenarios and see what is the cost of PPE which is acquired in an exchange transaction, right? In the first case, carrying amount of asset given up is 100. Fair value of asset given up is 120, fair value of asset acquired is 130 and there is commercial substance. Now, if this is satisfied, right, there is commercial substance, you will have to go to fair value of asset given up. So, in this case, you will have to see what is the fair value of asset given up which is 120. So, we will account for this particular asset at 120 which is nothing but the fair value of asset given up. And will there be any gain? There will be a gain of disposal because fair value is 120. So, whatever is fair value minus whatever is the carrying amount, you will account for it as gain, right? Gain on disposal or profit on disposal. Then, in the second scenario, carrying amount of asset given up is 100. Fair value of asset given up is not determinable. You are not able to identify. But the fair value of asset acquired is evident and it is at 130 and this transaction has commercial substance. In that case, you will account for it at fair value of asset acquired because it is more evident, it is available, and there will be a gain on disposal which is nothing but the fair value at which you are accounting the new property, plant and equipment minus whatever is the carrying amount that is being given up, which is 30. In the third scenario, there is commercial substance, carrying amount of asset given up is 100, fair value of asset given up is 100, fair value of asset acquired is also 100, cannot be measured reliably. In that case, the cost of asset acquired will be at 100 and there will be no gain of loss. So 100 minus 100 will be the carrying amount of asset given up. And lastly, in the last scenario, carrying amount of asset given is 100, fair value is 120, fair value of asset acquired is 130, but the transaction maximum substance, and if the transaction maximum substance will not look at fair value, you will look at carrying amount only. So it will be 100, it will be 100 and there will be no gain for loss on disposal. So this case, there will also be a situation where there is a loss on disposal. There is no loss, right? So the thing that you need to keep in mind is check for commercial substance. If not available, the carrying amount, if available, then fair value of asset given up. If fair value of asset received or acquired is more evident, then you will go with the fair value of asset acquired. Now we have understood how to measure initial cost. So sometimes what happens is there is a government grant which is received in relation to an item of property, plant and equipment. Now for this again we have a separate standard where we will be discussing in detail about government grants. But if there is a government grant related to an item of PPE and it qualifies as per Ind AS 20, it meets the conditions prescribed there, then you would be required to reduce the amount of government grant from the cost of property, plant and equipment. Detailed discussion we will have in Ind AS 20, not here. Now we discussed about initial cost, the measurement of initial cost, what are to be included, what are to be excluded. Now once you acquire an item of property, plant and equipment, it is not that there is only initial cost involved. For example, you purchase, right, now there is a over a period of time, regularly you have to spend something like a petrol. Now the petrol is subsequent expense that on that item of PPE, or you have to replace the tires, or you have to carry out general repairs and maintenance, or you have to get service at period interval, right? So there is somewhat as a form of subsequent cost which will be incurred on an item of PPE. The same whole goes with items of machinery also. You purchase a machinery, there may be repair requirement, there may be inspection requirement, or let's say you purchase an aircraft, you have a company, and as a company, the company purchase aircraft. Now aircraft require regular inspection, they require regular overhauls. A lot of subsequent costs are also involved. Now how do we handle this subsequent cost? What do we do with these subsequent costs? Now even these principles are clearly laid down in Ind AS 16. The first bullet rule of the first principle is any day-to-day regular repairs and maintenance, such costs are not added to the cost of PPE, but they are expense in the period they are incurred. So if you are carrying out regular repairs and maintenance, regular servicing is happening, then you will expense those particular items. You will not capitalize items of repairs and maintenance. You will say yes. You will say this is what you learned from it. Exactly. Anything is regular routine repair and maintenance, you will exclude. So was it necessary to spell it out clearly? Yes. When you look at some other kind of cost which can be capitalized, you feel like yes, it has to be spelled out clearly. Otherwise, sometimes you say every repair is a major repair, every repair is a major inspection overhaul, let us capitalize, right? So any subsequent cost of repair and maintenance will be expense and will not be capitalized. The next aspect to consider when you talk about subsequent cost is replacement of cost. Another way of camera maintenance concept that is battery of the camera is one. Right? We got the camera for years back and camera can use it for 10 years, but the battery lasts only for 2 years. Now initially when I accounted for the camera, I said the entire camera cost is so much. Now what I do? I have to replace a part of the camera, and what I have done, I have bought a new battery and I have disposed of the old battery. Now these are called replacement of parts. So there may be a requirement that you have to replace certain parts of your property plant equipment at regular intervals. Right? Say for example, you look at aircraft. Now if you look at aircraft, there is the outer body, and then there are engines, then there are internal furniture, the seats and all. Just teenager parts. I'm not an expert in flying an aircraft or understanding engineering aspects. This is teenager part. Now you may have bought an aircraft as a single item and you have accounted for it as 100 crores. But the outer body may have a life of 30 years. The engine may have a life of 50 years. The seats inside have a life of 5 years. So after 5 years, you have to replace all the seats. Right? So what do we do with this? Let's say we spend some amount to replace the seats. Do we treat it as a repair and maintenance item and expensive cost, or do we capitalize the cost involved in replacing the seats? And if we capitalize the cost involved in replacing the seats, what do we do with the original seats that were acquired on the aircraft? Do we say the entire aircraft is acquired for 100 crores? Now for 5 years we spend let's say 5 crores to replace the seats. Now this 5 crores, whether we should treat it as a repair or whether we should add it to the cost of PPE, that is one question. And the second question, if we add those seats at item of PPE, then what do we do with the existing seats? Because we do not have a separate balance for existing seats. We have combined everything into an aircraft and we have only that 100 crores when we purchase. Now here you need to understand a couple of things. We understand about these in further detail later, but as far as depreciation is concerned, what the standard prescribes is you have to follow component-wise depreciation. That is to say, if you purchase an aircraft, some part has a life of 30 years, some part has a life of 15 years, some part has a life of 5 years, you have to segregate and then charge depreciation. You cannot say that I depreciate the entire aircraft over a period of 30 years. So that is one thing that we do. We call it component-wise depreciation or component accounting. Okay, so when you replace these seats after 5 years, you have to check whether that qualifies to be recognized as an item of PPE and whether we can show it as an asset. If the recognition criteria are met, then you will take those cost of seats that you have incurred and you will add it to the cost of property plant equipment. So that 5 crores that you spend after 5 years, you will consider it to be an addition to PPE at the time you have made that expenditure. Now what about the seats that are already existing? Now as far as the older seats are concerned, you have to compute what is the carrying amount on that particular replacement date, and you have to de-recognize the older seats. So it's very simple. If there is a replacement, then the expenditure on replacement, if it meets the recognition criteria, say the standard always revolves around meeting the recognition criteria. If it can be recognized as an item of PPE, then you will add it to the cost of PPE, and the existing item you will de-recognize. Now let's check whether the conditions are met. Now if you look at aircraft, after 5 years the seats are not suitable, right, and there are a lot of vacancies and all, or maybe as per the mandate of the government you have to replace them. Unless you replace the seats, you will not be able to sell the aircraft. So definitely there is some future economic benefits. Definitely there is an tangible item. It will be used for more than 1 year. Then it will get future economic benefits. So you will recognize it as an asset. You will show it as an addition to item of PPE, and the existing seats will be recognized as the carrying amount. Now we will see how we arrive at the carrying amount. We understand examples, but this is how you should be doing it. So if I purchase a battery for camera, then the cost of new battery will be an item of PPE. The cost will be added to PPE, and the existing carrying amount will be recognized. Right? Let's take one more example. Say we have constructed a building, we acquired land, we built a structure, we have built a building, spent money on materials, painting, everything necessary. And generally the paints of the walls last for 5 years. And after 5 years we have to repaint the building. After 5 years we have to repaint the building. Now is this painting a revenue expenditure or capital expenditure? Do we recognize it as an expense in the year in which it is incurred, or do we capitalize it? Now you surprise to find that even such cost needs to be capitalized because the painting will last for 5 years. The paint of walls will last for 5 years. So any cost that we incur on painting a building is going to be used for more than 1 period, then that will be capitalized. So when we are capitalizing the new painting, we have to recognize existing painting. We have to recognize the cost of existing paint work that has been done. Now remember, does it mean that painting will show as a separate line item as PPE, the walls will show as a separate line item as PPE, the land will show as a separate line item as PPE, the structure will show separately? It doesn't work like that. The land will show it separately, but building will show it as a single item of PPE. But you may have to keep a breakup of what all has gone into the cost of that building, and at later point in time, you repaint the building, then recognize the existing painting cost and add the new painting cost. The next aspect we need to understand is the aspect of major inspection and overhaul. What is the major inspection? These are not routine inspection, not going to a machine and checking whether there is enough fit or not fit. It's a major inspection. You're actually undergoing a thorough checking of the entire machinery. Say for example, aircraft. Now when you purchase an aircraft from the manufacturer will have checked everything in that aircraft. You have gone to quality checks and then delivered, right? Now let's say as per the law, you are required to get the aircraft inspected and overhauled if needed once in 3 years. Now what do you mean by that? For 3 years you can fly in the original condition. But once the timeline of 3 years is over, then you have to get it rechecked, re-inspected and overhauled if needed. Overhaul means you have to get necessary parts replaced if required, and this inspection is mandatory. You will not be allowed to fly the aircraft if this inspection is not done. And this is a major inspection work. It is not a minor inspection work. Now what the standard describes is if at all there is a requirement of major inspection and overhaul, then the cost incurred for major inspection and overhaul will be capitalized. It will be treated as a cost of property plant equipment. Obviously the recognition criteria has been met. Now here you see this cost has to be incurred so that we will be able to fly the aircraft for next 3 years. If you don't carry out this inspection, you will not be able to fly
flight aircraft, so it is necessary and hence it has to be recognized as a cost of PPE. We are talking about major inspection, not minor routine repairs and maintenance or routine inspection. Now once you capitalize this cost and also depreciate over this estimated useful life that is estimated for next 3 years, you will also need to check if there was any component which has to be recognized because you are adding a fresh item of overhaul and inspection. Is there something which you need to recognize? Now if you go back to the purchase transaction, the manufacturer has done all the quality checks, he has done all the inspection work, so you have to estimate what would be the cost of that inspection and de-recognize the carrying amount accordingly. So you have to make an estimate and de-recognize the carrying amount accordingly. And in the future after 3 years when you do another round of inspection overall, you have to add that as a cost and you have to de-recognize the earlier incurred inspection and overall cost.
Let's have a look at one example. A shipping company is required by law to bring all ships into dry dock every 5 years for a major inspection and overhaul. So, as per law, a shipping company is required to get all the ships to the dock for major inspection and overhaul. A ship which costs 20 million with a 20-year useful life must have major overhaul every 5 years. So, if you have purchased the ship today, after 5 years you will have to get an overhaul done. The estimated cost of the overhaul at the 5-year point today is 5 million. So, if you have to get an estimate of that overall, it is 5 million today. Now, how much have we paid to acquire that ship? We have paid 20 million. So, what we will consider is out of this 20 million, we have paid 15 million towards the ship, 5 million towards the initial inspection and overall what was done by the supplier. Accordingly, we will depreciate these two for our depreciation purposes, right. So, I am again repeating, we paid 20 million to purchase that ship. Out of that, 5 million is estimated towards the inspection. So, when the ship was delivered, it would have been inspected. So, that cost is estimated to be 5 million. Now, the reason why we have to segregate these two is that 15 million cost of ship has a useful life of 20 years and hence will depreciate it over a period of 20 years, and this 5 million of overhaul cost has an estimated life of 5 years and hence we will depreciate it over a period of 5 years. So, in our example, the total amount of 20 million that is being paid, we will segregate that between the cost towards ship and the estimated cost towards overhaul and inspection, right. And the reason for that, as I already told you, whatever amount we are paying immediately, we can say that a part of it has been spent towards initial inspection and overhaul, right. So, 15 is cost of ship, 5 is towards inspection, and the total comes to sum of 15 plus 5, it is 20, right. Now, what will be the depreciation per year? Depreciation per year will be the initial cost divided by the useful life, and assuming we follow straight line method. So, 15 divided by 20, the depreciation per year comes to 0.75, and here it has a useful life of 5 years, right. So, the depreciation will be 5, that initial cost, estimated cost divided by 5, it is 1, right. I will just add one line item for useful life, 20 and 5, okay. Now, what will be the depreciation for 5 years? 0.75 into 5, the depreciation for 5 years will be 3.75, and 1 into 5 it will be 5. So, the total depreciation charge if you see will be 5 plus 3.75, which is 8.75. What is the carrying amount at the end of 5 years? Initial cost minus the depreciation of 3.75, it is 11.25. Carrying amount of this major inspection will be 0 because we have fully depreciated it, and carrying amount of the property, plant and equipment will be 11.25. Now, in balance sheet you will not show ship at 11.25 and inspection as a PPE 0. That is not how it will be done. You will show it together as an item of property, plant and equipment at 11.25, which is the total. This segregation of component is more for depreciation purpose and de-recognition purpose. Then, now let us assume that at the end of 5 years, when we had to carry out inspection and overhaul, it costed us 6 million. Now, what we will do is, we will add that to the component of inspection, we will add it to the item of PPE and de-recognize the existing carrying amount, which itself is 0. So, overall cost in year 6, you will add it to this line, overall cost. The total addition will be 6 and carrying amount after overhaul will be for the ship component 11.25 and for this major inspection component it will be 6 and the total will come to 17.25. Now, this 11.25 will continue to depreciate at 0.75 per year for the next balance 15 years, And now this major inspection, which has a useful life of 5 years, will depreciate it at 1.2 million per year. So, per year, here it does not change, it continues at 0.75. Here it will be 6 divided by useful life of 5 years, 1.2. And if at all laws change, regulation change, later on they say that it is useful only for 3 years, accordingly we will do the depreciation calculation. So, if you have to do depreciation for year 5, year 6 to 10, it will be 0.75 for 5 years, which is 3.75, and 1.2 for 5 years, 6, right. So, that is the total depreciation. And then carrying amount at end of year 10 will be, here it will be 11.25 minus 3.75, or original cost 15 minus 3.75 minus 3.75, that will be 7.5, right. And here it will be 6 minus depreciation of 6, 0, and the total would be 7.5. Like this, you will continue to do it for the for years 11 to 15 and years 16 to 20, and at the end of the period, this will also become 0. This will also become 0. This is how you will do capitalization of major inspection and overhaul cost. Let's now understand the next aspect, which is measurement after recognition. We also refer to this as subsequent measurement. Now, what do we mean by subsequent measurement? After the initial measurement, let's say at the end of each accounting period, what is done or what can be done. That is what is done under subsequent measurement. We talk about the cost model, we talk about the revaluation model, we talk about depreciation, we talk about when do we stop charging depreciation, we talk about impairment. All these things we discuss, we will begin with depreciation. Now, depreciation, all of you are aware of what depreciation, why is it charged, but here there are specific emphasis on the manner of calculating depreciation and when do we change the method, what happens when we change the method, and when do we stop charging depreciation. Now, for our basic understanding, say for example, there is an item of building is purchased, the building costs 1 crore, the expected life or useful life of the building is say 25 years, and at the end of 25 years, we expect that the building will not take us any value. Now, initially when we purchase that building, because it is expected to give benefit over more than one accounting period, we will calculate that, we will show it as an asset in the financial statement. Now, this 1 crore is the cost which is incurred today, and this building is giving us benefit over 25 years. So, we apply matching principle. This cost also has to systematically be allocated over the period of 25 years. The reason is because we are getting benefit over a period of 25 years, the cost will also be allocated over a period of 25 years. Now, for a simplistic calculation, 1 crore over a period of 25 years per year, the amount comes to 4 lakh. Now, this 4 lakh will be treated as an expense in the statement of profit and loss every year, right? Now, this 1 crore initial cost minus the residual value, at the end which is 0, this 1 crore is called the depreciable amount, and the systematic calculation of this depreciable amount over the useful life is called depreciation. Now, we understood that depreciation will be treated as an expense, but that is not always the case. Say for example, we have a machinery. Now, this machinery is used to produce inventory. Now, this machinery is producing inventory, which is an item of asset again, and the depreciation of such machinery will be added to the cost of inventory. So, it's not always that depreciation will be treated as an expense in the P&L. Depreciation can be added to the cost of another asset if the item of PPE is used to produce or create the other asset. So, if at all inventory is being produced, depreciation in relation to the production of inventory will be added to the cost of inventory, and obviously when we sell that inventory, the cost of goods sold will become the expense in the P&L. Or say for example, you have a machinery which you are using to construct a building. So, there is an item of PPE, it is used to create another item of PPE. So, the relevant depreciation of this machine will be added to the cost of building, and that cost of building will depreciate, right? So, this is the basic understanding of depreciation. Now, we spoke about the cost, then we spoke about the residual value, the value at the end of the life of the machine, we spoke about the useful life. Let's now look at how these items have been described under Ind AS 16. First, let's understand how do we calculate the residual value, or what is the residual value? Do we actually see how much amount we will realize at the end of 25 years and then calculate the residual value? The answer is no. What the standard says is, don't compute the value of 25 because that value is the future value. Today, look at an asset which is of similar age and condition of this asset after 25 years. Meaning to say, assume that this asset has been used for 25 years. It is in a condition that it has been used for 25 years. After that, you say, what is the value you will get if you dispose of that asset? Say for example, in today's market, a 25-year-old machine of similar condition and nature is available for 1 lakh. So, this 1 lakh will become the residual value. You are not calculating the residual value at the end of 25 years. You are looking at the current market value of similar asset, which will be of similar condition as this asset after 25 years. So, you are not calculating the future value and the present value. You are getting the current market value of an used asset. So, that is how you compute the residual value. And obviously, some cost is being incurred to dispose of the asset, that will be reduced from the residual value. So, you understand how we compute the residual value? And the depreciable amount is cost minus residual value. So, let us say we are talking about a machine, the cost is 10 lakhs, the residual value we have computed as 1 lakh. This 10 lakhs minus 1 lakh is the depreciable amount. And what is depreciation? The systematic allocation of this depreciable amount is called depreciation. Now, we said cost minus residual value, but at a later stage we will understand that sometimes an entity may choose to revalue the asset. So, if an entity is choosing to revalue the asset, then you will not use cost, you will use the revalue amount. So, what is depreciable amount? Cost or any other amount substituted for cost minus residual value. This depreciable amount is systematically allocated over the useful life of the asset. Now, the next question becomes, what is this useful life? Like we said, there is a 10-year life, there is a 10-year period, there is a 25-year period, what is the asset used? So, what is useful life? How does the standard define this? Now, useful life can be seen from two angles. One, on the basis of time. This is pretty simple and straightforward. The period for which the entity is expected to use the asset or the entity is expected to get benefit from that asset. That is the useful life in terms of time. The other is in terms of production unit. So, the second approach is, don't look at the number of years or number of months, look at the total output that you are expected to get from the use of that property plant, from the use of that item of PPE. Say for example, you have a machine, estimate the units of production that you get over the life of the machine. So, if you use the machine, what is the production that you will be getting? That can also be considered as a useful life, right? Or in some cases, you have a vehicle. How many kilometers will you use that vehicle for? So, that number of kilometers can also be considered your useful life. Now, why is this useful life important? If it is on the basis of time, depreciable amount will be allocated on the basis of time. So, year on year will charge depreciation. If it is on the basis of production unit or any other similar item, then based on the production you will charge depreciation. Now, in the second case, say for example, a machine is expected to produce 10,000 units over the period from the machine being used. So, production estimate is 10,000 units. In the first year, production is 1500 units. In the first year, production is 1500 units. So, the cost of the machine, let's say, is 10 lakhs. Cost of the machine is 10 lakhs. Residual value for amortization is 0. So, the depreciation for the first year when production is 1500 units will be 10 lakhs divided by 10,000 units, you will get per unit depreciation multiplied by 1500. So, that will be the depreciation on the basis of number of units. So, you can use time basis, you can use production basis as well. So, let's look at definitions as given in the standard. Depreciation is the systematic allocation of the depreciable amount of an asset over its useful life. Depreciable amount is the cost of an asset or other amount substituted for cost less its residual value. Residual amount is generally cost, or in case it doesn't value amount also, minus residual value. Then, residual value of an asset is the estimated amount that enterprise would currently obtain. So, please understand, you're talking about the current value from disposal of the asset after deducting the estimated cost of disposal if the asset were already of the age and in the condition expected at the end of its useful life. So, this is what we're trying to do. You're calculating out what will be the today's market value or what will be the today's sale value of an asset
which has been used or which has completed its useful life. And finally, useful life is the period over which asset is expected to be available for use by enterprise. So how long is the what is the period over which enterprise will use the asset, or number of fractional units expected to be obtained from the asset by an enterprise. So we understood about number of units of production equity. This tends to be number of hours used. See, it is purely the judgment of the entity as to on what basis they want to conclude the useful life. Say for example, a company purchases a car, and this car generally can be used for 10 years. But the company has a policy that any car which is older than 5 years will be sold off or will be disposed. Means the company is expecting to use the car only for 5 years. Though the life of the car will be 10 years, but the company by policy does not use any car which is older than 5 years. Meaning the car whatever is the reason. Now in such a case, what should be the useful life? Should we say the useful life is 10 years, or should we say the useful life is 5 years? The useful life in such a case should be 5 years because the entity or the company is getting benefit from the car only for a period of 5 years. So useful life will be considered to be 5 years in such a case. And at the end of every accounting period, an entity must review the estimate of its residual value as well as the useful life. Now we spoke about the definition of item of PPE. We said that this item of PPE is expected to give economic benefit in the future. And how is the enterprise getting economic benefit? By using it, right? Because you are using that asset, based on that usage you are getting economic benefit. And against these economic benefits, you are charging the depreciation. So one more thing I think is not only the consumption of the asset is giving economic benefits. What also happens is over a period of time as the time passes, because of technology changes, because of wear and tear, because of other physical usage, or because of the machines remaining idle, because of all these factors, the economic benefit in the future might be reduced. So let's say there is a new advanced technology developed in the market, the current machine that you are using may not be as beneficial as the new technology. So there is a diminution or there is a reduction in the economic benefit that you get in the future. And a part of the depreciation charge also because of these factors. And all of these factors should go into determining the useful life of that asset. Generally, an asset may be useful for 10 years, but you know after 4 or 5 years there may be a significant technological change, and because of which that machine may not be useful at all after 5 years. So you have to keep in mind all of these factors when you are estimating the useful life of that asset. So standard prescribes certain factors which must be considered while determining the useful life of an asset. It does not prescribe which asset should have how many years of useful life. It is completely the judgment of the management as to how much will be the useful life of particular asset. And obviously we have the Companies Act prescribing useful life for certain specific assets. Now let's look at the factors which must be considered to determine the useful life of an asset. The first one is expected usage of the asset. So what is the capacity of the asset, what is the output from that specific asset, how long are we expecting to use that asset? That's the first factor. Then expected physical wear and tear. Now this basically depends on the manner in which you are using that asset. If you are using an asset for double shift, then obviously the useful life will be lesser. Or let's say you have a truck, one truck you are using on a highway, other truck you are using on a hilly terrain, or you are using on a road is not in very good condition. So both of these trucks will have different useful life because the wear and tear will be different. Also how much of repairs and maintenance you are doing, how are you maintaining those specific assets, these will decide how much will be the useful life of that particular asset. The third factor which is much more relevant these days is the rate of technological changes. If technology changes very fast, the expected life of the asset will be lesser. To give a very simple example, a mobile phone earlier might have been used for 3 years or 4 years. Technology changes not so much. But today if you compare, a smartphone may last for 1 year or 2 years because technology changes very fast. You want to upgrade the latest technology. When it comes to a company, let's say you have a machinery, after 3 years, a machine with advanced technology has come up. So maybe this machine gives 10,000 units per month output. The new machine of similar cost gives 20,000 units per month output. It also saves cost. Now in such a case, the same price will start falling in the market. It could be an indication that the current machine may not be useful. You unless you switch to the newer machine, you will not be able to survive the price cuts in the market. So that could be another aspect to look at. And one more factor to look at would be the legal restrictions. Say for example, you have taken a land on lease and at least for 15 years. And on that lease land you have constructed a building. The building has a life of 25 years. But because the lease service is for 15 years, you cannot use the building for more than 15 years. So the useful life will be restricted to 15 years. These are all the factors which must be considered when you are determining the useful life of the asset. And then we emphasize an entity must reassess the useful life as well as residual value at the end of each accounting period. What happens when these changes will understand this? Let's take the case of land and building which are purchased together. Say for example, a company purchases land and building, they pay 1 crore. Now when it comes to depreciation, we know that we need to cost of 1 crore. We need to residual value, we need to that as well. And we also need to useful life. When we purchase land and building together, what is the useful life of land? Land generally has unlimited useful life. The life of land is unlimited. There is no end to life of land. In some specific cases, there may be no limited life. That is, if you are bound by legal terms, if you contract only for a specific period of time, or the asset has to be given back after more than 15 years. In such a case, land may have a limited life, but otherwise land has a limited life. And building which is constructed on top of the land has a limited life. Say building has a life of 25 years. Land has a limited life. Now, how should we depreciate? Can you say that I depreciate over a period of 25 years? Because there is a component of land and there is a component of building. So you have to separate land and you have to separate building and then you have to depreciate accordingly. Land because it has a limited useful life, it will not be depreciated. Building will be depreciated over the useful life of the building. Now, in some cases, when let's say land is purchased, and it already has a building in place. It already has a building in place. And to use the land, you have to dismantle that building. There is a land on which there is already a building. The building is of no use because it may be some old structure. So you have to demolish that building. And to demolish that building, let's say we got 10 lakhs. To purchase the land, you have to pay let's say 1 crore. So 1 crore and 10 lakhs is the expenditure. Out of this, 1 crore which is paid towards the land, that cannot be depreciated because land has unlimited life. But the structure which you have dismantled, the cost that you incur to dismantle that structure, you have to see how long will you be using it, how long will you be getting benefit out of that demolition. Let us say you want to use the vacant land for 10 years. So the cost of dismantling will be depreciated over 10 years. Right? So this is again more of a management judgment and management estimate. But the cost of land cannot be depreciated because land has an unlimited useful life. Unless the land itself has a limited useful life because of some contract obligation, because of some law, because of some regulation, in that case you will depreciate it over useful life. But otherwise you will not be depreciating land because land has unlimited useful life.
Let's now have a look at the next aspect, which is component-wise depreciation. We'll extend the example of land and building which we just spoke, and we will see how do we depreciate an item of PPE based on the components. Now, the reason for having this component of depreciation is because each component of an item of PPE may have a separate useful life. For example, you purchase land and you purchase building. Now, land itself has unlimited useful life, not depreciated. Building has a life of 25 years, depreciated over a period of 20 years. But in the building, you have a component, let's say painting. You have painting is another building. What is the useful life of that paint? What is the useful life of that paint? 25 years. After 5 years, 7 years, you have to repaint the building. Which means the painting has useful life only 7 years or 5 years. What will you do? Building structure has useful life of 25 years. Now, what the standard describes is land you won't depreciate. Building structure depreciate over a period of 25 years. Painting depreciate over a period of 5 years. Similarly, there is another component. It has significant value. Separate that component for depreciation purpose. So does it mean that I will say building separate amount of balance sheet, painting I should have separate amount of balance sheet, you combine both of them for the building. But for depreciation purpose, you will do component-wise depreciation, right? So any component which has a significant proportion, you will compute the depreciation separately. Similar to the case in the aircraft. Now, the aircraft body have a life of 30 years. The seats inside the aircraft have a life of 10 years. So you depreciate the aircraft structure over a period of 30 years. The furniture, the seats, you depreciate over a period of 10 years. The engines have a life of 15 years. You depreciate over a period of 15 years. Right? Now, like this, you have to identify significant components. Now, don't go to the section saying that there is a wash basin, there is a tap in the wash basin, the tap has useful life only 2 years. You're not doing that. Significant portions, you identify components, and balance, you aggregate it as a separate component and depreciate it over an estimated useful life. See, one thing we understand is it need not be accurate to the last percent. Maybe the tap is used for 2 years or 3 years. Maybe some other items used for 1 year, but the amount is not significant. All these insignificant parts of components you group together, you call it as a zero component and charge depreciation based on the estimated useful life. Right? But for larger components, you have to calculate the depreciation separately. So, continuing the aircraft example, say for a moment that the body will be used for 25 years, the engine also will be used for 25 years, and the method of depreciation in both cases is the same. When you combine them and then compute the depreciation, in that case it's possible. So, if a component has a method of depreciation and useful life which is same as another component of the same item of PPE, you can get that. But if the useful life is different or the method of depreciation is different, if the pattern in which you get the benefit is different, then you have to separate the components and calculate the depreciation. So the next question to come up is how do we determine what is real, what is significant component, what is not significant component? See, there's ultimately judgment of the management. How much will impact the statement of profit and loss? How much will impact the calculation of depreciation? All of those things are taken into account when we are deciding whether a component is significant or not. Right? If a component is significant, you calculate the depreciation separately. If having a component-wise depreciation will have material impact on financial statements, again, they will choose to the component-wise depreciation or component-wise accounting. Items that are insignificant, which will not impact materially financial statement of vendors, such things can be grouped together and you get as a component. And as I discussed earlier, if there is any inspection on this overall, such items will also be treated as a separate component for the purpose of calculation of depreciation.
Let's now understand when we start charging depreciation and when we stop charging depreciation. Starting very simple. The moment asset is available for you, that is to say, it is in a position, it is in a location to be operated in the manner that is intended by the management. Means the way you want it, the way the management wants it, the asset is ready. The asset is in the condition, it is in the location, it can be operated as intended by the management. The moment it is available for you, you will start charging depreciation, irrespective of whether you use the asset or not. The simple reason being depreciation also accounts for passage of time. It is not only active usage. So even if it is idle, you will start depreciation. So there is no confusion on that. When do we stop charging depreciation? Now to stop charging depreciation, you have to do two things. First one, if the asset is de-recognized. If the asset is de-recognized, the moment the asset is de-recognized, you need to say you have no asset on the books of account, then you also stop charging depreciation. Or it is held for sale or disposal. It is held for sale or disposal as per Ind AS 1.5. Now in among these two dates, whichever is the earlier date, on that date you will stop charging depreciation. So to summarize, depreciation will be charged the moment the asset is available for use, and depreciation will stop at the earlier date of de-recognition or the date on which it is held for sale as per Ind AS 1.5. Like earlier of these two dates, you will stop charging depreciation. And the case where we will not charge depreciation or where we stop charging depreciation is when the residual value of the asset is greater than the carrying amount. Now, say for example, the purchase machinery, the cost of machinery is 10 lakhs and the residual value is expected to be 2 lakhs and the useful life is 8 years. Okay? So what is the depreciation amount? 10 lakhs minus 2 lakhs, 8 lakhs is the depreciation amount and 8 years is the useful life. Every year you charge 1 lakh of depreciation. Say you charge depreciation year 1. So the opening cost is 10 lakhs, you charge depreciation of 1 lakh, the closing value of the asset or the carrying amount of the asset is 10 lakhs minus 1 lakh, 9 lakhs. So when you start charging depreciation year 1, original cost is 10 lakhs, you charge 1 lakh of depreciation, the carrying amount at the end of year 1 is 9 lakhs. Next year you charge 1 lakh of depreciation, the carrying amount will become 8 lakhs. Like this you continue to charge depreciation and say at the end of the 7th year you charge 7 lakhs of depreciation, the carrying amount has now become 3 lakhs. And at that point of time you realize that the residual value actually is 4 lakhs. So estimate that we had earlier that the residual value of 2 lakhs is no longer valid. The current estimate of residual value is 4 lakhs. What is the carrying amount? 3 lakhs. Now in such a case you will not charge further depreciation because you reduce the carrying value further because you understood that depreciation is the allocation of depreciable amount which is the difference between the cost and the residual value. So if the residual value now is 4 lakhs and you have already and the carrying value in the books is at 3 lakhs, you will no longer charge depreciation. So in such a case you will stop charging depreciation. Obviously in the future again you realize that the residual value has fallen down further, then you will start charging depreciation. That is one scenario where you stop charging depreciation. The other scenario where you will not charge depreciation is when you are following production unit method and no production happening in a particular year. In that case also you will depreciation charge, right? So if you are following the production unit method and no depreciation happens, you will not charge depreciation. Now in this scenario the carrying amount of an asset is 3 lakhs, that is at the end of 7 years. The residual value is estimated is still 2 lakhs, but the fair value of the asset is 4 lakhs. So carrying amount is 3 lakhs, residual value is still 2 lakhs and the fair value estimated is 4 lakhs. Now in such a situation, do we stop charging depreciation? The answer is no. Even if the fair value of the asset is higher than the carrying amount, that does not mean that you will not charge depreciation. Okay, you will still continue to charge depreciation till the time the carrying amount is greater than the residual value. If carrying amount is equal to the residual value, you will not charge depreciation. Or because of changes in circumstances, the residual value is more than the carrying amount, even then you will not charge depreciation. And you don't be like because we are carrying out huge depreciation, we will not charge depreciation. We are no, we are spending a lot of money on interest, that is self-expense. We will not want to expense depreciation in the books. That's what is more. You need to charge depreciation irrespective of whether you are using the asset, even the asset is idle, even then you will need to charge depreciation.
Let's now understand how should the depreciation be calculated or what is the depreciation method which an enterprise should adopt. Now, there are no prescribed methods in the standard. What the standard prescribes is you need to charge depreciation using a method which reflects the pattern of consumption of economic benefits by the enterprise. So, basically, how are you consuming the economic benefits of an asset? The depreciation method should reflect that. Say for example, if the entity expects that the benefit will come out evenly in each of the year of usage, then maybe a straight line method can be used. If the entity believes that initially they will get more benefit, in the future period they will get less benefit, they may use written down value method. Or if the entity believes that the production units or the output is the best estimate of consumption of economic benefits, then production unit methods can also be used. So, depending on what is the pattern of consumption of economic benefits, you have to decide or you have to determine the depreciation method. It could be a straight line method, it could be a written down value method, it could be a method based on production units. The depreciation method used shall reflect the pattern in which the asset's future economic benefits are expected to be consumed by the entity. So, there is a lot of emphasis on expectation, future. So, basically this also becomes an estimate. And this method of depreciation also should be reviewed at the end of each period. And if at all there is a change in depreciation method, it has to be accounted for as a change in accounting estimate as per Ind AS. Same thing happens in case of change in estimated useful life, same thing happens in case of change in estimated value. You will treat them as change in accounting estimate. So what we do is we take a simple example and understand quickly how we use the standard method of depreciation, the WDV method of depreciation, the production unit method of depreciation, and then we understand what happens if there is a change in method of depreciation, how we account for that. Let's look at the illustration and understand how we calculate depreciation using the standard method, the WDV method, and then we use a example to understand the production unit method. And if we acquired an asset 3 years ago at a cost of 5 million, so the cost of the asset, the depreciation method was 10% reducing balance method. So the depreciation method we follow is the reducing balance method. We are not using the residual value, not even the useful life. So at the end of the year, we have estimated that the minimum useful life will be 8 years, and then we decide to adopt the straight line method. We understand how we calculate depreciation straight line method, though all of you are knowing it. Straight line method from that date so as to reflect the revised estimated pattern of economic benefit. So the same treatment in accordance with Ind AS 16, calculate the depreciation charge respectively. So we need to calculate the depreciation for year 1, 2, 3, and then year 1, 2, 3 as per WDV, and from year 4 till year 11 we need to charge as per SLM. So what we do is first we calculate the WDV and then we move on to SLM method. Let's now have a look at how we calculate depreciation on reducing balance method, or you also call it the WDV method, written down value method. Base means how we calculate the depreciation. The question is, if the purchase at 5 million is 50 lakhs and the rate of depreciation is only 10%. So for year 1, what is the cost? The cost is 50 lakhs, and then the question is 10% depreciation on reducing balance. You have to see what is the carrying amount of that asset. Now, what is the carrying amount? The original cost minus estimated depreciation. That becomes the carrying amount. So whenever we are charging depreciation, we have to charge depreciation on carrying amount. Now because it is beginning of year 1, there is a depreciation charge, so 50 lakhs becomes the carrying amount. What is depreciation? The question mentions that depreciation is at 10%, right? And this closing amount, which is nothing but opening value minus depreciation, is also called as carrying amount. Right? So whenever we say carrying amount, what is carrying amount? Carrying amount is nothing but the cost minus accumulated depreciation. Okay. So year 1, opening balance is 50 lakhs, depreciation at 10%, 50 lakhs multiplied by 10%, this is your depreciation at 5 lakhs. What is the carrying amount? 50 lakhs minus 5 lakhs, 45 lakhs, that is the carrying amount. So if you want to know carrying amount is total cost or initial cost minus accumulated depreciation. Right? Come to year 2. Now here the opening carrying amount, opening balance will be 45 lakhs. On this depreciation at 10%, multiplied by 10%, 4 lakhs 50, 45 lakhs multiplied by 10%, you get 4 lakhs 50,000, and 45 lakhs minus 4 lakhs 50,000, the carrying amount will be 5 lakhs 50,000. The other way to look at this carrying amount is cumulative depreciation. What is cumulative depreciation? 5 lakhs plus 4 lakhs 50, 9 lakhs 50,000. This is the cumulative depreciation. 5 lakhs plus 4 lakhs 50,000, 9 lakhs 50,000 cumulative depreciation. So 50 lakhs minus 9 lakhs 50,000, you get the carrying amount of 40 lakhs 50,000. This is the opening carrying amount. Then depreciation and closing carrying amount. Come to year 3. Opening carrying amount is 40 lakhs 50,000. Depreciation 10% of this.
closing carrying amount is 36 lakh 45,000 minus 4 lakh 36 we can calculate net depreciation, reduce the amount from original cost to get the carrying amount. So this is how you calculate depreciation using the written down value method. But one thing that you can also understand is the depreciation of second year will be 90% of the depreciation of first year. So what I'm trying to say is 5 lakhs, if you calculate 90% because 10% is depreciation and the book value of the carrying amount is reducing by that 10% amount, the next year depreciation will be 10% less than the previous period depreciation. So this 4 lakh 50,000 is 90% of 5 lakhs. This 4 lakh 5,000, this one is 90% of 4 lakhs 50,000. So this one quicker way to calculate depreciation when using the written down value method. If you are not required to prepare a table, you can do it mathematically as well, right? So at the end of year 3, the amount is 36 lakh 45,000. Now in this question, we have been specifically asked to calculate depreciation for every year. So depreciation for year 1 is 5 lakhs, for year 2 is 4 lakhs 3,000, for year 3 is 4 lakhs 5,000. Now is there a shortcut to arrive at this arrive at this carrying amount or the written down value? Sometimes we refer to written down value, right? Is there a shortcut to arrive at this 36 lakh 45,000? Yes, there is a formula, that is amount or WDV is equal to cost multiplied by 1 minus rate of depreciation to the power of n to the number of years. So what is the cost? Cost is 50 lakhs multiplied by 1 minus rate, so 1 minus 0.1 to the power of n to the power of n here is 3. Okay, so if you do that, 50 lakhs into 1 minus 0.1 is 0.9 to the power of 3. Right? We get 36,45,000 is the same number. So if in case you want to calculate year depreciation, you can directly calculate the WDV is 36,45,000. Now after the end of year, we have changed the rate of depreciation and we have to consider that change in accounting estimate as per Ind AS 8. Okay. Now what do we mean by change in accounting estimate? You will give the effect of it only for the future year. You will not go back and do a retrospective adjustment. If you remember accounting standards which were there earlier, they will require to do some retrospective adjustment. But now we are only doing adjustment for the future. Now when we are doing adjustment for the future, now we need to see what is the depreciable amount. What is the depreciable amount? Now in our case, depreciable amount is no longer 50 lakhs. Here we need to substitute this 36 lakhs 45,000 in place of original cost. So earlier cases when we calculated depreciation, we directly said cost minus residual value divided by the useful life. But now here we will not use cost. We have to use this amount which is substituted for cost. So what do you say? Depreciable amount is equal to 36 lakhs 45,000. Depreciable amount is equal to 36 lakhs 45,000. Calculation of depreciation under SL is the straight line. Okay. Now did they mention anything about residual value? They are not anything. And they have said that the remaining useful life is 8 years. So useful life is 8 years. What is the depreciation? Depreciation for year 45 divided by 8 is 4,50,600. Now this depreciation will be charged from year 4 onwards to year 11. So for year 1, year 2 and year 3, depreciation is 5,50,000 and 4,50,000. After that depreciation is 4,50,600 per year. So let's see, this is not required by the question, but let's see how will the carrying amount grow when we start charging depreciation at 4,50,600 per year. So we have year 4, 5, 6, 7, 8, 9, 10 and 11. These are the years left. Okay. What is the opening carrying amount? 36.45. Right? What is the depreciation? It is 4,55,600. What is the closing carrying amount? 36.5 minus 455, 31,975. Again, opening carrying amount 39,975. Depreciation 4,55,625. Closing carrying amount 31,975 minus 4,55,625 is 733. So if you just calculate that till 11th year, you will see that at the end of the 11th year the carrying amount is 0. This is what it is. Now sometimes what happens is, the depreciable amount we have some residual value. Let us assume for a moment, just in this example, let us assume that there is a residual value of 1 lakh. Okay. So what is the depreciable amount? Depreciable amount will be 36, 45, 1, 2, 3, 36, 45,000 minus this 1 lakh will be 35 lakh 45,000 and depreciation amount will change to 440. And once you charge the depreciation, you see at the end of the useful life, the carrying amount is 1 lakh which is equal to the residual value. Most cases will not charge any depreciation. Right? So this is how we calculate depreciation under SL method and written down value method.
So as you have observed that when we applied the reducing balance method or the WDV method, the depreciation was high in the initial period and it started falling down in subsequent periods. Right? So if the entity believes that is the pattern which reflects upon consumption of economic benefits, then the entity can use WDV. Or they can use SL values of each year equal amount is charged as depreciation. Or the entity can use unit of production as a basis to compute the depreciation. Whenever we say unit of production, what the entity does is it calculates the estimated production over the life of the asset and based on the production on year-on-year basis, it charges depreciation. Say for example, an entity expects to produce a total of 10,000 units from use of a particular property plant and equipment. So the total production is 10,000 units. Year 1 estimates to produce 2,000, year 2 estimates to produce 5,000 and year 3 estimates to produce 3,000 units. 2,000, 5,000, 3,000. Now if the depreciable amount is 10 lakh, assuming the depreciable amount is 10 lakh, then in the first year the amount of depreciation will be 10 lakh divided by 10,000, that is the total expected production multiplied by 2,000. So in the first year you have 2 lakhs, in the second year you have 5 lakhs, and in the third year you have 2 lakhs. So this is the way in which you calculate depreciation whenever you are using unit of production. Now please note, unit of production doesn't mean sales. Unit of production doesn't mean sales. You cannot say that I will charge depreciation based on my revenue. Revenue is something which is a result of usage of property plant and equipment, other inputs that go into the production process, other marketing efforts, administrative efforts. There are so many factors which impact the revenue. So it is not appropriate to charge depreciation based on revenue. You can charge based on usage. You can charge based on unit of production, but you cannot charge it based on the revenue. So always remember, depreciation cannot be charged in proportion of revenue. Right? This is one important thing that you need to keep in mind. Now we have understood that there are different methods of charging depreciation. Can they keep on changing the method of depreciation whenever it wants, or should be applied consistently? So generally, the entity should apply a method of depreciation consistently from one period to another period. It cannot change the method of depreciation as and when it likes, but they have to review the method of depreciation at the end of each period. And if at all there is an indication that there is a significant change in the pattern of consumption of economic benefits, then change the method of depreciation. Right? And it will be applied prospectively as we have seen our example just now. So the method of depreciation has to be consistently applied. They cannot be changed as and when the entity wants. It has to be based on a proper evaluation of the pattern of consumption of future economic benefits. Let's now understand whether an entity can use different method of depreciation for the same category of same class of assets. Say for example, the entity has a bottling unit and the entity acquired another bottling unit. Okay, so there is one bottling unit the entity already has and they acquired another bottling unit. Now the existing bottling unit was depreciated using a straight line method. Whereas for the new bottling unit, the entity wants to use a written down value method. Can it do so? Now you see, the assets are similar and generally similar assets are expected to give similar kind of economic benefits. The pattern of economic benefits will also be the same. So in such cases, it is not advisable to have different methods of depreciation for similar kinds of assets. But if the assets are used in different conditions, different environment, we give examples of it. A truck which is used on a highway versus a truck which is used in let's say some rural roads where the roads are not proper, the expected life will be different or the method of depreciation will be different. That is possible. But generally, if the pattern of economic benefits are similar, then an entity should not use different methods of depreciation. Let's have a look at an example to understand how we compute depreciation when there is a change in useful life. An asset which costs 10,000 was estimated to have useful life of 10 years and residual value of 2,000. So initially when we purchase, estimated life of 10 years and residual value of 2,000. After 2 years, useful life is divided to 4 years. So this is important. When it initially got at the inception, let's say year 0, when we say it's the start of a period, from there it was 10 years. Okay, that's estimated. Then year 1 passed on, year 2 passed on, and then year 2. Now we are saying it is only for next 4 years. That is, by end of year 6, the asset will have exhausted its useful life. And we need to calculate depreciation for year 1, year 2, and year 3. Let's get that. When we know the cost of the PPE is 10,000, residual value is 2,000, and the useful life is going to be 10 years. Okay, first we need to calculate what the depreciable amount. Depreciable amount is the original cost minus the residual value. So cost minus residual value will give the depreciable amount. 10,000 minus 2,000 is the depreciable amount. This is the cost minus residual value. Okay. Now what is the depreciation? The original cost is 10,000, 2,000 is the residual value. The depreciable amount is 8,000. To be depreciated over 10-year period. So depreciation per year over 10-year period is 8,000 divided by 10 years, that is 800 per year. So every year you charge 800 of depreciation. Okay. Now what happened? At the end of year 2, the revised useful life is 4 years. So first we need to calculate what is the carrying amount at the end of year 2. Okay. So carrying amount at the end of year 2. What is the original cost? Original cost is 10,000. Depreciation for 2 years. If depreciation for 1 year is 800, depreciation for 2 years will be 800 into 2, which is 1600. So carrying amount at end of year 2 will be 10,000 minus 1600, which is 8,400. Now from here, at the end of year 2, the revised estimated life is 4 years. What is the residual value? The residual value still is 2,000 going to given. Now what is the depreciable amount here? The depreciable amount will be 8,400 minus 2,000. Now this 8,400 is amount substituted for original cost. Right? Remember the formula? Original cost or amount substituted for original cost. Now this 8,400 is the amount substituted for original cost. So now depreciable amount at end of year 2 will be 8,400 minus 2,000, which is
6,004. 400. This is the depreciation amount. What is the remaining useful life? Remaining useful life is 4 years. What is the depreciation? Depreciation for year is 6,400 by 4 is 1,600. So depreciation for year 1 and year 2 will be 800, and depreciation for year 3 onwards, 3, 4, 5, and 6 will be 1,600. So this is how we calculate depreciation whenever there is a change in useful life. Similar process will follow if there is a change in physical value.
Let's now understand how do we treat components whenever they are replaced, how do we calculate the depreciation, how do we recognize the fresh component, and what do we do with the existing component. Now if you remember, we took an example of building. We had purchased a building and that building had a component of painting as well. The building had a useful life of 25 years, the painting had a useful life of 5 years. Now after 5 years, when we carry out a fresh coat of painting, we are incurring certain cost, and this painting is again expected to be used for another 5 years. So what do? The fresh painting will be capitalized. We will have to recognize it as an item of PPE. So that is one simpler aspect. But what about the existing painting? And when we initially capitalized the building, we did not segregate how much is building, how much is painting. Like this, there would be many other parts. We did not segregate those parts. We said entire building cost is 1 crore and we have capitalized that in the books of accounts. Now after 5 years, we have to identify what is the cost of that painting which has to be de-recognized, which has to be removed from the books of accounts. Now how do we do that? Do we go back to the builder and say, hey, how much did you incur for the painting? What is the cost of that painting? It will be very difficult. So what we can do is, whatever is the cost of painting today, calculate the value, it would have been 5 years prior to that using the appropriate discount rate. So what I'm trying to say is, go back 5 years, assume that at the beginning of the period, and today at the end of year 5 is when you are incurring, let's say, 1 lakh on fresh coat of painting. So this 1 lakh is as good as a future value for something which you have incurred 5 years back, right? So something which you have incurred at year 0, and if you take it forward by 5 years, that will be the value today. So assuming that this discounting rate represents the increase in the cost of painting, use the discounting rate to discount this present cost, take it back 5 years. So that is what we do. We take the future value and then we discount it to the present. What I'm telling you is, take this present value, assume that this is the future value standing at year 0 and take it back by 5 years. So if you discount it back by 5 years, whatever value you get, that will be the cost of painting. So assume that this calculated present value, if you take it back by 5 years, whatever is the cost, that is the cost of painting, and that is a separate component. And accordingly, you will recognize that portion and getting a new portion, that is cost of new painting. So we take our illustration, work it out and see how we do this calculation. Let's look at the question. MS Limited has acquired a machinery at a cost of 1 crore with no breakdown of the component. They purchased machinery and there is no breakdown of the component part, which means they have calculated everything as a single item. And you know, which means they have calculated everything as a single item and depreciation value computed accordingly. The estimated useful life is 10 years. At the end of the 6th year, so what happened? You purchased, let's say, at year 0 at the beginning of the period, and at the end of the 6th year, at the end of year 6, what's happening? One of the major components, the turbine requires replacement as per the maintenance and economical. So you have used the machine for 6 years, and after 6 years you realize that the turbine, which is one of the major components, needs replacement. The remainder of the machine is perfect and is expected to last for the next 4 years. So initially what we thought was 10 years, the entire machine will run for 10 years, but this component has become unusable at the end of 6 years. The cost of new turbine is 45 lakhs, so when you purchase new turbine at the end of 6 years, which is 45 lakhs, and the discount rate assume this 5%. So the discount rate, why is this discount rate given? Because you have to identify what is the cost of this turbine at the beginning, at year 0, what is the cost of the machine, what is the cost of the turbine. So for that, we have to use this 5% discount rate. Take this 45 lakhs, 2 plus 2 year 0 and calculate the present value. So think of it this way, you're standing at year 0, at the end of year 6, the value of the cost is 45 lakhs, bring it back to year 0, discount it to year 0 for which the rate is going to be 5%. The question is, can the cost of the new turbine be recognized as an asset? That's the first question, and if so, what treatment should be used? The first aspect is, can we recognize the cost of the turbine as an asset? So for that, we need to see the two conditions which have to be fulfilled for recognition of an item of PPE as an asset. What are those two conditions? One, future economic benefits should flow from the enterprise. Will future economic benefits flow? Yes, you will use the turbine for the next 4 years, that is still the end of the life of the machine, and you will get economic benefits from the use of that turbine. That's the condition satisfied. Can we measure the cost? Yes, we have to spend 45 lakhs, we can also measure the cost. So because these two conditions are satisfied, the cost of turbine should be recognized as an asset. Basically, you will capitalize 45 lakhs, that is very clear. Now since we are capitalizing this cost of 45 lakhs, should we not remove the earlier cost of turbine, whatever was the cost that was incurred for the original turbine, that has to be recognized from the books. Now how do we do that? Now for that, we have to discount this 45 lakhs, calculate the present value 6 years prior, okay, and then see what will be the cost, calculate the proportionate depreciation part, and the balance amount will be recognized. We'll solve this problem, and after that I'm showing you the absolute clarity as to how do we handle such situations. Now let's calculate the value of this turbine 6 years back. So considering today as a future value, we have to go back 6 years and see what will be the present value at that point in time. So current cost of turbine is going to be 45 lakhs, okay. Discount rate is going to be 5%. We need to calculate value turbine 6 years back. So actually calculate value turbine 6 years back. Now if this value turbine 6 years back was P, that means present value at that point of time. Future value, today's value is equal to the present value then multiplied by 1 plus rate of interest, that is R, 5% to the power of 6, correct? So by applying this formula, we can calculate what is the value 6 years back. So P would be equal to what? Future value divided by 1 plus 5%, that is rate of interest to the power of 6. So what is the future value 45 lakhs divided by 1.05 to the power of 6, right? So that comes to 33 lakhs 57,969, rounded off to 30 lakhs 57,970. Okay, so this rounded off to 33 lakhs 57,970. Just make sure you know the depreciation calculated properly. Right? So what does this represent? This represents the estimated cost of turbine 6 years back. Estimate the cost of turbine 6 years back. Now, what did we do? We depreciated the entire cost of machine over a period of 10 years. And if you assume that the was followed, we have depreciated over 6 years by applying straight line method. So, you have to calculate two things. One, what is the current carrying amount of the machine in the account? So, original cost. For the machine, what is the original cost? 1 crore is the original cost. How much depreciation you have charged? You have charged depreciation of 10 lakhs per year. Why? Because 1 crore has to be depreciated over a period of 10 years. There is no residual value. So, depreciation would be 1 crore divided by 10, that is useful life, multiplied by 6. 1 crore divided by 10, so that gives you 10 lakhs for 6 years becomes 60 lakhs. So, you have charged depreciation of 60 lakhs over a period of 6 years. What is the current carrying amount? Carrying amount at the end of 6 years would be 1 crore minus 60 lakhs, that is 40 lakhs. Now, what's happening? We are adding a new component and we have to recognize an existing component. Let's split this machine. There are two parts. One, turbine. The other part is other component. We have turbine and other components. Now, this machine has turbine and other components. If I depreciated 1 crore assuming 10 years of useful life, even the turbine, which is a part of the machine, would have been depreciated considering useful life of 10 years. So, my cost of turbine is 30 lakhs 57,970 estimated. For this, how much will be the depreciation? For this, the depreciation would be 30 lakhs 57,970 divided by 10 multiplied by 6. The depreciation comes to 20 lakhs 14,072. So, what is happening? Let me just write down. So, turbine will be depreciated by 30 lakhs 57,970 divided by 10 multiplied by 6. So, this will be the depreciation for turbine. This is the depreciation for overall machine. This is the depreciation for turbine. Which also means the other component, what is the balance component? 1 lakh, 1 crore minus 30 lakhs 57,970 comes to 66 lakhs 14,030. This also will have been depreciated considering an estimated useful life of 10 years. So what is the depreciation here? 66 40,030 divided by 10 multiplied by 6, we get 39,85. What is the carrying amount?
Carrying amount of turbine would be 37,970 minus 21,782, and carrying amount of other components would be 66,42,030, and 39,520. See, we not calculate the components separately. Once you know the total carrying amount of machine is 40 lakhs, and the turbine is estimated to be 13 lakhs 40,000. This is basically the difference between 40 and 40. That's it. So what have we done? We have split the carrying amount of 40 lakhs into turbine which is 13 lakhs 40,000 and others which is 26,688. Now think of it logically. If I replace the turbine, this one, this 13 41,188 is going out. Correct? If I replace this turbine, something which has a carrying amount of 13 lakhs 40,188 is going out from the books. We will de-recognize that, and to the balance which is 26 lakhs 56,812, we will add the cost of two turbine, and this two will be depreciated over the balance useful life. So what will happen is you de-recognize the existing turbine, that is 13 41,188, and from yours you remove the 13 188, and so you de-recognize the existing turbine and new turbine will add 45 lakhs. Okay, this is going to the turbine. What is the device carrying amount? Device carrying amount will be original carrying amount 40 minus the part minus 13, then add 45 71,68812. 71,68812 out of this turbine will be 45 lakhs, and the other component will be 26,68812.
So let's have a look at a comprehensive problem where we will understand what are the costs to be included, how do we do this component-wise segregation, right? And how do we charge depreciation? All of those things we will understand in this question. On 1st April of year 1, Sun Limited purchased some land for 1 crore, including legal costs of 10 lakhs. Now, what does this mean? They have purchased the land for 1 crore and they have incurred costs of 10 lakhs towards legal costs. Now, are these legal costs to be included as a part of the cost of land? Obviously, yes, because these are incurred for acquiring the land. Please remember, cost of land will not be depreciated, cost of land will not be depreciated. So including this legal cost will not be depreciated, you just capitalize in the books account. And the purchase land construction new factory. Construction work commenced first of May and the following first of May. So construction cost, construction gain on first of May. First of April, land purchase, first of May, construction work started. Preparation and leveling of land 3 lakhs. Now, is this cost incurred for the purpose of land or for the purpose of construction of factory? This is for the purpose of construction of factory. So you need to add it to the cost of factory. Then you purchase of materials for construction, the amount given. Employment cost for construction workers, these are again incurred for construction of factory, so that will be included. Then overhead cost incurred directly in construction of the factory, 1 lakh per month, that will be included. Ongoing overhead cost allocated to the construction project using company's normal overhead allocation model. Now, what does this mean? You are incurring some cost somewhere else, maybe the corporate overhead. That you are allocating it to the specific factory which is being constructed. Now, can this be considered as the cost of factory? Can we add this as the cost of factory? We cannot, because it is not incurred for the construction of factory. You are incurring some additional cost. That is not the purpose of the factory. So we will not capitalize this. Then income received during temporary use of factory premises as a car park during the construction period. Whether or not you have used it as a car parking facility, the construction would have continued. It will not affect the construction. Such temporary income will be taken as other income or other income in the statement of profit or loss. You will not be reducing it from the cost of asset. See, the fundamental question I need to ask is it incurred for the purpose of bringing that asset to the current condition of operation? The answer is yes, obviously you should add. If the answer is no, you will not do that addition or deduction. Cost of relocating employees to work at the factory, the factory from there moving the employees to the factory, you will not consider that cost as cost of this particular factory. Then cost of opening ceremony on the first of January, you have done an opening ceremony from party was arranged, 1,50,000 spent. Will you add that to the cost of factory? Is that opening ceremony relevant for construction of factory? That is just a that is just a symbolic thing. That is something you have done to celebrate. That will not be considered as the cost of factory. The factory was completed on 30th of November. So remember the date, 1st of April, land was purchased, 1st of May, the construction was started, 30th of November, the factory was completed, 31st of January, inaugurated, and production began on 1st of February. And it also says that this period of construction is considered to be substantial period as per It indicates that the borrowing cost and interest cost will also be capitalized. The Revaluation Commission will be capitalized that as well. Now, with so many dates in place, you have completed on 30th of November, you have inaugurated the factory on 31st of January, production began on 1st of February. Since when should we charge depreciation? First thing is for land, we do depreciation, keep that right. For remaining assets, depreciation should begin from the date on which asset was available for you. And when was available for you? 30th of November. Irrespective of when you started production, when production was not started, depreciation should be charged from 30th of November or 1st of December. Right? The overall useful life of the factory is estimated at 40 years, and the roof will need to be replaced after 20 years. So the factory will last for 40 years. The roof portion has to be removed after 20 years. So we have to depreciate factory component separately, roof component separately, and the land part will not be depreciated. The cost of replacing the roof current price will be 30% of the cost of the building. So estimate that whatever is the total cost of the building, 30% we can assume that is incurred for the roof. At the end of 40-year period, Sun Limited has a legally enforceable obligation to demolish the factory and restore the site which was condition. So you want to decommissioning cost. The directors estimate that the cost of demolition in 40 years time, based on price prevailing at that time, will be 2 crores. So you have made an estimate that after 40 years, you will incur 2 crores to demolish the factory to level the site. This is the decommissioning cost. And annual discount rate is appropriate for this project is 8%, and the present value of 1 rupee payable in 40 years time at an annual discount rate of 8% is 0.046. Basically, after 40 years, if you have 1 rupee, today's worth is 0.046, okay, 8%. The construction of the factory was partly financed by a loan of 1 crore 75 lakhs taken out on 1st of April 2021. The loan was at an annual interest rate of 6%. Sun Limited received investment income of 1 lakh on temporary investment of 30. So you have taken a specific loan to construct this factory and you have deployed those funds from the earned income. The understanding is that if the income is arising out of temporary investment of the fund, then you can adjust that income against the interest cost. Okay. You are required to compute the carrying amount of the factory in the balance sheet of Sun Limited as at 31st March of the year. So you have to show the carrying amount. When you say carrying amount, you have to show the cost for the depreciation and you have to show the carrying amount. And for all items, whatever between the exclusion. Looks to be a very big problem, but it's not a very big problem. In fact, these kind of problems are highly swing the examination. The question will last for 8 months on singular lines. I tell you, if you apply the concept correctly, you can score 8 out of 8. 8 is straight into your pocket. You cannot lose marks on such kind of simple problems, right? So I understand the question. Let's now go into the solution part of it. So let's start solving the problem. Let's analyze one by one and see how much is the amount to be capitalized and what amount to be calculated the depreciation. Right? We are required to calculate the carrying amount as of 31st of March of the year 2, which means we need to know what is the total cost and we need to know how much is the depreciation. So to begin with, the question says land purchase for 1 crore, including legal cost of 10 lakhs. Now we know the entire cost needs to be capitalized because even the legal cost is incurred for the purchase of land, so in that part will be capitalized. So this is why it's 1 crore. And we'll write the explanation because the examination is important that whenever the question is given, it not only balance something but also write the reason. So because this purchase of land will be capitalized, including the legal costs. These are incurred for acquisition of land, right? Then it says preparation and leveling, the cost is 3 lakhs. So this one is direct cost of construction. And then you will capitalize. Then materials is given at 60 lakhs 80,000. So your direct cost of construction. Then the question mentions that there are employment costs of 2 lakhs per month. Now employment cost of 2 lakhs per month, for how many months should be capitalized? See, the construction began on 1st of May and it got concluded on 30th of November. So May, June, July, August, September, October, November. For 7 months, whatever is the employment cost that is incurred, that will be capitalized. So it is 2 lakhs per month into or multiplied by 7 months, that comes to 14 lakhs. Right? This is also direct cost of construction. Then direct overhead cost is given to be 1 lakh per month, and for 7 months that will be 7 lakhs. So this is also direct cost of construction, which will be capitalized. Then ongoing overhead cost allocated to the construction project using company's normal overhead allocation model. Now this we know that cost incurred somewhere else, if it is allocated, it will not capitalize, it will be 0. As the cost is not related to construction or as it is not incurred for the construction purpose. Then income from use of the car park. Here we understood that there is nothing essential because giving that land on rent for car park is not essential to construct the factory. So this is an activity not essential for construction. So that will be 0. Then relocation cost. This will be 0 because again this is not a direct cost. Opening ceremony, use of celebrations that
Technical assets will also be 0 and this is not direct cost. Then, so next item is finance cost or interest cost. This is the question, the borrowing is 1.25 lakh. They have not mentioned whether the borrowing is only for construction or only for for both the purchase of land as well as construction. You can take either assumption. You can assume that part of the borrowing is for land, proportionally the borrowing has been done for purchase of land as well as construction, that can be done. Or you can assume that the borrowing is only for construction, even that assumption can be done. So either assumption is correct. And as far as land is concerned, you can take a stand that the land is already available, it is already ready. So you cannot capitalize any further amount. That assumption can be taken. We take a specific assumption and we consider that the interest which has been incurred is only towards construction part and we capitalize the entire amount towards the construction part, that is the cost of building. Now, why is it important to distinguish this? If you add it to the cost of building, you will have a higher depreciation. If you add it to the cost of land, that portion will not be depreciated. And if you assume that that land is not a qualifying asset, then the entire interest component will be charged to the statement of profit. So depending on the assumptions you take, you will the amount can be charged to the P&L. The specific assumption which was up here is that this interest is incurred on loan which is taken for construction. And the issue is the amount has been spent over different periods of time. We do not know exact date of spending, so we will take the total cost of borrowing and we reduce the income which is generated on temporary investments. Right? So finance cost will prepare a working note for this as well. Okay, so finance cost will be capitalized. So capitalize it because it's a qualifying asset. Again, land, if you say because you purchase the land is already ready for use, so that portion will not be capitalized. We only take the period from the date on the construction started till the construction ended. Till that period, whatever the interest will be capitalized. So let's calculate. So amount borrowed, we have 1.75 lakhs. Then rate of interest is 6%. Months from May, not from April. You cannot say purchase land in April and then start capitalizing. The time when the factory construction commences, that is May, June, July, August, September, October, November, December. How much is the interest? Interest will be 1.75 lakhs multiplied by 6% divided by 12 multiplied by 7. So that comes to 6,12,500. 6,12,500 is the interest cost less income on temporary investment 1 lakh. This is the equation. So net finance cost will be capitalized is 612 minus 1 lakh is 5,12,500. So this is the finance cost 5,12,500. Okay. Then the last aspect is demolition cost. Now, do we capitalize demolition cost? Yes. The present value of future decommissioning cost will be capitalized, right? So the cost of demolition obligation, present value of obligation will be present value of obligation will be calculated. Now, what is the present value? Let's calculate. This is working of 1, working of 2. Future demolition obligation is going to be 2 years, right? And term is 40 years, okay? And discount rate. Risk adjusted discount rate is given to us in the position at 8%. Okay. Risk adjusted discount rate is given to us at 8%, and the present value factor is given to us as 0.046. This is also is given to us as 0.046. This is also given as 1 divided by 1.08 to the power of 40 in the demolition analysis. You have to press 1 divided by 1 divided by 40 times. Okay, so like 0.046. Obviously, have more accurate decision, right? So what is the present value of obligation? Present value of obligation is 2 crores multiplied by 0.046. That comes to 9,20,618. You know, round of 619 right? So I'll just take the exact number. Demolition cost present value 9,20,618. Okay, so this is the present value of the obligation that we calculate. Now we have identified what are the costs to be capitalized and what are the costs which cannot be capitalized. So what is the total capitalization? This is the summation. 1 crore plus 3 lakhs plus 60 lakh 80,000 plus 14 lakhs plus 7 lakhs plus 5,12,500 and 9,20,619. Right? So you will get 1 crore 99 lakhs 30,119. Now the examination will say that what you ignore the last zeros and 19,000 also, or you can write lakhs also, 5,000 lakhs depending on the right? So the answer is 1 crore 99 lakhs 30,119. This is the cost of PPE. So this 1 crore 99 lakhs 30,119 is the cost of PPE. Now let's see how we calculate the depreciation and what is the carrying amount as at 31st of March year 2. Now we have computed the total cost of PPE. Let us now calculate the depreciable amount and then calculate the depreciation. Now there are 3 things. This is the component of land which we cannot depreciate. So out of 1 crore 99 lakhs, we cannot depreciate the land part. So we have to keep land aside. Then coming to the balance part, which is the overall building, there also have to divide between the structure and the wood. And the question has mentioned that 30% is towards wood, 70% is towards the remaining structure. So what we have to do is from the total cost of PPE, we have to reduce cost of land. Why do we reduce cost of land? Because it is not depreciable. Not depreciable. So depreciable amount will be 1 crore 99 lakhs 30,119 minus 1 crore, which is 99 lakhs 30,119. Out of this, roof component is 30%. So this multiplied by 30%, 99 lakhs 30,119 multiplied by 30% comes to 29 lakhs 73,956 and remaining component is 70%. What is the remaining component? 99 into 70%. Into the fraction of that, you get 699,183. Okay. Now, how much is the depreciation? Here, useful life is 20 years. Here, useful life is 40 years. Okay. So, how much is the depreciation? Depreciation will be the cost, that is 29,73,936 divided by 20 because it has useful life of 20 years multiplied by how many months of depreciation? The depreciation should start from 1st of December to December, January, February, March. You have 4 months for depreciation. So 4 divided by 12. So how much will that be? This amount divided by 20 into 4 divided by 12. You get 49,566. And in the second case, the useful life is 40 years. How much will the depreciation? This will be 69 lakhs 39,183 divided by 40 multiplied by 4 divided by 3. And doing the computation using the first time. And you're going to divide 99,31,19 multiplied by 30% divided by 20 and for the respective number of months. So this divided by 40 into 4 months divided by 12, you get 57,827. So what is the total depreciation? Total depreciation will be 49,566 plus 57,827 comes to 1,07,392. What is the carrying amount? Carrying amount of land is 1 crore and carrying amount of building would be 99. The total balance amount 99 lakhs 10,119 minus depreciation 1,092, 98 lakhs 5,727. Right? So what is the total carrying amount? This plus this, we get 1 crore 98 lakhs 5,727. Now please note, land is not depreciated. We have to disclose land separately. Carrying amount of land should be shown separately. This is a class asset, is not depreciable, and building has to be shown separately. Now in balance sheet we will not show building, roof, furniture, fixture, all those things are done. That is only for calculation of depreciation. Right? So this is how we solve these kind of problems. It takes a longer time the first time, but as we get used to more practice, we will and these kind of questions will definitely get you 8 out of 8. Please don't miss marks in these kind of questions.
Let's now talk about measurement after recognition. This is also referred to as subsequent measurement. That is to say, at each balance sheet date, how will we measure the property, plant and equipment? Now, the standard prescribes 2 models, cost model and revaluation model. Cost model is something which you would have learned right from the time when you started learning accounting. So, under the cost model, you take the cost of PPE. From that, you will reduce accumulated depreciation, and from that, you will also reduce accumulated impairment losses.
Now, what is impairment? We understand in Ind AS 36. Just for the sake of clarity, impairment loss occurs when the carrying amount of the asset is less than the benefit that you get from the asset. Now, there are some technical terms used if you understand in Ind AS 36. For now, understand that if the carrying amount is less than 1,000 and the benefit that the entity expects to get from that asset is only 800, the difference of 200 is impairment loss. Right? It's a very simplistic term. So you take the cost, from that you reduce the accumulated depreciation and accumulated impairment losses. Whatever you get is the carrying amount. In fact, solve problems where you have reduced the accumulated depreciation from original cost, and the amount that you arrive by deducting accumulated depreciation from the cost of PPE is the carrying amount of the asset. Right? So you take cost minus accumulated depreciation minus accumulated impairment losses. This is one model which is largely followed. The other model is the revaluation model. Now, why do we need this revaluation model? Let's take one example. Say an entity purchased land from 20 years back at 20 lakhs. So 20 years back they purchased a piece of land at 20 lakhs. Now, if you check the value of the land today, if you go to the market and find out how much will that land cost, the current market value is, let's say, 1 crore. You purchased at 20 lakhs, but right now the value of the land is 1 crore. Now, do you think the balance sheet is going to something which has a worth of 1 crore, you're showing it in the books of accounts at 20 lakhs only. So because this land is not depreciable, so you continue to carry that cost, which is 20 lakhs. Now, this kind of treatment may not give a fair picture of the financials, and hence in a 16 describes another model, which is the revaluation model. Now, what would be one revaluation model? 20 lakhs was the cost, current value is 1 crore. We will understand how we arrive at those values. Current value is 1 crore. Increase the value of land in the books from 20 lakhs to 1 crore. So original asset was at 20 lakhs. Now, after revaluation, the asset will be shown at 1 crore. We have increased the value of asset by 80 lakhs. Now, increase the asset value by 80 lakhs, we should also increase some portion of the equity liability side. So, the increase, whatever the increase in value, the 80 lakhs will be shown under revaluation service under other comprehensive income. You will not take the P&L. There are methods for arriving at this number. We will come to that. But for now, understand that under revaluation model, you are allowed to bring the value of the asset at its fair value. Then we can derive the fair value. Then we can determine the fair value. You can measure the property plant and equipment at fair value. Now, once you measure at fair value, on this value you will start charging depreciation. We come to all those steps. So, two models. First is the cost model, where you take the cost less accumulated depreciation and less accumulated impairment losses. And the next model is the revaluation model, where you take the fair value of PPE less accumulated depreciation subsequent to revaluation and accumulated impairment losses subsequent to revaluation. So these are two broad models which are specified by Ind AS 16. And you can either choose the cost model or the revaluation model. So the cost model is a simple one. We just need to calculate the cost, the depreciation, and the impairment. When it comes to revaluation, we are saying we need to compute the fair value of the asset. Now, first question is, how often should we compute the fair value? Should we do it every year? Should we do it every 2 years, 5 years? How often should be the frequency of revaluation? For this, we have to look at the changes in the fair value of a particular asset. Now, to determine frequency of revaluation of assets, we have to check the volatility in the asset fair value. Does the asset value fluctuate? Is it highly volatile? If that is the case, then the fair value must be computed annually. But if the fair value of the asset is pretty stable and is not fluctuate highly, it is not very volatile, then the entity can choose to do it in 1 year, 3 years, or 5 years, or 2 years, purely depending on the entity's discretion. But if the value changes frequently, the asset value itself is volatile, it keeps on fluctuating, then you have to do annual revaluation. That is the first thing. So frequency, if it is highly volatile, then do it annually. If it is not volatile, if the changes are not significant, if the changes are not material, then you can do it once in 3 years or 5 years. Then the second question is, can we choose cost model for one asset and revaluation model for another asset? Because what entities want to do, they do this one. They want to take benefit on both sides. Say for example, there are two assets, there are two land buildings, both are purchased at 1 crore at different locations. Location A is location B. After a few years, the value of this property at location B increases to 5 crores. But when it comes to location A, the expected development is not happen, and the value of that asset actually come down to, let's say, 80 lakhs. Right? So here 1 crore to 5 crores, here 1 crore to 8 lakhs. Can the entity say, for this asset, because the value has increased, we will apply the revaluation model, whereas for this asset, the value has come down, we will apply the cost model. Or the company also want to choose vice versa. That is, when the value has come down, let us show losses, and when the value has gone up, let us ignore that. Now, for this, the standard clearly describes that if you are revaluing one asset of a particular class, then all the assets in that class should be revalued. That is to say, if you are revaluing land and building at location B, then you should compulsorily revalue land and buildings in location A as well. Which means, if you are revaluing land and building at location B, you also need to revalue land and buildings at location A. You cannot pick and choose and revalue only selective assets. So you have to revalue all the assets within the class. Now, the company may also have plant and machinery. Now, if you are revaluing land and buildings, is it necessary that you revalue land and machinery as well? It is not required. Within the class, if you are revaluing one asset, all the assets in that class should be revalued. A different class of assets may be carried at cost model. So the entity can choose to apply cost model or revaluation model to a specific class. Say for example, you have 10 classes, class 1 to class 10, and each student represents an asset. So if you are applying the revaluation model to one student of class 1, you have to apply the revaluation model to all the students of class 1. You can go class 2 to class 10. Now let's say for class 9, for one asset you apply cost model. You have to apply cost model for all the students in class 9. Right? For all the assets falling in a class of assets, you will need to apply a model consistency. Apply cost model for all or apply revaluation model for all. But you cannot be partial and only revalue few assets in a class and ignore the other assets of the class. So what do we mean by class of assets? Class of assets basically mean assets which are similar, which are of similar use to the entity. For example, land and buildings. Land and buildings have different location. They are the same class of assets. Then you can talk about, let's say, office equipment. You can talk about vehicles. You can talk about ships. You can talk about gear man. So group of assets which are similar in nature and which are of similar use to the entity are called class of assets. In this illustrative list of class of assets, so you have land, land and building, machinery, ships, aircraft, motor vehicles, furniture and fixtures, office equipment, gear man. This is an indicative list. So if you are talking about furniture and fixtures, all items of furniture would fall under the class of furniture and fixtures. All items of office equipment, meaning equipment or any other equipment, that would fall under office equipment. Then you have vehicles, then you have land, then you have land and building. See the distinction. Land is separate, land and building is separate. Now if you are applying the revaluation model to any one asset, any of the class of assets, then you have to revalue the entire class of assets. So why am I emphasizing this? Because this is one tricky point where you can get a question in the examination. So to quickly summarize, subsequent measurement can be done using the cost model or the revaluation model. If you are using the revaluation model, what will be the frequency? If the changes to fair value are not significant, then it can be done once in 3 years or 5 years. If the changes to fair value are significant, if the asset experiences volatile changes in the fair value, then it has to be done on an annual basis. And coming to application of revaluation model or cost model, for a class of assets, we cannot apply both models. If one item in a particular class has been measured using, let's say, cost model, all the items in that class should be measured using cost model. Similarly, if one item is valued using the revaluation model, all the items in that class of assets should be measured using revaluation model. Now, whenever you revalue an asset, whatever surplus is generated because of increasing the value of an asset, that surplus is shown under revaluation surplus under other comprehensive income. You cannot take it to P&L, you cannot take it to earnings directly, it has to be shown under revaluation surplus. And the reason why we keep separating the revaluation surplus is we cannot take dividend out of this surplus. See, you have just increased the value of the asset. You increase the value of the asset from 20 lakhs to 1 crore. Now, the 80 lakhs of revaluation surplus is a kind of gain, but that gain is not yet realized, and you should not be allowed to take dividend out of that gain. And hence, we show it under revaluation surplus under other comprehensive income. Now, can we issue bonus share out of this revaluation surplus? We cannot issue bonus share out of the revaluation surplus because it is neither a phase of, it is neither part of your security account, it is neither part of your CR. Right? So because it doesn't fall in any of these categories, you cannot use revaluation surplus to issue bonus shares. Let's take one more example to understand the class of assets in bonus better. Say there's a company, the company owns factory buildings and warehouses, and the company also owns office buildings. So you have factory buildings, warehouse buildings, and office buildings, and these are located at different parts of the country. Now, what the company wants to do is it wants to apply the revaluation model to the office buildings, but it wants to carry the factory buildings and the warehouse buildings using the cost model. So for one kind of buildings, it wants to apply the revaluation model. For other kind of buildings, it wants to apply the cost model. Is that permissible? Now, just because we said that buildings form single class of assets doesn't mean that the office buildings and the factory buildings are also same class of assets because the use are different. How do we understand class of assets? Assets which are similar, both of them are buildings, but are they of similar use? Are they of the same use to the entity's operations? No. Factory buildings, warehouse buildings are used for different purposes. Office buildings are used for different purposes. So what you can do is you can call office buildings as a separate class of assets, and you can call these factory buildings and warehouse buildings as a separate class of assets, and apply the revaluation model to office buildings and use the cost model for the factory buildings and warehouse buildings.
Let's now understand the accounting aspects under revaluation model. Whenever we are valuing an asset under the revaluation model, what are we doing? We are calculating the fair value, we are arriving at the fair value, comparing that with the carrying amount. Now, the fair value may be higher than the carrying amount, the fair value may be lower than the carrying amount. Right? Now, in each of these scenarios, how do we do the accounting? How do we take care of the depreciation aspect? What do we do with the accumulated depreciation? All of those things what we will be understanding now. Say for example, we have an asset with original cost of 1 lakh. The useful life is expected to be 10 years and with no residual value, and we are following the SLM method of depreciation. So every year the entity will charge 10,000 as depreciation to the statement of profit or loss. Now, at the end of 4 years, the entity wants to apply the fair value model. Right? So let's see how does it work out. Now, the original cost is 1 lakh, and we are doing after 4 years. So we have to calculate depreciation for 4 years. How much will that be? 1 lakh divided by 10 multiplied by 4. So 40,000 is the depreciation. This we call accumulated depreciation. Accumulated depreciation. Then we calculate something called the carrying amount. What is the carrying amount? The cost of 1 lakh minus depreciation of 40,000. 60,000 is the carrying amount. Now, in the balance sheet also, I'm preparing the balance sheet for our understanding. In the balance sheet also you have PPE,
of 1 lakh plus accumulated depreciation of 40,000 right? So carrying amount would be 1 lakh minus 40,000 is 60,000. Now in the books, in the balance sheet, you can see that carrying amount of this asset is 60,000. Right? Gross block or the original cost 1 lakh, accumulated depreciation 40,000, carrying amount 60,000. Now in the books of accounts also you have a separate ledger for the cost of the machine. You carry the machinery at cost in a separate ledger and accumulated depreciation will be in a separate ledger. So how would it appear is the PPE would appear in year 1 of your past entry to let's say bank. Your past entry to bank 1 lakh, right? And every year you carry the balance forward and show PPE at cost of 1 lakh and accumulated depreciation every year. Year 1 to year 4 will be by depreciation. Basically depreciation account debit to accumulated depreciation. You have 10,000 into 4 which is 40,000. So original cost of PPE 1 lakh and it will continue to be shown as 1 lakh in the books and accumulated depreciation every year you charge 10,000, so accumulated depreciation will be 40,000. This is the presentation part. This is purely the presentation part. But we know that the current value of this PPE as per the books, the carrying amount of the PPE as per the books is 60,000. How do we get 60,000? 1 lakh minus 40,000 we get 60,000. Now assume for a moment that the fair value on this date has increased and it is 80,000. The fair value has increased and now it is 80,000. Now the question is how should we bring this 60,000 to 80,000? Carrying amount is 60,000, we have to bring it up to 80,000. How can we do that? Now for this there are two approaches. The first approach is eliminate the depreciation, bring the depreciation account to 0 so that this PPE comes back to 60,000. What do I mean by that? This depreciation balance is there, right? 40,000 in the accumulated depreciation account. This you transfer it to the PPE account and make the PPE account equal to the carrying amount. So what we will do is from here at the end of year 4 we will say to PPE account that is 40,000. We transfer this 40,000 from this account and we bring it to the PPE account by accumulated depreciation 40,000. Once we do this, what happens? Our balance will be 1 lakh minus 40,000, 60,000 will be the balance. So indirectly you know that it's already 60,000, but we are showing it in two different ledgers. So the first thing that we will do is we will eliminate the depreciation and transfer the depreciation to the PPE account and bring the PPE account from cost to the carrying amount. From cost to the carrying amount, right? So this balance becomes 60,000. This is nothing but this carrying amount of 60,000. Now we know that the balance is 60,000. We know the balance is 60,000 and we have to increase that to 80,000. What is the increase? Increase is 80,000 minus 60,000, 20,000 is the increase. So what you do is in this PPE account end of year 4 you say to revaluation surplus. You are increasing the value of PPE. You are adding 20,000 to the value of PPE. You debit the PPE account and you credit the revaluation surplus. This revaluation surplus will be shown under comprehensive income under PPE. How much is the revaluation surplus? 20,000. So you debit the PPE account and you credit the revaluation surplus by 20,000. Now the balance, the revised balance of your property plant and equipment will be 1 lakh plus 20,000 minus 40,000. 1 lakh plus 20,000, 1 lakh 20 minus 40,000, 80,000 is the balance carried down. Right? So what do we do? We increase this value of property plant and equipment from 60,000 to 80,000. So now after revaluation, PPE the carrying amount is now 80,000 and revaluation surplus is 20,000. See in net effect there also net asset value is 60,000. Assume here we have other liabilities and equity 60,000. Assuming that these two are only the items in the financial statements. Right? Now here you have other liabilities and equity 60,000. Revaluation surplus and showing separately 20,000, 60 plus 20, 80 and this is 60 plus 20, 80,000. So this is one approach to apply the revaluation model. What do you do here? First step, transfer the balance of depreciation to the PPE account. Then calculate the amount of revaluation. Then debit the PPE account with the upward revaluation and credit revaluation surplus with the increasing value of PPE. So what is the journal entry one by one? First entry what we did was we transfer the accumulated depreciation to PPE account. So first entry would be PPE accumulated depreciation account debit by how much? By 40,000 to PPE account 40,000. Right? So this is the first entry. Then second entry. What is the increase in the value of PPE? How much is the difference between the fair value and the carrying amount? PPE account debit 20,000 to revaluation surplus 20,000. Right? Now, how do we charge subsequent depreciation? We will charge on this value of 80,000. Not 60,000 but now 80,000 we charge depreciation. We will come back in some time. So I hope you are clear with the first way of treatment at the time of revaluation. Now in the first method we eliminated depreciation. Right? So we made accumulated depreciation to 0 and then did the revaluation. And the second method what we do is we do not eliminate depreciation but we increase the gross amount of the asset as well as accumulated depreciation proportionally to bring the asset value to the fair value. Now what do I mean by that? See, the fair value of the asset is 80,000. Fair value of the asset is 80,000. What is the current carrying amount? Current carrying amount is 60,000. From that 60,000 we have increased the value by 20,000. Correct? So instead of just doing a net basis accounting, we will do a gross basis accounting. So what do we do here? We first compute what is the increase percentage. What is the increase percentage? Increase percentage is nothing but 20,000 divided by 60,000 multiplied by 100. Right? So that comes to 0.33 and converted into percentage. It comes to 33%. So 20,000 divided by 60,000 multiplied by 100 comes to 33.33%. What are we doing here? We are increasing the carrying amount of the asset by 33.33%. Now, can I say that I can increase the cost by 33.33% and also increase the accumulated depreciation by 33.33%? Correct? So I'm increasing both the cost as well as the depreciation by the same proportion to ensure that this carrying amount increases from 60,000 to 80,000 which is also by 33.33%. And repeating once again, the net increase in the carrying amount is 33.33%. That is 60,000 has to become 80,000. Now instead of just increasing 60,000 to 80,000, what I'm doing is I'm increasing the overall cost by 33.33% and also the accumulated depreciation by 33.33% to ensure that the net carrying amount is also increased by 33.33%. So now what we can do, we can increase that. Increase what? Increase the original cost, that is the gross carrying amount by 33.33%. So 1 lakh into 33.33%, that comes to 33,333.33, and depreciation by 4 lakhs multiplied by 33.33%, that comes to 13,333.33. So I'm actually increasing this. These respective amounts. So what is the revaluable amount? My revaluable amount is 1 lakh plus 33,333 and 40,000 plus 13,333. If you see the carrying amount, this minus this, it becomes 80,000. So we increase this multiplied by 33.33%, that is 20,000. So what do we do? We increase the original gross value by 33.33%. We increase the accumulated depreciation by 33.33%, which resulted in increasing carrying amount by 33.33%. So we present in the balance sheet now, PPE gross amount would be 133,333. Accumulated depreciation would be 53,333. Accumulated depreciation would be 53,333. Carrying amount would be 133 minus 53, that is 80,000. So within the previous calculation, here also carrying amount is 80,000 after revaluation, but we are showing that as a single component, whereas in this method we are increasing the gross amount as well as the accumulated depreciation to arrive at the carrying amount of 80,000. Now in the second approach where we are not eliminating the depreciation, we will not pass the depreciation entry. We will not transfer the depreciation to PPE account, but instead we will increase the depreciation amount. We increase the depreciation amount as well as the PPE amount, So first let's look at the journal entry that we will be passing. You have increased the PPE, so PPE account debit by how much? By 33,333. We have increased the accumulated depreciation, so to accumulated depreciation by 13,333 to revaluation surplus. The difference of these two, 33 minus 13, it comes to 20,000, right? That is something 40%. So increase PPE by 13,333, increase accumulated depreciation by 13,333, and that is also revaluation surplus. Now let me here in the accumulated depreciation account, you increase it by 13,333. So you say by PPE account 13,333, and to balance carry down would be the opening depreciation value plus 13,333, which makes 53,333. This you can see here in the balance sheet. And PPE account debit by 33,333. So in the PPE account you have to revaluation surplus 20,000 to accumulated depreciation 13,003. In accumulated depreciation you have 13,333.33, and the balance carry down would be 1 lakh plus 20,000 plus 13,333, which makes it 133,333. So you can see this linkage. You can see this balance of 133,333 is being shown here, and this balance of accumulated depreciation is being shown here. Net of these two, like in the revised carrying amount is 80,000. Carrying amount remains the same. In the first method, you have eliminated depreciation. In the second method, you have increased both the gross carrying amount as well as the accumulated depreciation.
Now comes the complicated part of the revaluation accounting as well as a very logical and interesting treatment, right?
This is an area where a lot of students get confused and make mistakes. Lose out in marks in the examination. But let me tell you, once you understand these treatment with logic, there is nothing to memorize. You understand the logic, the treatment will flow automatically. Now, you understood that the revaluation will happen periodically. So there will be a first time revaluation and then there will be subsequent revaluation. First time meaning when you are revaluing a class of assets for the first time. Whenever you are revaluing an asset, there are two scenarios possible. Say this is the carrying amount. The revaluation can be an upward revaluation, which will result in a revaluation gain, or a downward revaluation, which will result in a revaluation loss. There can be a gain on revaluation, there can be a loss on revaluation. Now, whenever you are doing revaluation for the first time, if at all there is a gain, then that gain will be shown under revaluation surplus under OCI. So think of this as a bucket where you will accumulate revaluation gain. So let's say you have revalued a particular asset, whatever is the gain on revaluation, you will transfer that gain to this revaluation surplus and you keep this bucket with you. You will keep this bucket with you, and the amount which is lying in this revaluation bucket will be transferred to retained earnings when the asset is de-recognized. So when you de-recognize the asset, you can transfer it to retained earnings. So there is an alternative treatment also possible that for to extent of difference in depreciation, you can transfer every year an amount from revaluation surplus to retained earnings. So when you take this revaluation surplus to, you can take it to retained earnings. Can we take this to P&L? No, you cannot take this to P&L. So revaluation surplus can go to retained earnings, but it cannot go to P&L. Let's look at the second scenario. At the time of revaluation, there is a revaluation loss, which is to say fair value is less than the carrying amount. Now whenever there is a revaluation loss, that revaluation loss will be taken to profit and loss. Means you will recognize it as a loss in the statement of profit or loss. So gain, you take it to the bucket called revaluation surplus. Loss, you will recognize it in profit or loss. Now after first time revaluation, we have subsequent revaluation. Again here, there can be increase in the value of asset or there can be decrease in the value of asset. Now if there is an increase in the value of asset, do not directly take it to revaluation surplus. First check whether there was any decrease in the earlier period. What does that mean? There is an increase in the value, let's say year 2. At the end of year 1, there was a revaluation loss. At the end of year 2, there was a revaluation gain. At the end of year 1, there was a revaluation loss. What do you do with this revaluation loss? This revaluation loss you take into P&L. So at the end of year 2, if at all there is a revaluation gain, there was a revaluation loss for the same asset in the previous period, then to the extent of the earlier loss, you can recognize this gain in the statement of P&L. It's logical, right? Earlier for the same asset, you recognize a loss in the statement of P&L. Now when the value is increasing, to that extent of loss, you will recognize in the statement of P&L. You take it as a gain in the P&L, and anything over and above that, you will show it under revaluation surplus. You take it to the same bucket of revaluation surplus. So just to give you one example, let's say in year 1 there was a revaluation loss of 10,000. What do you do with this 10,000? You take it to the statement of profit and loss. At the end of year 2, there is a revaluation gain of 15,000. What do you do with this 15,000? Everything will not keep in the bucket of revaluation surplus. To the extent of loss recognized earlier, that is 10,000, you will take it to the statement of profit and loss, and you will recognize the gain in the P&L, and over and above the extra 5,000, you will take it to revaluation surplus. Right? So this is a scenario where there is a gain after earlier loss. Okay? Now what if there was no loss recognized earlier? Earlier also there was a revaluation surplus. In that case, you will not need to pay ahead. Whatever is the revaluation amount, the entire amount will be taken to revaluation surplus. Right? So this is the treatment when there is increase in the value of asset if subsequently. Now let's look at the second scenario. Let's say at the time of subsequent revaluation, the value of asset has actually come down. There is a revaluation loss. Generally, you take this revaluation loss to statement of profit and loss. But before doing that, you go back in the earlier period, check your revaluation surplus bucket and see is there any surplus of this asset left in this bucket. So if earlier you have done an upward revaluation, there was a revaluation gain and it is lying in the revaluation surplus bucket. To the extent of earlier revaluation surplus, you can knock off this revaluation loss. So what do I mean by that? Say for example, initially you had done an upward revaluation by 10,000. Now at the end of year 2, there is a revaluation loss of 12,000. Earlier it was gone up by 10,000. Now it's going down by 12,000. So to the extent of this 10,000 which you already recognized earlier as a revaluation surplus, to that extent of loss, you can knock it off against revaluation surplus, and the balance 2,000 you can take it to the statement of profit and loss. Right? So what do? If there is a subsequent downward revaluation, you go back and check was there any upward revaluation done earlier? Is there any surplus left in that account? If there is any surplus, knock off this loss against that surplus. If there is no surplus left, then you take it to the P&L. Now in the second scenario, when there was a revaluation loss and in the earlier period also there was a revaluation loss, then there is no balance in revaluation surplus account. The entire amount will go to the statement of profit and loss. Right? So this is how we handle revaluation gain or loss, first time revaluation as well as subsequent revaluation. Now let's take a few instances and understand how we deal with the treatment when we take revaluation surplus bucket, when we take it to the P&L. Now we can take this hypothetical situation. Let's say at the end of year 1, carrying amount of an asset is 1 lakh. The fair value is 1 lakh 20,000. Now 1 lakh 20,000 means there is an increase of 20,000. There is an increase of 20,000. And this is the first time revaluation. What do we do with this? We will take it to revaluation surplus. Now what do I mean by taking revaluation surplus? We will debit the PPE account by 20,000 and we will credit the by 20,000. And writing the same column, but this represents the debit. That is the debit PPE account and this is the credit. Right? So when we write generally in the examination, write in the proper format. Okay. Then subsequently, let's say year 2, the carrying amount is now 90,000 from 120, there is some depreciation on carrying amount is 90,000 and fair value is 1 lakh. What is the increase in this 10,000? Now what do I do with this increase? I have to go back and check, did I debit some revaluation loss for this asset to P&L? Did I do that? No, because I have to revaluation surplus. So again here we have revaluation surplus and you will debit the PPE account by 10,000 and you will credit the revaluation surplus by 10,000. Now total revaluation surplus here is 30,000. Correct? Now let's take another situation. Let's copy these numbers. This case 1. Case 2, carrying amount is 1 lakh. Fair value is 1 lakh 20,000. Increase 20,000. First time does not change. Second year, instead of being increased, there is decrease. So let us say carrying amount is 90. Fair value is 80,000. Fair value is 80,000. Now what happened? There is a loss of 10,000. There is a revaluation loss of 10,000. Now what do I do with this revaluation loss? Can I take it directly to P&L? No, I cannot take it directly to P&L. I need to go back and check for the same asset. Did I ever recognize the revaluation gain? Yes, I recognize 20,000 of revaluation gain. Now this 20,000 of revaluation gain, you can use it to offset this particular loss. So in the second year, the end will be debit revaluation surplus by how much? 10,000 and 10,000 and credit to which account? PPE account. PPE account by 10,000. So what are you doing? In the first year there was an increase. In the subsequent period there was an increase. So to the extent of earlier increase, you can use the revaluation surplus and you can reduce the carrying amount of PPE. But in the same situation, let's say the fair value at the end of year 2 is not 80,000 but 65,000. What is the revaluation loss? Revaluation loss is 25,000. Now, out of this 25,000, whatever was the revaluation gain recognized earlier, that is 20,000, I can knock it off, and the balance 5,000 has to go in the statement of P&L. So, revaluation surplus I can debit by 20,000. Right? Then, I need to debit the balance amount to profit or loss account. So, out of 25,000 revaluation loss, 20,000 was taken from the earlier revaluation gain, and balance 5,000 will be debited to profit and loss, and amount credited to PPE will be 20 plus 5, 25,000. So, debit this account and credit this particular account. Right? This is another situation. Then, now let's look at another situation. Let's say the carrying amount was 1 lakh, and the fair value at the end of year 1 and then the first year itself was determined to be 90,000. Now, what's happening here? The fair value has come down. Now, the fair value has come down. The revaluation loss will be debited to P&L. So, what will we do? We will debit profit or loss account by 10,000, and you will credit the PPE account by 10,000. Right? Now, in the subsequent period, let us say the carrying amount is now 80,000 and the fair value is say 85,000. Now what happened? This is a gain of 5,000. This is a revaluation surplus. Now what do I do in this case? Can I take this? Do I take this revaluation surplus directly to revaluation surplus account? No. To the extent of loss recognized earlier, I can take it to P&L. So out of this entire 5,000 can be credited to P&L because earlier it was debited to P&L. So what will I do? I will debit the PPE account by 5,000 and I will credit profit or loss by 5,000. Why? Because earlier I debited profit or loss. Now in the same case, let me have one more dimension. Now in the same case, let us say subsequently from 80,000 the fair value was determined to be 95,000. Now there is an increase of 15,000. Now for this increase of 15,000 up to 10,000 you can take it to P&L and 5,000 is over and above 10,000 amount will be taken to revaluation surplus. So in the second you will debit PPE by 15,000, profit or loss will be credited by 10,000 and you will credit revaluation surplus 5,000. So, 1 debit 15,000, credit to profit or loss 10,000, credit to revaluation surplus 5,000. So, to summarize, for the first time revaluation, if there is a revaluation gain, take it to revaluation surplus. If there is a revaluation loss, take it to statement of profit or loss. That is the first time revaluation. For subsequent revaluation, if there is a gain, check was there a loss earlier. If there is a loss which was recognized earlier, to that extent, you can take it to statement of profit or loss, and the balance will go to revaluation surplus. If there was no loss recognized earlier, then that gain will also go to revaluation surplus. Then, if there is a revaluation loss, check whether there was revaluation surplus created. If there is a balance in the revaluation surplus account, to that extent, you can transfer the loss to revaluation surplus account, balance will go to statement of profit or loss. And if there is no revaluation surplus, then the entire loss will go to statement of profit or loss as a loss. Now, another thing I need to understand is you cannot use the revaluation surplus of one asset and knock that off against the revaluation loss of some other asset. You need to pay for each asset. You need to have a separate revaluation surplus bucket. So what I mean here is for every asset you need to have a separate revaluation surplus bucket, and you can use the revaluation surplus bucket only to take care of that specific asset. Gain of one asset cannot be used to offset the loss from another asset. And please note I'm not saying class of asset. It is for that specific asset. So all the discussion around treatment of revaluation loss and revaluation gain is done for each asset separately. The loss of one asset can be used to offset the gain of that asset, but the gain of one asset or the loss of one asset cannot be used to offset the gain or loss of some other asset. For each asset, you have a separate calculation of the revaluation gain and loss. You cannot mix all of them. Keep them in separate buckets.
Now, after having understood how do we do accounting when it is a first time revaluation and subsequent revaluation,
and what do we do with this revaluation surplus? See, for now you show it under other comprehensive income, it's part of the equity shown in the balance sheet. But when this account will close, so the standard prescribes two treatments. The first treatment is continue to carry the revaluation surplus under OCI till the time the asset is recognized. Whenever you recognize the asset, move that amount from revaluation surplus to retained earnings. Please note a very important thing here. From this revaluation surplus, you cannot take any amount of profit and loss and then bring it back to retained earnings. That is not what is prescribed. What has to be done when you are recognizing the asset? This revaluation surplus, whatever is the balance left, whatever is the balance left over, that balance has to be directly transferred to retained earnings. That is one thing that we need to understand. And the second approach which is prescribed is, see, whenever there is revaluation surplus, we have increased the value of the asset. So we saw from 1 lakh, we increased the value of the asset, let's say 1 lakh 20,000. We increased the value of the asset by 20,000, which means we are charging more depreciation. Earlier we would have charged depreciation on, let's say, carrying amount of 1 lakh, but now we are charging depreciation on a higher amount of 1 lakh 20,000. There is extra depreciation. So what you do is you need to figure out what is the extra depreciation that has been charged. What is the extra depreciation that has been charged? To that extent, every period you can transfer the balance from revaluation surplus to retained earnings. Again, just because you are charging higher depreciation in profit or loss doesn't mean that you can transfer from revaluation surplus to the profit or loss and then the net impact goes to retained earnings. That is not how it goes. You are charged extra depreciation in the profit or loss because of which your profit has come down. To that extent, you can transfer the balance from revaluation surplus to retained earnings directly. You cannot do it for the statement of profit or loss. So what we do is we take one example and see how do we calculate this difference in depreciation and how do we transfer that amount to retained earnings. So let's take the same example of taking something back. Original cost of 1 lakh, useful life of 10 years. So depreciation is calculated per year. So depreciation per year comes to 1 lakh divided by 10, which is 10,000. Depreciation for 4 years was 40,000. The carrying amount was 1 lakh minus 40,000, which is 60,000. And the fair value is 80,000. And now we are into 80,000. Increase of 20,000 is taken to revaluation surplus. Right? Now let's understand how this is impact depreciation and how can we transfer the amount of revaluation surplus to retained earnings. Now if you say 4 years have already passed by and assume that the remaining life remains unchanged at 6 years. So what is the revised depreciation? Revised depreciation is 80,000, which is the revised carrying amount, divided by how many years are left? 4 years have passed by, so 6 years are left. 6 years are left. So revised depreciation comes to 13,333.33 for every year for the next 6 years, right? What is the depreciation on cost? Had you continued to charge depreciation on cost basis, the depreciation would have been 10,000. So this extra depreciation, whatever it is, 13,333 minus 10,000, 3,333, you can transfer from revaluation surplus to retained earnings. Now do this for 6 years, you will see that the entire 20,000 will be transferred from revaluation surplus to retained earnings. So what are the you pass? First, to increase the value of asset, and let's assume that we are doing it on a net basis. You say PPE account debit by 20,000 to revaluation surplus 20,000. Assume that you already transferred the depreciation to the PPE account, we are showing that carrying amount only. Okay. Now in the next year, when you charge depreciation to be depreciation account debit 7,333.33 to accumulated depreciation 13,333.33. Now, if you see this 13,333.33 is higher than the normal depreciation of 10,000, so the next step is different. That is 3,333. You can transfer from revaluation surplus to retained earnings. So, revaluation surplus account debit by the difference, that is 3,333 to retained earnings 3,333.33. Like this, we do it for 6 years, then the entire 20,000 revaluation surplus will be transferred to retained earnings. Or otherwise, what we can also do is at the end of the 10th year, when the asset is ultimately recognized, then the entire balance of 20,000 can be transferred to retained earnings. So if an entity chooses to transfer this excess depreciation from revaluation surplus to retained earnings, then the closing balance of revaluation surplus also will be reduced accordingly. In our case, let's say at the end of the 5th year, your original revaluation surplus amount was 20,000. From that, you will reduce 3,333.33 that is transferred to retained earnings, and the balance will be shown as the closing balance of revaluation surplus. When we had computed the carrying amount, we took the initial cost or the amount at which the asset was initially recognized. Then we deducted accumulated depreciation and accumulated impairment. Now, as far as accumulated depreciation is concerned, we have understood in detail. As far as accumulated impairment losses are concerned, these are dealt by Ind AS 36. So calculation of the amount, how much is the impairment loss, when should we recognize, when should we reverse, all those are covered under Ind AS 36. Now, sometimes what happens is, against these impairment losses, we have some amount receivable from third parties. Say for example, we have taken insurance on a particular machinery and the insurance provides coverage for any kind of malfunctioning of a particular asset. That is possible. Or sometimes there may be damage due to fire because of which the machinery may not be able to perform optimally. So we may have insurance policy. Now, say for example, the machinery has been impaired, the item of PPE is impaired, and for which we will get insurance claim from the insurance company. The insurance company will pay a certain amount. Now, what you need to do is, you need to account for impairment separately. You have separate accounting. Whatever is receivable from the insurance company, that is an item of income which you should take it to the statement of profit or loss. But you should take it only when the insurance claim is confirmed by the insurance company. Just because the machinery is damaged, you cannot say that you will receive amount from the insurance company and you will take that amount to the income statement. That is not done. Impairment account for it as when it happens. Insurance claim, any amount receivable from third party, you will take it to the statement of profit or loss only when that amount is receivable. Only when the insurance company says, okay, we have approved your claim. At that point in time, you can recognize that as income in the statement of profit or loss. So that is one thing. Impairment deals separately. Any amount receivable from third party, deal with it separately. Now, sometimes what happens is, whatever claim is received from the insurance company, the company may utilize it to purchase another item of PPE. So what's happening here? There was an existing machinery which got impaired, for which we got some amount from this insurance company, and this amount we are utilizing to buy a new item of PPE. All of these three transactions, you have to deal with them independently. Impairment independently, insurance receivable independently, a new item being bought, treat them independently. Don't mix all the transactions and say that we have given an asset, now getting something in exchange. It does not work that way. You have to treat these transactions as independent transactions and do the accounting treatment accordingly. So how do you do the accounting? Impairment of items of PPE are recognized in accordance with Ind AS 36. You take account of Ind AS 36 and account for impairment losses accordingly. Then de-recognition of item of PPE, retired or disposed of, is determined in accordance with the standard. So let's say not only impairment happened, now you have to de-recognize the asset. Now de-recognition has to be done as per principles given in Ind AS 16. Then compensation from third parties for items of PPE that were impaired, lost or given up is included in determining the profit or loss when it becomes receivable. So basically, if you are getting any amount from third parties towards impairment losses, compensate the impairment loss, then it will be taken to the statement of profit or loss when it becomes receivable. Impairment loss will be recognized in one period, the corresponding receivable may be recognized in another period. And lastly, the cost of items of PPE, restored, purchased or constructed as replacement is determined in accordance with the standard. Basically what it means is, if you acquire a new asset or if you are carrying out some kind of replacement, then you have to check the recognition criteria of the standard, and if they qualify to be recognized as an item of PPE, then you will recognize them separately. You will not mix all of those transactions when handling these kind of issues. We take an example and see how we do the accounting for it. Let's look at the question. X Limited has a machine which got damaged due to fire as of 31st of January of year 1. So there was a machine which got damaged due to fire. The carrying amount of the machine was 1 lakh on that day. X Limited sold the damaged asset for 10,000. So there was a machine carrying amount 1 lakh. It got damaged and was sold for 10,000. X Limited has insured the same asset against them. So there was insurance policy against damage. As of 31st March of year 1, the compensation proceeds was still in process. So basically the compensation proceeds were not received, but the insurance company has confirmed the claim. So claim is confirmed, but amount is not received. Compensation of rupees 50,000 is receivable from the insurance company. How should X Limited account for the above transaction? So a very simple question. Carrying amount 1 lakh, basically it got damaged, against which we got 10,000 scrap, 50,000 is receivable from the insurance company. So if you look at it, loss on this particular item comes to 40,000. 1 lakh minus 50,000 minus 10,000. Let's see how we do accounting for this. So how do we account for this transaction? The machine had a carrying amount of 1 lakh and it got damaged and we got 10,000 from scrap sale. Basically, the first set of transaction, 1 lakh was the carrying amount, 10,000 was realized from scrap. So you see that due to damage in the machinery, there is a loss of 90,000. 1 lakh minus 10,000, 90,000. This will be recognized as a loss. You recognize this particular machinery from the books and you look at a loss of 90,000. Now when it comes to 31st of March year 1, we see that 50,000 is receivable. 50,000 is receivable from the insurance company. This 50,000 will be shown as an item of income in the financial statement. So basically, what you do is insurance claim receivable 50,000 and you credit it to profit and loss. 50,000 is income that will be accounted for. 90,000 is the loss and 90,000 is loss because of damage to machinery. So 90,000 loss, 50,000 again. Net impact to profit or loss will be 40,000. Let's take another example. Say there is an item of machinery. The carrying amount of 100 crores because of some bad damage. Therefore, we have an insurance policy. And what the company did after the damage, they filed an insurance claim for 50 crores. Okay? And the insurance company then made the payment. They pay the claim amount. Apart from this, the company also incurred 40 crores in restoring the plan because the social plan got damaged. They have to rebuild the plan. For this, they incurred 40 crores. Now if you see here, the amount you get from the insurance company is 50 crores, whereas the amount of cost that is being incurred to restore the plan is 40 crores. Can we say that there is 50 crores receivable and there is cost only 40 crores? So balance 10 crores will be taken to the income statement. Can we do that? And can we say that whatever is the impairment loss which may come upon this plan, we should not recognize? Can we do that? For this, we need to go back to the principles given in Ind AS 16. The first thing is the plan got damaged. Whatever is the loss, it has to be recognized immediately. Insurance claim may come later, but whatever is the loss, it has to be recognized immediately. Say for example, the loss was 60 crores. The loss was 60 crores. 60 crores of impairment loss should be recognized in the statement of profit or loss. That is the first thing. Second thing, the amount of insurance claim which is receivable 50 crores, this should be accounted as income when the insurance company confirms the claim. Or the insurance company says that we will pay the claim amount. So you cannot say that the loss minus the proceeds from insurance claim will net off and show in the statement of P&L. That doesn't work. Loss you have to show separately. This insurance claim will become receivable and it will be accounted in the income when it becomes receivable. This is the second part. The third part, whatever amount which is spent as 40 crores, if it meets the recognition criteria, you will recognize it as an asset, as an item of PPE. So you cannot pull up all of these three, you cannot net off all these transactions and only show the net amount, right? Now these kind of questions from the exam, you have to mention clearly that each of these transactions, each of these events are separate economic events. Impairment loss is a separate economic event, the insurance claim is a separate economic event, restoration of plan is a separate economic event, and they have to be accounted for separately. You cannot club them and account for them on a net basis.
Let's now move on to the last aspect, which is de-recognition. We had recognition, we had measurement, we had subsequent measurement. Now we're talking about de-recognition. Now what do you mean by de-recognition? Recognition, you bring it into the books of accounts. De-recognition, you are moving it out of your books of accounts. You will no longer show that item of PPE as an asset. Now when should an entity de-recognize an item of PPE? It should de-recognize first when it is disposed of. So when there is a disposal of PPE, you will de-recognize. Disposal could mean, let's say you have sold that asset, right? At that point of time, you will de-recognize the item of PPE. Or if the entity does not expect any further economic benefit from its use or disposal. Now what does that mean? That basically means that asset is worthless. There is no economic benefit that would flow to the entity. Remember the recognition criteria where we said future economic benefit should flow to the enterprise. If future economic benefits will no longer flow to the entity, then the entity will de-recognize the item of PPE. So when do we de-recognize? The carrying amount of an item of PPE should be de-recognized on disposal or when no future economic benefits are expected from its use or disposal. So either from its use or even if you want to dispose of the asset, there is no buyer for asset. At that point in time, you will de-recognize the item of PPE. Now, when we de-recognize, there could be a gain, there could be a loss at the time of de-recognition. Say, for example, the carrying amount of PPE is 1 lakh, you dispose it of 1 lakh 20,000, and let's say you incur from 5,000 of incidental expenses for disposal. So, net disposal is 1 lakh 15,000, carrying amount is 1 lakh. This difference of 15,000 will be recognized as gain in the statement of profit or loss. If let's say the net disposal proceeds for 90,000, 10,000 will be recognized as loss. Now, what you need to understand is this gain on sale of PPE or the total proceeds that get from sale of PPE that will not be recognized as revenue. You cannot show it as revenue. The gain portion will be shown as income only the net amount and you will not get revenue. Now, when you recognize this gain or loss, you should recognize it on the date of disposal. When the date of disposal, you have to take care of Ind AS 115. The way you establish that the control has been transferred, similarly here, whenever the control is transferred, as per Ind AS 115, applying the principles of Ind AS 115, you will see whether the control has been transferred or not, and the date of this control has been transferred to the recipient, that will be the date of disposal, and on that date you will recognize the gain or loss. So sometimes what happens in Ind AS 116, this type of different treatment in case of sale and leaseback. For that, you refer to Ind AS 116 whenever there is a sale and leaseback transaction, and accordingly you will account for gain or loss. Sometimes what happens is an entity gives out its item of PPE on rental to others, and after some period of renting it out, they sell it as part of the activities. Say for example, an entity is in a car leasing business, so they give out cars on rent to others, and after some period of renting, they sell those cars, and these are ordinary activities for the enterprise. Now, if sale of items of PPE, in our example car, is happening as an ordinary activity, it's a routine part of the business, then these items of PPE should be transferred to inventories, and then whatever amount you get from sale of those items should be recognized as revenue as per Ind AS 115. Generally, gain on PPE will not be recognized as revenue, sale value of PPE will not be recognized as revenue, but if you are in the business of renting out those items to others, and you routinely sell those items after giving them out on rent, in such a situation, you will transfer these items of PPE to inventories, you treat them as inventories, and then whatever revenue you get from sale of those items, you will classify them as revenue under Ind AS 115. Then, as far as determining the transaction price is concerned, you have to take the reference of Ind AS 115. So whatever principles we understand in Ind AS 115 in determining the transaction price, similar principles will apply when we determine the transaction price under Ind AS 16. Sometimes what happens is there may be a deferred payment. So when there is a deferred payment, you have to segregate the cash price and the financing element and account for them appropriately. So these are some guiding principles to determine what is the transaction price, what is the value realized on disposal of asset, and what should be done to the gain or loss. Now disposal can happen because you have sold an asset, disposal can happen because you have given an asset on finance lease, disposal can happen because you have donated that to somebody else. So it can happen multiple different ways. Whenever there is a disposal, you will recognize the item of PPE. Let's now move on to the next aspect, which is disclosure. Now, what are these disclosure about? How have you computed the value of fixed asset? How have you done the depreciation? What are the useful life? What is the gross carrying amount? What is the net carrying amount? All of these things are to be disclosed. Now, Ind AS 16 prescribes the minimum disclosure requirements. If Companies Act prescribes more disclosures, that has to be done, or if the management wants to voluntarily give out more disclosures, that can also be done. So whatever we have learned in this standard, largely those would be disclosed. We'll understand now item by item what are the items to be disclosed and how they are presented in the financial statement. We'll also to one financial statement of a company to understand how they actually disclose in the financial statement. The first thing is the measurement base of loss carrying amount. That is where you apply the cost model or the revaluation model. That is the first thing. Then what is the depreciation method used? Are you using a method, WDV method, introduction method? Then what are the expected useful life or what is the rate of depreciation provided? And then what is the gross carrying amount? What are the accumulated depreciation accumulated? And then if there are any accumulated impairment process at the beginning and the end of the period. So this is a standard disclosure you will see in most of the financial statements. And then there are additional disclosures as well. When it is required to provide the reconciliation of the carrying amount at the beginning and at the end of the period. Basically, you will take the carrying amount at the beginning.
of the period, then you take the carrying amount at end of the period, and you present the reconciliation. Reconciliation means what are the additions, what are the deletions, what are the depreciation, what are the depreciation, what are the impairment losses, how did you move from opening balance to the closing balance? That is what the meaning of reconciliation, right? So you have to show additions, then you have to show the assets classified as held for sale or included in a disposal group classified as held for sale in accordance with Ind AS 105 and other disposal. So what are the items which are classified as held for disposal, or what are the items which are actually disposed, has to be mentioned. Then acquisition to business combination. If there are items of PPE which are acquired because of a business combination, that has to be disclosed separately. Then increases or decreases resulting from revaluation and from impairment losses recognized or reversed in other comprehensive income. So if at all there is an increase or decrease resulting from revaluation or and from impairment losses, that has to be disclosed. Impairment losses recognized in profit or loss in accordance with Ind AS 36. Impairment losses reversed in profit or loss in accordance with Ind AS 36. Basically movement in impairment. One was movement in revaluation, now movement in impairment. Then depreciation. Then the net exchange differences arising on the translation of the financial statements from the functional currency into a different presentation currency, about which we understand in Ind AS 21, including the translation of foreign operations into presentation currency. So whatever differences arising as described in Ind AS 21, we will understand that those have to be disclosed, and then any other changes. And we also disclose the existence and amount of restrictions on the title. So if there are any restrictions on the title of item of PPE, that has to be disclosed. Say for example, you have unit as a collateral, security of mortgage and item of PPE, that has to be disclosed, because you will not be able to dispose of the item of PPE at your own will, because there is a restriction on the title. Or sometimes there may be a dispute on the title of PPE. Let's say you purchase a land and then there is some dispute going on the land. So if there are any restrictions on the title, both the existence and also the amount of restrictions that has to be mentioned, or if you have placed them as security for liabilities, that has to be disclosed. Then the amount of expenditure recognized in the amount of item of PPE in the course of its construction. So if at all there is a self-constructed item of PPE, then whatever is the amount that is recognized as due to self-construction, that has to be disclosed. Then the amount of contractual commitments for the acquisition of item of PPE. Contractual commitments basically means these are contracts that the entity has entered into. They have given commitments under those contracts, but the amount may not have been fully spent. Let's say there is a 5-year long project, right? Now what is the total amount of commitment given under that particular project, that has to be disclosed. And the reason why we disclose these kind of commitments is the use of financial statements should know that not only there is a liability which is given in the financial statement, but for the next 4 years the entity has committed to spend so much amount, and the entity will incur those liabilities in the future. So you have to disclose that as well. And the amount of compensation from third parties for items of PPE that are impaired, lost or given up, that is included in profit or loss, if it is not separately disclosed in the statement of profit or loss. Give an example, right? Where we got an insurance claim from the insurance company. Right? This is not disclosed separately in the statement of profit or loss. You have to disclose it as part of the disclosure, right? So these specific disclosures are understood. If there are any restrictions on title, that has to be disclosed. Or if you have pledged them as security, that has to be disclosed. Then the amount of expenditure on item of PPE which are constructed, that has to be disclosed separately. If there are any contractual commitments which have been given, that has to be disclosed separately. And the compensation on impaired assets given up has to be disclosed if they are not disclosed separately in the statement of profit or loss. Then for items which are revalued, so we understood that there is a cost model and revaluation model. So for items which are revalued, you have to disclose the effective date of revaluation. So when is the effective date of revaluation? Then whether any independent valuer was involved in revaluing item of PPE or whether it was done internally, that is also to be disclosed. Then for each revalued class of PPE, the carrying amount that has been recognized has been carried under the cost model. So basically we are saying your revalued assets, your revalued class of assets, you disclose that amount, and also disclose the amount that would have been the carrying amount had you continued to follow the cost model. So you show the revalued amount in the financial statement. In the balance sheet you present the revalued amount. In the notes you disclose that had you followed cost model, this would have been the carrying amount. This needs to be disclosed. And then the revaluation surplus, including the change for the period and any restrictions on the distribution of the balance sheet shareholder. So whatever the revaluation surplus is disclosed. And then what is the change during the period, that needs to be disclosed, and the restrictions on the distribution of the balance sheet shareholder. So we know that revaluation surplus cannot be used to, let's say, dividends or issue ownership, so such restrictions should be disclosed. And lastly, we have certain recommended disclosures that are optional and not mandatory. The first one is carrying amount of temporarily idle PPE. So if there is an item of PPE which is temporarily idle, let's say due to COVID, some of the item of PPE will not be used, they are temporarily remaining idle, that has to be disclosed. Then the gross carrying amount of any fully depreciated property plant and equipment, that is still used. Something what happens is you estimate the useful life of 10 years, right? And you report that at the end of 10 years you dispose of the particular item of PPE, but you still continue to use the item of PPE, whereas the entire cost of PPE will have been depreciated. In such a situation, you may disclose the gross carrying amount that is still using. Then the carrying amount of PPE retired from active use and not classified as held for sale in accordance with Ind AS 105. So you have retired an item of PPE from active use, you are no longer using it, but you have not yet classified that item as held for sale as per Ind AS 105, that can be disclosed. And then when the cost model is used, the fair value of PPE when this materially different from the carrying amount. Now, this is optional disclosure again. It says if you follow the cost model, you will disclose the amount of the cost model, but if the fair value is significantly different, if it is materially different, then you may disclose the fair value as well. These are some optional disclosures.
So let's now have a look at the balance sheet, the profit or loss, the statement of profit or loss, and also the accompanying notes to account to understand the disclosures and how they are presented in the financial statement. It's very important for us to relate whatever we learn with what happens in practical life, because this is what we'll be doing once you qualify as a chartered accountant. Working a corporate or you're practicing doing audit, we must be able to how the so now coming to the balance sheet, under one can see this property plant equipment, what we are understanding now in Ind AS 16, and there is note 3, which should contain the disclosure requirements, and you can see here the carrying amount in gross 19,150 crores as of March 31st, 2021, and 18,070 crores as at March 31st, 2020. So then come on to the profit or loss statement of profit and loss. You can see this depreciation, right, is one of the major component in financial statement, disclosed on the face of the face, and then you can see the amount of depreciation charge 361 and 375. So let's go to number 3A. And before that, let's look at the accounting policy what has been mentioned for PPE. Property plant equipment are stated at cost of acquisition or constructed, less accumulated depreciation and accumulated impairment. What does that mean? They are following the cost model. Okay, freehold land is measured at cost and it's not depreciated, because you understood land has an unlimited useful life. Cost includes the whatever you learn, get right the same thing. If you read report, you will be able to understand all the accounting standards as well. Cost includes purchase price, non-recoverable taxes and duties, labor cost, and direct overhead costs and constructed assets, and other direct costs incurred up to the date the asset is ready for its intended use. Remember what we learned? All the costs incurred till the date the asset is ready for use as intended by the management. Interest cost incurred for constructed assets capitalized up to the date the asset is ready for its intended use based on the borrowings incurred specifically for financing asset, or the weighted average rate of all the borrowings is most specific borrowings or have been incurred for the asset. So this is about the borrowing cost, which we are understanding separately. Depreciation is provided on the statement method over the estimated useful life of assets, considering the nature, estimated usage, operating conditions, past history of replacement, anticipated technological changes, manufacturer's warranties, and maintenance. Again, these factors what are used to determine the useful life and depreciation. They are understood, same factors mentioned here. Taking into account these factors, the company has decided to retain the useful life either adopted for various categories of PPE, which are different from those prescribed in Schedule 2 of the Act. So if you go to the company's Act Schedule 2, there companies Act have prescribed that it is the useful life of the items of PPE. If you are using a different useful life, you are allowed to use it, you have to disclose that. So estimated useful life of building, roads, bridges, and culverts 4 to 6 years, plant and machinery and equipment 8 to 20 years, computers 4 to 6 years, vehicles 4 to 10 years, furniture, fixtures and services 5 to 15 years. So that is what the useful life. The useful life is reviewed at least at each year end, and changes expected useful life is stated as in the accounting estimate. Again, whatever we have learned. Depreciation is not recorded on capital working process until the construction installation is complete and as is ready for its intended use. An item of PPE is recognized on disposal. That's what we understood. Any gain or loss arising from de-recognition of an item of PPE is included in profit or loss and it is recognized. So just by reading the accounting policy actually revise the respective standard. Obviously, the detailed calculations and other things are not given. A broad overview of policy is given. Now let's go to note 3A. This is note 3A. Right? So what is mentioned? We understood, right? The gross carrying amount and the various additions and disposals, carrying amount, carrying amount at the end, everything we mentioned here. Cost as of April 1st, 2020, whatever is for different class of assets. We have for different classes: land, buildings, plant, machinery, furniture, fixtures, vehicles, computer and other assets. And again, even on these, if some asset has been given on this, it has been disclosed separately, and assets which have been taken on this, which qualify to be recognized as an item of asset on PPE, that has been given separately. This will understand when we understand Ind AS 116, right? So what have been disclosed? The cost, the additions, sale of business to a subsidiary company, the sale of business to a investment, that has been given, and other disposal and adjustments have been given, and what is the cost as at 31st March. So this is the gross amount and adjustments to that. Then accumulated depreciation as at April 1st, 2020, that's opening balance. Whatever is the depreciation for the year, that has been given. Whatever the reversal of impairment cost, that has been given. Because they have sold some asset, what is the adjustment depreciation, that has been given. And for disposal and adjustment, depreciation has been given. So what do you understand is, if you dispose of an item of PPE, you remove that from the cost and the gross block, we call this as gross block. And from the accumulated depreciation part as well, you remove that portion which belongs only for this particular items, right? So here you can see the accumulated depreciation is negative item. When you dispose of, so much of the depreciation has been removed. Then we're showing the net carrying amount, right? Then there is an adjustment because of initial application of Ind AS 116, the reconciliation of that also has been given, right? So this is how you present in the financial statements. Let's now understand how do we handle changes in decommissioning liabilities, restoration liabilities, and similar other liabilities. Now if you remember, we have understood that whatever is the decommissioning cost or restoration cost which is estimated at the end of the life of the PPE, that has to be discounted to present value, and this present value should be added to the cost of item of PPE. This is what we have understood. Now what are we doing here? We are estimating a future liability, that is one aspect. We are using a specific discount rate, and then we are arriving at the present value. Now over a period of time, these may undergo changes. Whatever you have estimated as a future liability, that may undergo a change, or the rate that you have used to discount, even that may change because of change in market conditions. Now Appendix A to Ind AS 16 gives guidance as to how do we handle these kind of changes. So let us understand that. First, let us see how do we account for these changes when the entity is following a cost model. Now these changes in decommissioning liability can be an increase, can be a decrease. Now logically, if there is an increase in decommissioning liability, what would you do? You would increase the carrying amount of asset. When there is a decrease in decommissioning liability, you will reduce the carrying amount of an asset, right? It's very simple, it's very logical. Initially also, the present value of decommissioning liability was added to the cost of PPE. Even here, if there is an increase in that liability, you will add it to the cost of PPE. If it is a reduction in the liability, you will reduce it from the cost of PPE. So what would you do? If there is an increase, you will debit the PPE account and you will credit the decommissioning liability. Similarly, if there is a reduction, you will debit the liability, credit the PPE. This logic sounds very simple, but calculation can be slightly tricky because you have to again recompute the present value, and that we understand using an illustration. So after we have done this, there will be two scenarios possible. Let us say the carrying amount of the asset is 1 lakh, carrying amount of the asset is 1 lakh, and these changes in the decommissioning liability is 50,000. It has increased by 50,000. Now what do we do? To this 1 lakh, we will add 50,000, and the revised carrying amount will be 1 lakh 50,000. Now whenever you increase the value of an asset, the first thing that we need to check is there any impairment possible? Because the increase in the carrying amount of asset may be possible, you will not be able to recover all the amount that is represented by the carrying amount. So you have to check for impairment, go to Ind AS 36 and figure out whether the increase is justified. If the increase is not justified, if the carrying amount is not fully recoverable, then you have to make a provision for impairment loss. That is the first thing. The second thing is, if there is a reduction, let us say the carrying amount is 1 lakh and there is a reduction by 50,000. Then what do we do? 1 lakh minus 50,000, revised carrying amount will be 50,000. But what if the reduction in decommissioning liability is 1 lakh 25,000? The carrying amount is 1 lakh, the reduction in decommissioning liability is 1 lakh 25,000. Now whenever I am defining this term, increase in decommissioning liability, decrease in decommissioning liability, this I am talking in terms of present value, I am not talking in terms of future value. So for 1 lakh carrying amount, you have figured out that the decommissioning liability has come down by 1 lakh 25,000. So if you reduce 1 lakh 25,000, it actually becomes minus 25,000. So this cannot be done. You cannot have an item of PPE shown at negative value. So what do you do? To the extent of 1 lakh, you will reduce it from the carrying amount of asset, and the balance 25,000 you will recognize it in the income statement. So to summarize, when entity is following a cost model, if there is an increase in decommissioning liability, you will add it to the cost of PPE. If there is a decrease in decommissioning liability, you will reduce it from the cost of PPE. Whenever there is an increase in the cost of PPE, immediately you have to check for impairment. That's when whenever there is a decrease in liability and the decrease is more than the carrying amount, then to the extent of carrying amount, you reduce it from the carrying amount of PPE, and whatever balance is left, you will take it to the income statement. Let's now have a look at the problem and understand how do we account for changes in decommissioning liability. H Limited purchased an item of PPE costing rupees 100 million, which has a useful life of 10 years. So what is the original cost? Cost is 100 and useful life is 10 years. The entity has a contractual decommissioning and site restoration obligation estimated at rupees 5 million to be incurred at the end of 10th year. So you have purchased the machine. Today you have incurred 100 million. At the end of 10th year, you are expected to incur 5 million. And we know this decommissioning cost should be discounted to year 0, that is present, and we have to add it to the cost of PPE. So this obligation is given to be at 5 million and you will incur it at the end of 10th year. The current market based discount rate is 8%. So you have to discount this 5 million by 8%. H Limited follows cost model for accounting of PPE and SLM method of depreciation. So that's given in the question. Determine the carrying value of item of PPE and decommissioning liability at each year end when there are two cases. Number 1, there is no change in expected decommissioning liability. So in the first case, there is no change in expected decommissioning expenses. The timing of decommissioning expenses is always covered. So in the first case, we are assuming that we will be incurring 5 million at the end of 10 years. There are no changes. This is a straightforward case. In the second case, at the end of year 4, the entity expects that the estimated cash outflow on account of decommissioning and site restoration will be 8 million instead of 5 million. So in the first case, 5 million will remain 5 million. There is no change. In the second case, by the time you reach the end of 4th year, they realize that it is not going to be 5 million, but it will be 8 million. Also determining case B, how H Limited need to account for the changes in decommissioning liability. First thing first, we will do a case where there is no change in decommissioning liability, similar to the problem we have solved earlier. Then we will say how do we factor this change, what is the impact of change, and then what will be the ultimate impact on accounting. So in this question, we need to figure out what is the present value of decommissioning expense which will be incurred at the end of 10th year. So expected decommissioning expenses at the end of 10th year is going to be 5 million. Now this has to be discounted using a discount rate of 8%. So discount rate 8%. Number of years is 10. Right? So you can use the formula present value of expected decommissioning expenses is equal to the amount that is spent, that is 5 divided by 1 plus rate of interest is 8% to the power of 10. This is the number of years. This is nothing but the present value formula. Present value is equal to future value divided by 1 plus rate of interest to the power of number of periods. So that comes to 2.32. Now what do we do with the present value of expected decommissioning expenses? This will be added to the cost of PPE. Now what is the cost of PPE then? Cost of PPE is equal to 100 plus 2.32 million. That is nothing but 100 plus 2.32, 102.32. Now this is the cost of PPE. And the question says that the depreciation is on SL basis. So depreciation per year. So
depreciation per year on SLM basis will be 102.32 divided by 10. That comes to 10.23. So this is the depreciation that we charge every year. Now because there is increase number of decimal as well, so that comes to 10.232. Now coming carrying amount of PPE, what is opening amount is the cost plus the present value of expenses, that comes to 102.32. Depreciation is 10.232 and the closing balance is opening cost or opening value minus the depreciation at 92.08. The opening amount at the beginning of year 2 is nothing but 92.02. Then you charge depreciation of same amount 10.23 and the closing amount will be 92.08 minus 10.23. The closing value will be 81.85. So like this you can prepare the table. So every year you charge 10.23 of depreciation and the opening value minus depreciation will be the closing value or the carrying amount. Now this is the first part of it. In the second part of the question, we need to calculate the carrying amount of decommissioning liability. Now we come to decommissioning liability. What is the opening value? What is the present value? We got it as 2.32. Then we need to add interest at the rate of 8% as time passes by. As we reach closer to year 10, we need to keep on adding interest so that this present value becomes the future value of 5 million. Right? So interest at the rate of 8%. This is also called unwinding of interest. This is also called unwinding of interest. So 2.32 into 8%, that comes to 0.19. There could be some rounding of expenses. Increase the number of decimals. There can be some rounding of expenses. You can take 2.32, you can take 2.316 and compute. It is positive. At the end, whatever is left over, that can be treated as into rounding of interest, and there will be no problem in the evaluation as well. So opening is 2.32 or 2.316. Interest is 0.1853 or 0.19 rounded off. So opening plus interest will be the closing carrying amount. Then the closing balance at the end of year 1 will be 2.316 plus 0.153. Or if you are following the 2.32 plus 0.9, both of them, there is no problem at all. It comes to 2.50.2. Then this becomes the opening balance at the beginning of year 2. To this you add interest at the rate of 8%, which is 0.20. Closing balance is again 2.50 plus 0.2. Like this you continue for 10 years. At the end of 10 years, you get 5. At the end of 10 years, you get 5. This is the amount that we paid to complete the decommissioning activities. Whatever resources has been done, this is how we arrive at this number. Now, how can there be difference in the decommissioning phase 2.32? Then you see it's coming to 5.0087. Right? Now, that difference can be ignored as a rounding off difference. Okay? So, we have calculated both of these, carrying amount of PPE at the end of the year and carrying amount of decommissioning liability at the end of the year, provided there is no revision. Now, we move on to the second case where we see how do we handle the situation where there is a change in the decommissioning liability, change in the estimated decommissioning liability. Now, let's move on to case B. What happened in case B? At the end of year 4, there was a change in estimated decommissioning liability. So, initially they thought they will be spending 5 million, now they will be spending 8 million. So, if you come to the decommissioning liability schedule, this 5 million should now be 8 million. And where are we standing right now? We are standing here at the end of year 4. So, what happens is we need to discount the revised amount that we get at the end of the 10th year, and we have to bring it back to end of year 4. Please understand that this is very important to calculate the revised decommissioning liability. Initially, what was there? It was 5 million. We discounted it and we brought it to beginning of year 1. We discounted it and we brought it to beginning of year 1. Now, we are standing at end of year 4. We are standing at end of year 4 or beginning of year 5. On this date, you got to know that the liability will not be 5 million, but it will be 8 million. So, what you do is this 5 million you have to discount back so many periods so that you get the present value of 8 million at the end of year 4, which is here, or at the beginning of year 5, which is here. So, basically, what we're trying to do, we're discounting it by 1, 2, 3, 4, 5, and 6. So, you have discounted it back by 6 periods so that you get the present value at the end of year 4. This is what we Now, if I just show you the formula here, if I discount this 5 million by 6 periods, what happens? 5 divided by 1 plus 8% to the power of 6. So, I got 3.150. This is present value of 5 million discounted for 6 periods. Because 6 years are left. Now, instead of 5, you have 8. So, this is 5 million. Now, revised is 8 million. 8 million discounted by 6 periods. You need to show you already have over here. I'm just trying to explain the logic. So, if I do that, 8 divided by 1 plus 8% to the power of 6, I get 5.0414. 5.0414. This is the present value of the revised obligation for 6 periods. So, at the end of year 4, initially it was 3.15 the carrying amount. Now, the carrying amount should be 5.04 because you know that there has been a change in the liability. So, what is the increase? Increase in present value terms is this minus this. So 1.8905. Now this increase, you should add it to this number that is at the beginning of year 5 so that this ending number becomes 8 million. So let me show you how this works. If I just change this to 5.0414, you can see from 5.0414, it has become 8 million. So 5.0414, 8% interest comes to 0.403, and then now the closing balance is 5.44. And this time you can prepare the schedule. This continues year on year, and at the end of year 10, the carrying amount will be 8 million. So what do we do here? From 3.15, we have increased the present value of decommissioning liability to 5.0414. And you know that whenever there is an increase in the decommissioning liability, and we are following the cost model, the increase in liability will be added to the cost of PPE. So now the cost of PPE will also undergo change. I hope you are clear with the revision of the decommissioning liability part. So for example, we will not repeat this entire thing again, so you can exclude this portion. You can directly start from year 5, which is 5.0414, and this is how we arrive at this number. This is the present value of 8 million for 6 years. So I'll just write down a note for you. Present value of 8 million at end of year 4 is 8 million divided by 1 plus 8% to the power of 6, which comes to 5.0414 million. Carrying amount at end of year 4 as per original estimate is 3.1508 million. Hence there is an increase of 1.8905 million in the hence there is an increase of 1.8905 million in carrying amount of decommissioning liability. This increase will be added to carrying amount of PPE. So what will you do? This increase 1.8905, you will add it to the carrying amount of PPE. So when you start this period, this will be 61.39 plus whatever is the increase comes to 1.8905. So the revised carrying amount will be 63.28. Now, this 63.28 should be depreciated over a 6-year period. This has been depreciated over a 6-year period. So now the depreciation will also undergo change. So 63.28 divided by 6, you get 10.55. So the depreciation amount will increase from 10.23 to 10.55, and you can see the carrying amount becomes 0. So revised depreciation from year 5 is equal to 63.28 divided by 6. That was also 10.55 million. Right? So from year 1 to year 4, that was as per the original estimate. And once the estimate changed, we increased the carrying amount of PPE by 1.8905 million. So you can actually make a note of it. Revised carrying amount of PPE is equal to 61.39 plus 1.8905. So that will be 61.39 plus 1.905, that is 60.2805. 60.28 as a round off number. So this is how we give the impact of change whenever there is a change in the estimated decommissioning liability. Now this question also asks what is the accounting treatment in the past of the which we have done in the earlier problem as well. So the will be PPE account debit by how much? By 1.8905 and decommissioning liability to decommissioning liability 1.8905. And you also see that whenever you increase the carrying amount of an asset, you have to check whether the carrying amount is recoverable. If you feel there are indications that the carrying amount cannot be recovered, then you have to check for impairment as per Ind AS 36. Right? Now there is an impairment that we handle separately by Ind AS 36.
How do we account for decommissioning liability changes when the entity follows a cost model? Now let us move on to the revaluation model. Again here it may sound complex, but once you understand the logic, it is very simple. In the earlier case we saw that when there is an increase in decommissioning liability, we credit the decommissioning liability account, we increase the decommissioning liability balance, right? And corresponding debit under the cost model was given to PPE. We increase the carrying amount of PPE and we increase the carrying amount of decommissioning liability. But when we talk about the revaluation model, we will increase the decommissioning liability, but we will not increase the cost of PPE. The simple reason being, we are valuing the PPE at fair value. We are doing revaluation on a periodic basis. So it doesn't make any sense to change the carrying amount of PPE again. So if there is an increase in decommissioning liability, you will credit the decommissioning liability account. That is perfectly fine. Where should you debit? Which account should you debit? Now it depends on what happened in the earlier revaluation. Say for example, earlier the same item of PPE was upward revalued, meaning there is a revaluation surplus in the balance sheet. So you can use that revaluation surplus in the balance sheet to take care of this increase in decommissioning liability. What I mean is, you will debit the revaluation surplus account and you will credit the decommissioning liability account. Say the revaluation surplus was 100. Increase in decommissioning liability is 50. So you will debit the revaluation surplus by 50 and you will credit the decommissioning liability account by 50. So revaluation surplus will come down by 50 and correspondingly decommissioning liability will increase by 50. But what if the revaluation surplus stands at 100 and the increase in decommissioning liability is 125? You do not have sufficient balance in the revaluation surplus account to take care of this increase in decommissioning liability. What do we do in that case? Can we increase the cost of PPE? No, you cannot do that. You should not increase the cost of PPE. To the extent balance is available in the revaluation surplus, you will debit the revaluation surplus account and you will credit the decommissioning liability account. And whatever is the balance left over, now for example in this case, credit to decommissioning liability should be 125, revaluation surplus will be divided by 100, the difference of 25 which is not available in the revaluation surplus account, that amount will be credited to the statement of profit and loss. So what will you do? To the extent balances are available in the revaluation surplus account, you will utilize that, and any excess over that you will debit to statement of profit and loss. So the first case, increase in decommissioning liability, to the extent balance is available in the revaluation surplus, you will debit that account, and any excess amount left over will be credited to the profit and loss. So what if there was no operating valuation in that asset? In that case, the valuation surplus anyway is zero, so the entire amount will go to the statement of profit and loss. So increase in decommissioning liability, first utilize it against the valuation surplus. If balance is not available, take it to statement of profit and loss. So let's look at the second case, where there is a decrease in decommissioning liability. The decrease in decommissioning liability is what? You will debit the decommissioning liability account, and now you need to find an account which you can use. Basically, it is a kind of a gain. It is a kind of a gain. Now can I take this gain to profit and loss statement? You cannot do that. So if at all there is a decrease in decommissioning liability, then you will debit the decommissioning liability account and you will credit the revaluation surplus account. You will credit the revaluation surplus account. So again, I'm repeating, if there is a decrease, you will not credit it to profit and loss, you will credit it to revaluation surplus account. But if there was a downward revaluation done earlier and you had debited that deficit to the statement of profit and loss, to that extent you can credit the decrease in decommissioning liability to statement of profit and loss. Similar logic what we follow in case of upward and downward revaluation. So when there is a decrease in decommissioning liability, you can credit the P&L to the extent there was a downward revaluation done earlier. So this is what the treatment when there is a reduction in decommissioning liability. So to put things into perspective, if there is an increase in decommissioning liability, you will credit the decommissioning liability account and you will debit the revaluation surplus. If balance is not available, then you will debit to the profit and loss. If there is a decrease in decommissioning liability, then you will debit the decommissioning liability account and you will give a corresponding credit to revaluation surplus. But if any previous deficit was charged to profit and loss, you will give a credit to profit and loss statement. So there is one more check that you need to do in case of revaluation model, that is you have to calculate the carrying amount of the asset under the cost model, not under the revaluation model but under the cost model, and check that carrying amount with the reduction in decommissioning liability. So this only activity is the reduction in decommissioning liability. So what are we doing? We are calculating the carrying amount of the PPE as if the cost model was followed, and then that amount you compare with the reduction in decommissioning liability. If the reduction in decommissioning liability is more than the carrying amount, if the reduction in decommissioning liability is more than the carrying amount under the cost model, then the surplus will be credited to the income statement. The same way, the same treatment that we gave when we discussed about the cost model. So if the reduction in decommissioning liability is more than the carrying amount of the asset under the cost model, though you are following the revaluation model, you have separately compute the carrying amount under the cost model, and whatever is the difference to that extent, you will credit it to the profit and loss. So if the reduction in decommissioning liability is 150 and the carrying amount under the cost model is 100, the difference of 50 will be credited to profit and loss. Now after the entity has changed the carrying amount of decommissioning liability under the revaluation model, the entity should also assess whether there is a need to revalue the entire task asset, because changes in the carrying amount of the liabilities would also indicate that the carrying amount of assets are not at their fair value, so the entire task asset needs to be revalued. Like under the cost model, there was a request for impairment. Here they need to check for requirement of revaluation. So this is one thing that needs to be treatment. Now this is how the treatment is to be done in case of cost model and the revaluation model. Now coming to depreciation, we have already seen in the problem that wherever there is a change in the carrying amount of PPE, the revised or adjusted depreciable amount will be depreciated over the useful life of the asset. And also note that once the asset has reached its end of useful life and there are changes in decommissioning liability after that, such changes will not be adjusted against the cost of PPE. They will be taken directly to the statement of profit and loss, whether it's the cost model or the revaluation model. The interest which comes on this decommissioning liability that cannot be capitalized under Ind AS 23. So what do you do? Whatever is the interest cost, whatever we call as the unwinding discount part, that has to be taken to statement of profit and loss. So with this we have discussed the treatment of changes in decommissioning liability, what is to be done in case of cost model and what is to be done in case of revaluation model. Now look at some significant differences in Ind AS 16 versus AS 10. So whatever is given by AS 10 and what is given by AS 16. Let's look at the two significant differences. The first one, where fixed assets are retired from active use and held for sale. Ind AS 16 does not deal with these items which are held for sale because such items are covered under Ind AS 105. But as far as AS 10 is concerned, AS 10 gives the accounting treatment for items which are retired from active use and held for sale. So basically we have a separate Ind AS 105 which takes care of the non-current assets which are held for sale. And the second difference is where we have stripping costs in the production phase of a surface mine. For this we have a detailed guidance given under Ind AS 16 under appendix B. So these stripping costs are basically incurred when you have to clear off the waste materials to access to the mining resources. For this there is a detailed guidance given under Ind AS 16 under the appendix, but AS 10 is not provided, and this stripping cost is not covered as a part of our syllabus as well. Let's now have a look at some more illustrations to get a better understanding of whatever we have learned in Ind AS 16. A Limited purchased some property, plant and equipment on 1st of April of year 1 and estimated their useful life for the purpose of financial statement which are prepared based on Ind AS. Following were the original cost and the useful life of various components of property, plant and equipment assessed on 1st of April of year 1. So there are buildings, plant and machinery, furniture and fixtures, original cost 15 million, 10 million and 10.5 million. We can go to zeros. Then estimated useful life 15 years, 10 years and 7 years. A Limited uses straight line method of depreciation and 1st of April of year 4. So when did we start? On 1st of April of year 1 is when we started. On 1st of April of year 4. So from year 1 to year 2, 1 year
is gone, year 2 to year 3, second year is gone, and year 3 to year 4, third year is gone. So on first of year 4, that is after 3 years, then we review the useful life to external valuation is 4. And what is the revised useful life? Buildings 10 years, plant machinery 7 years, furniture and features 5 years. So at the end of 3 years, the revised useful life are 10 years, 7 years, and 5 years. The original life is 15 and 7, 3 years have passed by, and after that we still have 10 years, 7 years, and 5 years. But there are no standard values for the components of PPE either initially or at the time the useful life. So there is no residual value. Compute the impact of revaluation of useful life on statement of profit and loss for the year and then first of March year 5. So for the first 3 years, the life will be 15 and 7. After 3 years, the first of year 4 life will rise. So after that, what is the impact? Basically, we are asking for the first financial year, first of year 4 to 21st of March year 5, what will be the impact on profit and loss? Simple problem. Let us see how we approach it in these kind of problems. So before we compute the impact for the year and 21st of March year 5, let us calculate the carrying amount as on first of year 4 or 31st of March year 4 using the existing estimated life. So what's the original cost given? The original cost of building is 15 million, so I write almost million. Then plant machinery is 10 million and furniture and features is 3.5 million. This is the original cost. What is the life of building is going to be 15 years, plant machinery is going to be 10 years, furniture and features is going to be 7 years. Now based on this information we can calculate the depreciation per year. And also note that the question mentions there is no residual value. Residual value is 0, so we can calculate the depreciation per year directly. That is original cost divided by life, which is 1 million for buildings, 1 million for plant machinery, and 0.5 million for furniture and features. Right? So we can calculate depreciation per year is equal to original cost minus residual value divided by useful life. Right? So since residual value is 0, we will not calculate the original cost divided by useful life. What is the depreciation for 3 years? 1 multiplied by 3, 3 million, 3 million, and 1.5 million. So after calculating the depreciation, calculate the carrying amount, which is original cost minus accumulated depreciation. So 15 minus 3 is 12, 15 minus 3 is 7, and 3.5 minus 1.5 is 2. Then directly calculate the carrying amount. Then calculate the carrying amount of building by 15. That's original cost minus 15 divided by 15 into 3. What we have done in a tabular form, we can use the formula and compute as well. Okay. Now this is the carrying amount 12, 7, and 2, which has to be depreciated over the remaining useful life. There is a change in the useful life. This amount, this carrying amount will be depreciated over the remaining useful life. And this is no residual value even now. So depreciation based on revised useful life for year ended 31st March of year 5. Okay. So for each of these items, what is the carrying amount? For building, the carrying amount is 1 million. For plant machinery, the carrying amount is 7 million. For furniture and features, the carrying amount is 2 million. Now what is the useful life? Revised useful life is 10 years, 7 years, and 5 years. 10 years, 7 years, and 5 years. So what is the depreciation per year? Revised depreciation per year will be 12 divided by 10, which is 1.2, 7 divided by 7, which is 1, and 2 divided by 5, and 2 divided by 5, which is 0.4. Now, if you see what is the total depreciation per year, that is 1.2 plus 1, 2.2 plus 0.4, 2.6, right? That comes to 2.6. What was the depreciation per year? Depreciation per year was 2.5 million. So, revised depreciation per year is 2.6 million. Original depreciation per year was 2.5 million. So increase depreciation is 2.6 million minus 2.5 million, that is 1 lakh. So, after the changes in the useful life, the depreciation impact is additional 1 lakh to the statement of profit and loss. That is to say, amount of 1 lakh will be charged extra as depreciation every year from first of April of year 4.
Let's look at another question. An item of PPE was purchased for 9 lakhs on 1st of April of year 1. It is estimated to have a useful life of 10 years and is depreciated on straight line. So 9 lakhs on first of year 1, 10 years of useful life, and depreciation on a straight line basis. On 1st of April of year 3, that's 2 years, the asset is revalued at 9 lakhs 3,000. The useful life remains unchanged as 10 years. Ignore the impact of the taxation and show the necessary treatment as per Ind AS 16 to calculate depreciation and revaluation surplus for year 3, 4. That is 1st of April year 3, 31st of March year 4. For that period, you need to show the depreciation, the revaluation surplus, and the impact on revaluation surplus. Now here we are not given the residual values, we can assume that the residual value is 0. So 9 lakhs divided by 10 years, 90,000 per year will be the initial depreciation, and then after 2 years will be the value, we will see what will be the revaluation surplus, and then what will be the impact on depreciation. The first thing that we need to do here is to arrive at the carrying amount as 1st of April of year 3. And by now all of you will be proficient to calculate that carrying amount. What is the carrying amount? Original cost minus accumulated depreciation. What is the original cost? Original cost is going to be at 9 lakhs, right? And what is the useful life? Useful life in years, and depreciation per year is 9 lakhs divided by 10 becomes 90,000. Depreciation for 2 years is 90,000 multiplied by 2, 1,80,000. Carrying amount is 9 lakhs minus 1,80,000, 7 lakhs 20,000. Actually, add one here, so we got 9 lakhs divided by 10. Okay. Though it is apparent that this is 90 or 10, but as a practice, it is good to mention at the examination. So this is the carrying amount. So what can be on 1st of April of year 3, the asset is revalued to 9 lakhs 60,000. So carrying amount as 7 lakh 20. Revalued amount is 9 lakh 60,000. 9 lakh 60,000. What is the revaluation surplus? Revaluation surplus is 9 lakh 60,000 minus 7 lakh 20,000. 2 lakh 40,000 is the revaluation surplus. Now what do you do with this revaluation surplus? This revaluation surplus will be created to revaluation surplus account. It will be shown under other comprehensive income, and you increase the carrying amount of PPE by 2 lakh 40,000. And we have seen that two approaches to this. You can do it either on a gross basis or on a net basis. So we will do both methods. Though the question only asks us to calculate the depreciation and revaluation surplus impact, we will do the revaluation part using both methods and see how we calculate depreciation in each of those two methods. So if you follow that method, what do? You transfer the accumulated depreciation amount to the PPE account. So you do accumulated depreciation account debit 1,80,000 to PPE account 1,80,000. Debit 1 is credit, right? Now PPE stands at 7,20,000 carrying amount after this particular entry. Then what do? You increase the PPE amount by this 2,40,000 and credit that amount to revaluation surplus. So PPE account debit 2,40,000 to revaluation surplus 2,40,000. Please note the second line item represents credit. It is not debit. I'm just writing the same column, but in exams you write the debit side separately and credit side separately. Right? So if you revaluation surplus of 2,40,000, then what happens? Then you need to depreciate this item of PPE over the remaining useful life. Now what is the value as it stands on 1st of April of year 3? It is 9,60,000. This 9,60,000 would be depreciated over the remaining useful life. What is the remaining useful life? See, we purchased it on 1st of April of year 1. So 1st of April of year 2, 1st of April of year 3, 2 years have passed by. Now the remaining useful life is 8 years. So depreciation on revalued amount over remaining useful life. How much is that? That will be 9,60,000 divided by 8, which is 1,20,000. So you can write it here. 8. Right. So 1,20,000 is the depreciation that will be charged every period. It will be charged every period from 1st of April of year 3. So what will then be? Depreciation account debit 1,20,000 to accumulated depreciation 1,20,000. Right. So this is the depreciation part. Now we have seen that whatever is the difference between the depreciation based on original cost and depreciation based on revalued amount, you can transfer this portion of difference from revaluation surplus to retained earnings. And the logic for that is we are charging extra depreciation to the P&L, which means our profit has come down, which means our retained earnings will come down. But to compensate to the extent of revaluation, we can transfer that difference from revaluation surplus account to the retained earnings account. See, I charge depreciation as original cost, you have charged 90,000. Now you have charged 1,20,000. This 30,000 extra debit to P&L can be transferred from revaluation surplus to the retained earnings. So in that effect, retained earnings will not be impacted. Your profits will be lower, but retained earnings will not be impacted. So what you can do? Difference between depreciation based on revalued amount and original cost can be transferred from revaluation surplus to retained earnings. Right. So this is one more you can notice down. So what is the difference? Depreciation based on revalued amount is 1,20,000. Depreciation based on original cost is 90. Difference will be transferred to retained
earnings is 1,20,000 minus 90, 30,000. So what will be for that? 20 for that would be revaluation surplus, debit 30,000. We'll leave 30,000 from 2,40,000 to retain earnings 30,000. But please note, you cannot transfer this directly to the statement of profit and loss. You have to transfer this to retain earnings. Now there is already choice in the available is at the end of the useful life you can transfer the entire revaluation surplus balance to retain earnings. So you can do it periodically at a year basis, or you can transfer it all at once at the end of the useful life of a particular asset. Then what is the closing balance? PPE. The value amount is 9,60,000 plus accumulated depreciation 1,20,000. Carrying amount will be 9,60,000 minus 1,20,000, that's 40,000. Then what happens to revaluation surplus? Balance to revaluation 2,40,000. Let's transfer to retain earnings 30,000. Closing balance is 2,40,000 minus 30, 1,10,000. Now the question we have only asked about the depreciation part and the revaluation part. So we will not present this part later PPE, but just for your information and understanding purpose. Now this will be the correct model. What will happen if you follow the gross model? See, the amount should be transferred will not differ. The amount of depreciation will also not differ. Just the presentation would change. So let's see what happens when we follow the gross model of revaluation. Now when we talk about gross model of revaluation, we have to see what is the percentage increase in carrying amount. So carrying amount of the asset was 7,20,000. Revalued amount is 9,60,000. Percentage increase is how much? 9,60,000. Increase is how much? 9,60 minus 7,20, 2,40,000. Percentage increase 2,40,000 divided by 7,20,000. That comes to 33.33%. So what will you do now? You increase the gross carrying amount by 33.33% and accumulate depreciation by also 33.33%. So revalued amounts. Gross value would be your original cost of 9 lakhs multiplied by 1.3333. So that comes to 11,99,970. If you add further a couple more decimals, so we'll count it to 12 lakhs. This will increase by 1/3. Accumulated depreciation. Accumulated depreciation was 1,80,000. Right? So this will increase by 1.3333%. So just have one more 3, 2,40,000. Now in examination, whoever gets confusion, directly multiply by 1/3. So basically what you do is 180 divided by 3 multiplied by 1, that gives you 60,000. This 60,000 you add to 1,80,000. Even if there is a difference because of this decimal thing, you may not worry, you get full marks for that. Right? So carrying amount would be 12 minus 240, 9 lakhs, 60,000. Right? Now we already see how fast for this, you can write there is no precise in that. The thing that I want to highlight is how we calculate depreciation. When we calculate depreciation, there are two approaches. You can take the carrying amount that is 960 and this carrying amount you can depreciate over a period of 8 years as we have seen earlier. The other more appropriate approach is the gross block now stands at 12 lakhs. This 12 lakhs had a useful life of 10 years. So if you see the depreciation, that would be 12 lakhs divided by 10 years, which is 120. Or you can also calculate it as 960 divided by the useful life, 120. So whichever you do, both of the ways are correct. I just want to show you that you can calculate the depreciation even by considering the revised gross block value. Right? And after this 1,20,000 combination of depreciation, remaining entry would remain same. There will not be any difference in that. Right? So in examination for this question, because we are specifically asked to show the impact on depreciation and revaluation surplus, so what you can do is you can see you can calculate the revaluation amount. This is one part of it. So one part of the working will be this one. Then depreciation combination will be the second part. And third part will be this one. Right? So this is one part of the question. Other things I told you just for your understanding so that when if at all any other question comes up, you'll be able to solve that question.
Let's look at another question. Now this is to do with the changes in decommissioning liability. We will first do using the cost model. Then by adding some more information, we'll try to do it using the revaluation model. See, once I practice these kind of questions, I'm 100% sure you are ready for the examination. And questions from this chapter, you can easily score 6 out of 6 or 8 out of 8 easily. Means you cannot make a mistake in these kind of questions. An entity has a nuclear power plant and a related decommissioning liability. The nuclear plant started operating on 1st of April of year 1. So on 1st of April of year 1 that is when the nuclear plant started operation. The plant has a useful life of 40 years. So from year 1 you have to add 40 years, that will be somewhere around 31st of March of year 41. Okay. Its initial cost was 120. Its initial cost was 1,20,000. Now don't bother about how can a nuclear plant be built at 1,20,000, that is the cost, which included an amount for decommissioning cost of 10,000. So this 1,20,000 includes decommissioning liability of 10,000, which is represented as 70,400 in estimated cash flows payable in 40 years, discounted at a rate of 5%. So basically after 40 years you have to pay 70,400. If you discount that by 5%, the present value comes to 10,000, and this 10,000 is included in 1,20,000. The entity's financial year ends on 31st of March. So financial year ends on 31st of March. As on March of year 11, so from year 1 we have moved to year 11, that is 10 years forward. The net present value of the decommissioning liability has decreased by 8,000. So think of it, at year 1 that is at inception, the present value was 10,000. At year 11, first of April of year 11, after 10 years, don't get confused with the number of years, we are starting from year 1. Okay, so after 10 years means year 11. So this 10,000, if you add 5% interest every year, would be some amount at the end of year 11. It would be some amount at the end of year 11, and on that day, the present value of that decommissioning liability should be incurred after 30 years, because once you go forward by 10 years, there are another 30 years left. After 30 years, whatever you bring, you bring that to the present value as on 1st of April of year 11, it has decreased by 8,000. So we need to know what was the original balance as on 1st of April of year 11, and we have to reduce it by 8,000. The discount rate has not yet changed, so we have not changed the discount rate, only the estimated liability has changed. How will that account for the changes in decommissioning liability? It will the cost model. So you have to see on 1st of April of year 11, what will you do with the decommissioning liability? See, as far as decommissioning liability is concerned, it has reduced by 8,000, which means you will debit the decommissioning liability and you will credit the PPE account. You will reduce the cost of PPE also by 8,000. That is the final answer to this question. On the question, figure out what will be the answer. But we'll do the workings and see what will be the impact on depreciation, what will be the impact on the unwinding of discount, and what will be the effective balances. Let's get started. So first, let's calculate the carrying amounts as on 1st of April of year 11, and then we'll see what will be the impact on depreciation on the unwinding of discount part and how will we pass the interest part. Now first thing, let's look at the PPE. Right? So as far as PPE is concerned, cost of PPE is going to be 1,20,000. Okay, cost of PPE is going to be 1,20,000, and this 1,20,000 includes the present value of decommissioning expenses. That's already included, we need not pay that again. Right? Now depreciation. Depreciation for 10 years. Right? From year 1 to year 11, you have to start depreciation. Whether it's not given, so we'll assume that it is a straight line method, no estimated value. So 1,20,000 divided by 40 years multiplied by 10, you get 30,000. So carrying amount as on 1st April of year 11 is 1,20,000 minus 30,000, that is 90,000. Right? This carrying amount of PPE. Then decommissioning
liability, right? What is the decommissioning liability? The present value of decommissioning liability is going to be 10,000. What, when is the present value? As on 1st April of year 1. Okay, as on 1st April of year 1, it is 10,000. Now, 10 years have passed by, meaning we will unwind the discount, we will calculate the interest for 10 years, and then we'll arrive at the value as on 1st April of year 11. So, the present value of decommissioning liability on 1st April of year 1 is 10,000. What is the balance as on 1st April of year 11? So, to calculate balance as on 1st April of year 11, this is nothing but a type of future value. Assume this is the present value that is on 1st April of year 1. If you have calculated the amount on 1st April of year 11, basically calculating the future value at 5%. What is the formula? Future value is equal to present value multiplied by 1 plus the rate of interest to the power of n by the number of years. So, the balance would be 10,000 multiplied by 1.05 to the power of 10. Into this, you get the balance as on 1st of April of year 11 is 16,289. 16,289 is the balance of decommissioning liability applying those interest as on 1st of April of year 11, that is 16,289. And the question mentions that this decommissioning liability of 16,289 has reduced by 8,000. So, as on 1st of April of year 11, the present value of the revised liability is less by 8,000. So, if you reduce 8,000, what is the carrying amount? Carrying amount of decommissioning liability is 16,289 minus 8,000, that is 8,289. This is the revised carrying amount of decommissioning liability after reduction of 8,000. This 8,000 reduction is given in the question as the present value reduction. It is not the future value reduction, it is the present value reduction as of 1st of April of year 11. Now, when the reduction happens, what do? We reduce the decommissioning liability, so we debit decommissioning liability by how much? By 8,000, and you will credit PPE by 8,000. Basically, what I mean, decommissioning liability debit 8,000 to property plant equipment 8,000. Now, what is important here is this 8,000 will be reduced from the carrying amount. So, let us do the adjustment. Reduction in decommissioning liability, how much? 8,000. So, revised carrying amount will be 90,000 minus 8,000, 82,000. Now, you also have to change the depreciation because the carrying amount has changed. You will change the depreciation. So, revised depreciation for next 30 years because 10 years have passed by. So, we will basically do 82,000 divided by 30. That comes to 2,730.80. This will be the annual depreciation that will be charged in the statement of profit and loss. And as far as unwinding of discount part is concerned, interest part is concerned, my carrying amount of decommissioning liability is 8289. Interest cost at 5% for year 11-12 would be 8289 into 5%, that comes to 414. So, this is one part I need to understand. This is the interest cost part of year 414 and depreciation, revised depreciation 2733. So, this is how you read the change in decommissioning liability if the entity is following the cost model, right? So, if there is an increase, you will increase the value of PPE. If there is a decrease, you will reduce the value of PPE. And always remember, you have to check for impairment whenever you increase the value of PPE. And if the decrease is more than the carrying amount, the balance will be transferred to P&L.
Let's look at another question. It is just an extension of the problem that we have just now solved, but has a lot of information and you have to pay utmost attention because
here you understand different aspects of revaluation, multiple revaluation, treatment revaluation, impact of depreciation, all those aspects. Pay utmost attention. Don't get scared with the length of the question. Once you understand this, you'll be able to handle multiple scenarios in a single question. And if you have a plan related to decommissioning liability, new plan starting on 1st April of year 1, the plan is for like 40 years, cost of 120, decommissioning cost of 10,000, which is the value of 7,400 at 5%, all that information is next part. Assume that a market-based discounted cash valuation of rupees 1,15,000 obtained on the 31st of March of year 4. So we started on 1st April of year 1, then we move 1st April of year 2, 1st April of year 3, and 1st April of year 4. So there are 3 years, that is 31st of March of year 4, when the period ends. After 3 years, the valuation is obtained at 1,15,000. This valuation is after deduction of an allowance of rupees 11,600 for decommissioning cost. So this 1,15,000 whatever has been given is after deduction of 11,600 for decommissioning cost, which represents no change to the original estimate. So it is as good as the original estimate after unwinding of 3 years discount. So what does that mean? 10,000 was the value. That 10,000 add 3 years of interest, which comes to 11,600. So the 7,600 is deducted and then you arrive at a net valuation of 1,15,000. So what that basically is, the PPE is an asset from that, they reduce 11,600 and the net amount after deduction is 1,15,000. Nothing that you need to understand here is, you will not reduce the decommissioning liability from the value of asset. So you have to show the value of asset or value of PPE at its gross value, at its fair value. This decommissioning liability of 11,600 you have to show it separately as a liability. You cannot do the adjustment and show a net amount. So the value of asset will be 1,15,000 plus 7,600, that comes to 1,26,600, right? On the 31st of March of year 5, then it estimates that because of technological advances, based on advances, because of technological advances, the present value of the decommissioning liability has decreased by 5,000. So always the value of the carrying amount you get from that you reduce 5,000. Now the reduction of 5,000 can you reduce it from cost of PPE, you cannot, because you're following the revaluation model, you have to that to revaluation surplus. So this 5,000 will go to revaluation surplus. Then it decides that a full valuation of the asset is needed on the 31st of March of year 5 to ensure that the carrying amount does not differ materially from the fair value. The asset is now valued at rupees 1,07,000, which is net of an allowance for the reduced decommissioning obligation. So even here, it is on a net basis after reducing the obligation, you have to add that back and arrive at the gross amount. How will the account for changes in decommissioning liability if you have the revaluation model? Now, if you calculate the question, you will see multiple information. The best thing is to plot it on a kind of timeline. So the first day, 1st of April of year 1, 1,20,000 was spent to acquire plant or the plant was commission. This includes 10,000 of present value of decommissioning liability. Move forward by 3 years, on the 1st of March of year 4, the asset was revalued. This was the first year the asset was revalued, where there was no change in decommissioning liability. Move further by 1 year, there was a second revaluation and there was also a change in decommissioning liability. So these two changes you have to consider and see how we account for those changes. So first thing that we need to know is what was the carrying amount of asset before revaluation as on the 31st of March of year 4. So we started on 1st April of year 1, so from financial year 1, 2, 2, 3 and 3, 4, total of 3 years. Please be careful by counting the number of years. So cost of PPE is going to be 1,20,000. What is the depreciation for 3 years? We know the useful life is 40 years, so 1,20,000 divided by 40 multiplied by 3, you get 9,000. So you can actually make more of it here. 120 multiplied by 3 divided by 40. Assume that there is no physical value, right? What is the carrying amount now? 120 minus 9,000, 1,11,000 is the carrying amount before revaluation. Now the question is just what is the revalued amount? What is the revalued amount? The revalued amount net of decommissioning liability is going to be 1,15,000. So 1,15,000. Now please note that the decommissioning liability cannot be adjusted from the value of the asset as we shown separately. So you will add back the decommissioning liability and show the asset at the gross revalued amount, not in the net revalued amount. And the question clearly mentions, if I read it back to you again, the question clearly mentions that the valuation is after deduction of an allowance of 11,600 for decommissioning cost. Right, so they have done a cash flow based valuation. Basically, it is a method of deriving the fair value. They use the cash flow based valuation, and after adding at the value, they deducted the present value of decommissioning liability, and the net number comes to 1,15,000. We cannot show it on a net basis, so we have to add back decommissioning liability. How much is that? The question mentions it to be 11,600. So if you see this, the revalued amount is 1,26,600. So the revalued amount without adjusting the decommissioning liability is 1,26,600. So the carrying amount is 1,11,000. The revalued amount is 1,26,600. What is the revaluation surplus? 126,600 minus 1,11,000, that gives you 15,600. This is the revaluation surplus, which will be credited to revaluation surplus account. Now, this decommissioning liability, let's do a quick check and see whether we get 11,600. So, the present value at the beginning was 10,000. We need to see for 3 after 3 years for the amount. So, that will be 10,000 multiplied by 1.05 to the power of 3. That gives us 11,576. It has been rounded up to 11,600. Right? So, you can see this 11,600 and 11,576. We go to 11,600. This is the question. This is revaluation surplus. What will we do with revaluation surplus? This revaluation surplus will be credited to revaluation surplus and you will debit that amount to PPE. So, from the net carrying amount of PPE, that is 1,11,000, you will add 15,600 and the revised carrying amount will be 1,26,600. Now, these changes happen as of the 1st of March of year 4. Now, from 1st of April of year 4, that is from next financial year onwards, the depreciation amount will also change. So, let's go to the depreciation amount. Depreciation amount will be 1,26,600 divided by 37 years, which is left over. So 3,422 will be the revised depreciation per year. Now we get that. That is 1,26,600 divided by 37. Right? So this gives you 3,422. That will be the depreciation for the year 2004, 2005. That is for the year ending 31st of March of year 5. So what is the carrying amount now? 31st of March of year 5. If you have the carrying amount, that will be the revalued amount, that is 126,600 minus 3,422. You get 123,178. You get 123,178. This is the carrying amount as on 31st of March of year 5. Now here, what is the revalued amount? Again, the question is what the question. Let's go back to the question. Says the asset is now valued at 1,07,000, which is net of the allowance for the reduced decommissioning obligation. So again here, revalue amount net of obligation is going to be 1,07,000, right? This is the revalue amount net of obligation, which is 1,07,000, right? Net of reduced obligation. So let's see what is the obligation. Opening balance as on 1st of April of year 4 is 11,576, which is around 11,600. Interest at 5%, right? 1 year interest needs to be added. So 11,600 into 5%, you get 580. So closing balance is 11,600 plus 580, that comes to 12,180. This is as on 31st of March of year 5. So what's happening here? 11,600 was the balance as on 1st of April of year 4. To this you add 5% interest, you can multiply by 1.05 as well, and you got the amount that is 12,180. Now to this 12,180, the question says that there is a reduction of 5,000. So by 5,000. So revise carrying amount. As on this, it will be 12,180 minus 5,000, that is 7,180. Right? So this 7,180, or you can round it up to 7,180, take 7,180. This 7,180 is adjusted from the revalue amount to average on 7,000. So you will add decommissioning liability of 7,180. So then you will get revalue amount, is gross for clarity. On this, it will be 1,07,000 plus 7,180 comes to 1,14,180. Now see what's happening here. Now see what's happening here. Carrying amount as on 31st of March of year 5 is 1,23,178, and revalue amount is 1,14,180. So there is a downward revaluation, which is 123 minus 114, 8,998 or 8,000 or 9,000 of 8,998 is downward revaluation. Now see what has happened. First you got revaluation surplus of 15,600. What would you have done with this? This revaluation surplus will increase the carrying amount of PPE and you will credit this to the revaluation surplus. So then you DPE account debit to revaluation surplus. So this is 15,600 debit and 15,600 credit. Please note there is a balance of 15,600 revaluation surplus account. Then here if you see there is a reduction in present value of decommissioning liability, and under the revaluation model, even this has to be taken to revaluation surplus account. So the entry for that would be decommissioning liability debit to revaluation surplus. What is the decommissioning liability reduction? 5,000. Revaluation surplus credit 5,000. Now let's go to balance in revaluation surplus account. 15,600 here and 5,000 here. Then what happened after that? There is a downward revaluation by 8,998. Now this downward revaluation is reduction in value of your PPE. What will you do with that? That amount typically you are taking to the P&L, but if there was an earlier revaluation or there is a balance in the revaluation surplus for this particular asset, to that extent you will use the revaluation surplus account. So the entry for downward revaluation would be revaluation surplus debit by the amount of reduction in revaluation 8,998 and to PPE 8,998. So this reduction in value of PPE for which we have used the earlier revaluation surplus. So let's quickly see what are the balances that will be shown in the balance sheet in respect of the balance sheet. The first thing is the PPE. So this PPE will be shown at the revalue amount, and please note this depreciation model we have computed, right? 3,422. We have passed an entry saying depreciation, depreciation, and this accumulated depreciation will be transferred to PPE account to show it on a net basis before revaluation. So we have passed that earlier as well. Let me just pass that for you now as well. Accumulated depreciation 3,422 to PPE account 3,422, right? So you will do this to make the PPE account on a net basis, and then you do the revaluation from 120,178 to the carrying amount. The revised carrying amount comes to 114,180, right? Now this revised carrying amount of 114,180 will be shown in the balance sheet. So 114,180. Is there any depreciation? No, accumulated depreciation is 0 because you have transferred that to the PPE account. Then we have this decommissioning liability. How much is the decommissioning liability after reduction computed? It is 7,180 that will be shown, and then revaluation surplus. Now please note revaluation surplus has come from three transactions. One, upward revaluation on 31st March of year 4. Okay, that was 15,600. Then reduction in decommissioning liability, that was by reduction in decommissioning liability 5,000. So this was by revaluation surplus. Then downward revaluation, which is going to be, which was 8,998. So we will leave that. So the final balance would be 15,600 5,000, 2,600 minus 8,998, that comes to 11,602, right? So this is how you present those balances in the balance sheet. Now this surplus is, if there is an increase in the value of an asset, the revaluation surplus will be created. Subsequently, if there is a reduction in value of an asset, to the extent of balance in the revaluation surplus, you will utilize the revaluation surplus and you will debit the revaluation surplus account in the P&L account. And whenever you are doing this revaluation, you will transfer the accumulated depreciation to the account of PPE. I suggest that you go through this problem once again so that you have a proper grip on these kind of problems.
Let's now have a look at an examination question. This was asked in November 2019, more of a theoretical question, applying the concept whatever we have understood. M Limited is setting up a new factory outside the Delhi city limits. So the company is setting up a factory outside the Delhi city limits, and to facilitate the construction of the factory and its operation. So basically you are setting a factory outside the city limits, and to facilitate the construction and also its operations, M Limited is required to incur expenditure on the construction or development of a electric substation. Basically it looks like to supply electricity to that factory, they have to develop or they have to build a electric substation, right? Though M Limited incurs or contributes to the expenditure on construction and development, it will not have ownership right on these items, and they are also available for use to other entities and public at large. So basically what's happening, there is a factory being set up outside the city limits. To supply electricity to that factory, they are building an electric substation. Now this electric substation, though the company is incurring cost to build that substation, it does not have exclusive ownership rights. So basically, it does not have right to control it fully. It cannot ask others to not use that particular substation. They build a substation, it will be available to other entities, it will also be available to public at large. Now the question is about whether the expenditure incurred on building that electric substation can be capitalized as an item of PPE. Now the truth is, factory definitely straightforward, you can capitalize as an item of PPE. What do we do with the expenditure if you incur on a particular electric substation? And the question also mentions that the entity will not have control over an electric substation. Just that it is facilitating the factory that is being built, it will facilitate the operation of the factory. Whereas the electric substation can be used by other entities, can also be used by public at large. It's like if you build a road, do you build a road, you do not have exclusive control over that road. So as far as this electric substation is concerned, it cannot be capitalized as a separate item of PPE because it does not meet the recognition criteria. Benefits to the entity may not independently available from this electric substation. And we have seen that the fundamental basic criteria to recognize an item of PPE as an asset is that there has to be future benefits to the entity. In this case, this electric substation is not independently giving us any benefit directly or indirectly. But the cost that you have incurred on building this particular electric substation is to facilitate the construction of factory
factory. So if you look at the factory project, this cost of electric substation is somewhere related to the construction of that factory. Had you not built the electric substation, you would not be in a position to construct the factory or operate the factory smoothly. So as a part of the overall factory, you can include this particular cost to the cost of constructing that particular factory. So independently, this electric substation is not a separate asset, but as a part of the overall factory project, you can add this cost because this cost is being incurred to build that particular factory. Right? So this here, you can add the cost incurred on this electric substation to the cost of the factory. Now coming to the next aspect is depreciation. Now as far as depreciation is concerned, if cost of a particular item is significant in relation to the overall property plant equipment, you have to do a component-wise depreciation. Now this electric substation, you may think that it can be a component, but we are not depreciating the electric substation. We have added this cost of electric substation to the overall factory cost as a directly attributable cost, and we are depreciating the factory. We are not depreciating the electric substation. So there will not be any component-wise depreciation, even though the use of electric different. The cost has gone to the cost of factory and not at the cost of electric substation. So as far as depreciation is concerned, you will depreciate this particular cost along with the other expenditure that you incur on building the particular factory. Now this is how you should understand and approach these kind of questions. Now let's look at how we can present this answer in the examination. So now, as we understood that a property plant equipment shall be recognized as an asset if it is probable that the future economic benefits associated with the item will flow to the entity, which in this case, using the electric substation, there does not seem to be a direct economic benefit to flow to the entity. And the second is the cost of item measured value. We can measure the cost of item, but direct economic benefit, indirect economic benefit doesn't seem to flow from this particular item. Right? And hence, we cannot recognize this electric substation as a separate item of PPE. Right? Then, as we discussed, the electric substation cost whatever we have incurred, we add it to the overall factory cost. Now, do we show electric substation separately? We will not do that because here we are not capitalizing that particular electric substation. Only the cost of the electric substation is being added to the cost of construction of the factory. In this does not describe the unit of measure of recognition, so we have seen already that the unit of measurement is right? Right? And the judgment is required to apply the recognition criteria on entities specific circumstances. Basically, what I'm trying to say is there is no unit of measure defined, and we have to take judgment based on specific entities circumstance. Then, coming to the addition of this electric substation cost to the overall cost of factory. The cost of an item of PPE comprise any cost which are directly attributable to bring the asset to the location and condition necessary for it to be capable of operating in the manner intended by the So this is very important. This particular is very important that whatever cost can be incurred, if it is incurred for bringing that asset to the location and condition necessary for it to be capable of operating in the manner as intended by the management. So I need the cost of this electric substation to ensure that the factory is built and also to ensure that the factory is in a smooth operating condition. So in the case, electric substation is required to facilitate the construction of the factory and also for its operation. And hence, expenditure on these items is required to be incurred to get future economic benefits from the project as a whole. So from electric substation not getting anything, but for the project as a whole, this expenditure was necessary. And this particular project can be considered as a unit of measure for the purpose of capitalization of the same expenditure, even though the company cannot restrict the access of others for using the assets individually. So even though you cannot restrict the access, you can capitalize this cost as part of the cost of the overall project. In view of this, even though the unit may not be able to recognize expenditure incurred on electric substation as individual item of PPE, expenditure incurred may capitalize as part of the overall cost of the project. So this is the crux of the solution. Hence, the expenditure incurred on electric substation should be considered as cost of construction of the factory. Accordingly, the expenditure incurred on electric substation should be allocated and capitalized as part of the items of PPE. Now, as far as depreciation is concerned, if the cost of the item is significant to overall PPE, then you have to depreciate separately. But in this important thing is, the cost has been included in the cost of property plant equipment as directly attributable cost, and hence it will depreciate over the life of the said property plant equipment as the project. You will not depreciate it separately. Now, we present the balance sheet. The electric substation will be presented along with the cost of the factory. So this is how you get quite close. Now, this is an 8-mark question. Make sure that you write the recognition criteria of the mass. Then analyze the case why we cannot separately capitalize the electric substation. Then justify why we should add the cost of electric substation to overall factory. Then how should we handle the depreciation and what is the presentation.
Let's look at another question.
Why there is a company which manufactures aircraft engines and sells them large engines like so basically the company first using it in the exam also. On first particular one, they reported company began the construction of new production line in aircraft parts manufacturing. They are building a new production line and the cost of the production lines are going to be in thousands. Right? Cost of material which is priced after the discount 10,000 exactly 0 10 million for 1 crore. Right? So cost of level is 10,000. This is the cost which is incurred. When 10,000 manufacturing 10 million. Right? So 10,000 is the cost which is incurred for building a production line including the cost of GST. Because the GST is not included in the purchase cost. So this GST which is incurred basically input and is not included. What we do is we ignore this particular item. Employment cost of the construction staff for 3 months to 30th June. So from 1st of April till 30th of June, they incurred 1200. Right? So this is for information on this. Otherwise, directly related. So if it is directly related, will include. If it is allocated, will not include. Payment advice relating to the construction basically some other cities 500 included. Expected dismantling and restoration cost 2,000. Right? Construction staff was engaged in production line, which took 2 months to make ready for use and was not in use on the construction. Basically, the plant took 2 months to get ready, and what is the 3 months salary? All the 3 months salary, you can only 2 months salary. The other overhead incurred 2 months period and then construction. This included a normal cost of 3 lakhs, that is 300,000, caused by the nature of the fault. So, in this overhead of 900, 300 is abnormal item. You consider abnormal item, you not consider 900 minus 300, 600 be considered as cost. The production line is expected to have a useful economic life of 8 years, which is basically for depreciation purpose. At the end of the time, filing errors limited is legally required to dismantle the plant in a specified manner and restore basically decommissioning expenses. The amount of 2 million mentioned above is the amount that is expected to be incurred and basically the future amount that is spent is 2 million. You have to bring it back to the present value. The appropriate rate to use in discounting calculation is 5%. So if you use 5%, the present value of rupee 1 payable in 8 years at a discount of 5% is approximately rupees 0.68. So then you need to do those calculations. 4 years after you got to use the production line require major overhaul. Now we know that if there is, we know if there is any major overhaul, that has to be treated as a separate component for the calculation of depreciation. To ensure it generates economic benefits for the second half of useful life, the estimated cost of the overhaul at current prices. So this is given what is the current price of the overhaul, that is 3 million. 3 million is 3 lakhs, right? The company computes depreciation on a monthly basis, straight line on a monthly basis, and no impairment method by the first month here. Analyze the accounting implication of the cost related to the production line, we will mention the balance sheet and profit and loss for the year and the first month here. Basically, what all will be the cost and capitalized, what will be the expense, and what will be shown in the balance sheet, what will be shown in the P&L, what will be the decommissioning liability, what will be the depreciation amount, all that we need to calculate. Simple question, a linear one, but again, once you clear the concept, you can get 12 marks out of 12 marks in this question. This was given in May 2020 RTP. So let's not compute the cost of PPE first to begin with, then we move on to other aspect. The question says cost of material after discount, this one has to be the production. So zero select amount. So that is here. So the cost of material, cost of basic material is given 10%. And only and moving to last first. Then recoverable goods and service tax. So we know recoverable GST will not come out of cost, it will be offset against the output GST liability. Employment cost of construction staff for 3 months. And the question said that they have worked on construction only for 2 months. So employment cost of construction staff. What the cost? Total cost incurred is 1200. 1200 multiplied by 2 divided by basically find out the monthly number. 1200 divided by 3 multiplied by 2 get 800. Then divided. Then other overhead directly related to construction 900. Out of this 300 is towards abnormal loss. That 3 lakhs whatever you 300,000 has to be reduced from this 900,000. Overheads directly attributable is going to be 900 minus 300. 600 for the second 900 minus 300 is 600. Then payment structure by that included. How much is that? 500. Expected dismantling cost, present value of cost. So expected cost is 2,000 multiplied by the factor given was 0.68. So that comes to 1360. 2,000 into 0.68. Apart from this, more information given. And the question also mentions that 4 years after the being brought into use, the production line will require major overhaul to ensure it generates economic benefits, and the estimated cost of overhaul at current prices to this cost is 3 million. Should we add this cost to the cost of PPE? Because the information given should not blindly add this overhaul cost, because this is estimated cost to be incurred in the future for overhaul, and this information is given to us to indicate that you have to have a separate component for overhaul cost. So whatever is the total cost that incurred, let's add this. 10,000 plus 800 plus 600 plus 500 plus 760, we get 3260. Out of this 3260, you need to separate this 3260 into 2 components. One towards overhaul, because that overhaul has a life only of 4 years, and current estimated overhaul cost is 3 million. So that 3 million should reduce from this total cost and show it as a separate component for depreciation purpose, and balance will be depreciated separately. Overall cost has a life of 4 years, so 3 million will be depreciated over 4 years period, and the balance will be depreciated over a 8 year period. You will not show separately in the balance sheet, but for the total computation of depreciation, you show them separately. This is not an additional cost being incurred. Please understand that. This is an estimate we are doing for the overall cost, right? Now if you have any confusion here, go back to the example when we discussed about replacement of turbine. So you understand the logic why we are segregating these into 2 components. So components for depreciation. Overall cost at current prices 3 million, 3 million is 3,000, because we are in houses. And other cost will be 13,260 minus 3,000, 10,260. Now let's calculate depreciation. Depreciation for each period ending 31st March year 2. So depreciation for period ending 31st March of year 2. Now please note the plan was ready by 31st of May. So from June onwards till March you will calculate the depreciation, that is for 10 months. Right? So first let's calculate for overall cost. Now if you see overall cost 60,000 divided by, it has useful life for 4 years. It has useful life for 4 years. Now 3,000 divided by 4 will give you annual depreciation, but you need to calculate depreciation only for 10 months. So multiply by 10 divided by 12. So you have to take 3,000 divided by 4 multiplied by 10 and divided by 12 you get 625. Right? For overall cost depreciation 625. For other costs, for other component you have 10,260 divided by, this is for 8 years. 8 years multiplied by 10 divided by 12 you get 1,069. So for the balance amount the depreciation is 10,260. It has useful life for 8 years and you calculate for 10 months you get 10,169. So total depreciation is 1,069,695, 1694. Right? So in the balance sheet what will you show asset at a gross value of 260 minus the depreciation of 1694 you present in the balance sheet. So now let's start presenting the amounts relevant to balance sheet and profit and loss. Property, plant and equipment. Cost. How much is the cost? Cost is 13,260 plus accumulated depreciation 1694. Carry amount is 13,260 minus 1694, 11566. That's the carry amount for property, plant and equipment. Now apart from this, in the balance sheet we would have to show this present value of dismantling cost, decommissioning value, whatever we have to show what is the closing balance. So under non-current liabilities you have decommissioning liabilities. What is the value for this? Opening balance is computed to be 1360 is the opening balance. Add interest at 5% for, and please be careful, we are calculating only for 10 months period. From the date the plant is ready for use, that is on 1st of June onwards, for 10 months what is the unwinding of discount? So that will be 1360 multiplied by 5% divided by 12 multiplied by 10 you get 57. So what is the closing balance? Closing balance will be 1360 plus 57, 1417. Let's look at the extract profit and loss. We have to show what the depreciation. Depreciation for which we are working here. So depreciation is 1694. Then we have finance cost for which we are working here. 57. Right. So these are the two amounts which will be charged to the statement of profit and loss. Here. And extract balance sheet present. Under assets you have non-current assets. Right. And non-current assets we have PPE. The PPE amount we have arrived at the carrying amount of 1566. And under equity and equity liabilities you have non-current liabilities. Under that you have other liabilities of 14170. This is how you present this simple question. If you understood the logic and if you approach it in a step-by-step manner, you will be able to solve it easily.
Let's now do a quick recap of whatever we have learned in Ind AS 16. The first thing, exclusions from Ind AS 16, non-current assets which are for sale, which will be not 5. Then biological assets which are related to agricultural activity other than beer plants, which are covered in Ind AS 41. So if it is a beer plant, it comes in Ind AS 16. Other biological assets which are related to agricultural activity will be taken under Ind AS 41. If it is an animal which is not related to agricultural activity, even that will be covered under Ind AS 16. Then decommissioning, measurement, exploration, evaluation assets that will be there in Ind AS 116. And mineral rights, mineral reserves, oil and natural gas and similar non-regenerative resources, these are also excluded from the of Ind AS 16. We also understood the definition of PPE. These are tangible items which are held for use in the production or supply of goods or services for rental purposes or for administrative purposes and are expected to be used for more than 1 year. They are tangible, either using them for production or supply of goods and services or for administrative purposes or for rental to others. Then the recognition criteria, you will recognize the cost incurred on item of PPE as an asset only if two conditions are satisfied. The first one, it is probable that the future economic benefits associated with the item will go to PPE and the cost can be liability. So if these two conditions are satisfied, the cost which is incurred on item of PPE will be recognized as an asset. Basically, we calculate that expenditure. Then as far as spare parts, standby equipment and servicing equipment are concerned, in the new recognition criteria, we calculate them, otherwise we will extend them to the statement of profit and loss. Then we discuss about subsequent cost. If it is regular repair and maintenance, you will not calculate item, you will directly extend to the statement of profit and loss. Then when it comes to replacement of parts of property plant equipment, if you are replacing a part, then the new part, if it meets the recognition criteria, you will calculate the regular part and the part which has been replaced, the older part will be recognized. And you have seen how to arrive at the value of the part which is being recognized. Then coming to the inspections and overall, whenever these inspections and overalls are being carried out, then the cost which are incurred will be calculated. They will recognize and add to the carrying amount of PPE and the cost which are incurred earlier, then we recognized. We have seen problems as to how we calculate depreciation and how we do the recognition as well. We also understood what is the cost. Whatever the purchase price net of discount, and you will exclude the duties and taxes which are recoverable. But if any duties and taxes are not recoverable, then we add to the purchase cost. And we will include all the costs which are incurred to bring the item of PPE to its current condition and location and to be operated in the manner as intended by the management. So transport cost, insurance cost, loading, unloading, everything that has been incurred to bring it to the location and condition to be operated in the manner which is intended by the management. All the costs will be added to the cost of PPE. After it is ready for use, then you will not add any further cost. You will not capitalize any further cost. And very important, depreciation will also start the moment the asset is ready for use, irrespective of whether you use the asset or not. Then important aspect of cost of dismantling, removal, site restoration, basically decommissioning related cost. Even the present value of the cost will be added to the cost of PPE. Sometimes entities may carry out certain incidental operations which is not required to bring the item of PPE to its current condition and location. Such items of cost will not be added to the cost of PPE. And even if you get some income out of such operations, that will not be reduced from the cost of PPE. For example, if there is a vacant land which is practically built and given that you start the construction, you for parking purposes, then the income from such activity will not be reduced from the cost of PPE. They will be taken to the statement of profit or loss as other income. You will only consider those operations or those activities which are absolutely necessary to bring the item of PPE to its current condition, location to be operated in the manner as intended by the management. We also understood how we handle deferred returns. We are putting item of PPE beyond the normal returns. Then you segregate between the cash price and financing component. You will capitalize the item of PPE only at the cash price and the financing element will charge as financing costs. Then we understood about items being acquired in exchange. So you basically one item of PPE acquired by item of PPE in exchange. Whenever exchange transaction happens, you will measure the item which is acquired at the fair value of asset which is given up. But if the transaction lacks commercial substance, then you will use carrying amount of asset given up. Also, if you cannot measure the fair value of asset acquired or asset given up, even then you will use the carrying amount of asset given up. So what is commercial substance? Commercial substance means after that exchange, there is a significant change in the nature of the timing or the risk associated with the cash flow. So if you take old machinery and buy a brand new machinery with different technology, there is commercial substance. But if you take 5-year-old machinery and acquire another 5-year-old machinery which has similar kind of operational abilities, then there is no commercial substance. So you have to check if there is commercial substance or not. If there is commercial substance, then fair value of asset given up. If there is no commercial substance, then carrying amount of asset given up. If fair value cannot be determined, then also carrying amount of asset given up. After initial recognition, we spoke about subsequent recognition. Again, there are two models to respect. One is the cost model, which is the simplest model of cost. There will be initial cost, less accumulated depreciation, less accumulated impairment with the carrying amount. The other one is the revaluation model, where an entity revalues or brings the asset to its fair value at periodic intervals. Like if the fair value fluctuation is high, then it will every year. If the fair value fluctuation is not so high, if the fluctuations are not significant, then it will be calculated 2 years or 3 years or 5 years period. So the revaluation model, you revalue the assets and bring the assets to its fair value. Now, whenever revaluation is done, it's possible that there is an upward revaluation or downward revaluation. If there is an upward revaluation, whatever is the gain is related to the revaluation under OCI. Then if there is a downward revaluation, you will charge that loss to statement of profit or loss. So there are exceptions to this. If there is an upward revaluation, but earlier there was a downward revaluation, you will transfer an amount to the statement of profit or loss. To that extent, you can give to profit or loss, and over and above that, you will transfer the amount to revaluation surplus. Also, in case of downward revaluation, if there was upward revaluation earlier, then to the extent of revaluation surplus for this asset, you will debit the revaluation surplus, and anything over and above that, you will transfer the statement of profit or loss. Now, what do we do with this revaluation surplus?
periodically you can transfer the difference between the revised depreciation and depreciation based on original cost to the statement of profit and loss. The second approach is at the end of the useful life you transfer the entire revaluation of the balance to the retained earnings. You cannot transfer this revaluation of the balance to the statement of profit or loss. And when we talk about revaluation must be done for the entire asset falling within a particular class of assets. You cannot say I revalue one item and I not revalue another item within the same class. So if you have revaluation for the entire class of assets, revaluation model needs to be followed. We also discuss about depreciation. When we calculate depreciation, we need to identify what the depreciation amount is. The cost minus the residual value divided by the useful life. So this cost can be the initial cost or any other amount substituted for the initial cost. Basically, when we calculate revaluation of that, instead of using cost, we use the value amount. And whenever there are changes in the estimated useful life or the residual value of the particular asset, then you will have to give the impact prospectively. There is no retrospective indication. The changes have to be accounted for prospectively only. When you come to depreciation comes when the asset is ready for you, irrespective of whether you use the asset or not. The moment it is ready for you, you will start charging depreciation. And when you stop to charge depreciation will cease at the earlier of the date that the asset is classified as held for sale. So you have classified the asset as held for sale, or the date on which the asset is derecognized. So if the asset is derecognized, then you want the depreciation, or the asset is held for sale, you stop charging depreciation. When you stop the depreciation, it could be a straight line method, it could be a written down line method, or it could be a production method. Whichever is the best presentation of the consumption of benefit from the particular asset, you use the method accordingly. Then you spoke about depreciation, so that the carrying amount of PPE will be recognized either on disposal or when no further economic benefits are expected from the disposal. On that date, you will recognize the item of PPE. Then we also understood about the changes to decommissioning liability as in by This is an overall summary of what you have discussed in this standard. Now, two kinds of questions come in decommissioning. One is a numerical based, so you have to solve problems. Then is a simple one, and then you have theoretical question where you have to apply the concept of indexing and present the answer. Right? But whatever question comes from this chapter, make sure over 6 months, 8 months, 12 months, you pocket them. This is a story in AS, there is not making mistakes. And also because you learn almost all of these things as you see in the level, so you should not be making mistakes in the standard. So this brings us to the end of Ind AS 16.